Good morning. It is 9 a.m. on Monday, January 31st. This is Yahoo Finance Live. I'm Julie Hyman, along with Brian Sozzi. Let's take a look at futures here this morning. We are seeing a bit of a mixed picture here. We've got the Dow and the S&P futures actually pointing to a lower open this morning, modestly lower open. Nasdaq futures, though, are in the green. They're up by about 0.25%. So it does look like it could be a rocky end to a dismal month, what could be the worst January ever for the Nasdaq. We're going to tell you why two of Wall Street's top strategists think things could get worse before they get better. A $16.5 billion software deal this morning. Citrix Systems is getting taken private by Vista Equity Partners and Elliott Management. We'll have the details as the shares, unusually on a deal news day, fall for Citrix. And Joe Rogan is sorry. The controversial podcast host issues an apology after musicians pull their material from Spotify. The stock, by the way, is rising this morning, but hey, my, the shares have tumbled over the past year. Yes, that was for you, Brian Sozzi. And I just wanted to talk about where we are setting up here this morning as we look at the month of January, because it has been such an unusual January, right? First of all, Januaries don't tend to be negative. And second of all, they certainly don't tend to be this negative. I mentioned that it looks like we're going to have the worst NASDAQ performance this month ever, I should say. The closest we got, I believe, was back in 2008 or 2009, it was 2008 when we had a decline of 9.9% on the month. So take a look at the Yahoo Finance Interactive. Just wanted to quickly whip through some of the performance that we have seen year to date for some of the majors that we watch here. The Dow is down 4.4% year to date. The S&P 500 down 7% thus far in January. But the Nasdaq, again, is the big loser here. It is down about 12% year to date. And we all know what has been going on this month as we've seen volatility go higher. A lot of it has to do with what's been going on with yields and the expectations for what is going to happen to interest rates this year. So we looked at a pretty big increase in bond yields over the course of the month. More than 20 basis points was the increase that we saw to 1.8%. And so we get this sort of valuation and PE compression as that has been going on. So that's been really the big overarching theme that we have seen over the month of January. And then there have been some specific themes, certainly, that we have seen with the various groups and the various other asset classes. One of the other asset classes that we've watched closely here has been cryptocurrencies, of course, and they are down, or Bitcoin is down, I should say, specifically 22% year to date. Now, the volatility that we've seen overall in stocks is not unusual for something like Bitcoin, but nonetheless, it has created some consternation, certainly, Brian Sozzi, for people who got into Bitcoin or crypto more broadly last year while it was seeing incredible gains and now have been posting some losses. But, you've been looking at some other areas and some other notable investors, shall we say, who have had some turbulence over the past month.
Yeah, just speaking of this new age digital economy, Julie, look at the ARK Innovation ETF. Last year was one of the hottest tickers on all of Yahoo Finance. This year, still hot, but the fund itself, or the ETF, definitely not hot. Down about 28% so far in January, just absolutely clobbered here because of pressure on some of the top holdings like a Tesla, Zoom, Teladoc. Roku has just been absolutely obliterated the past 3 months. So far, this ETF has lost a little over half of its value the past year. A lot of pressure on Cathie Wood here, who appears to be doubling down. A new release or a new disclosure late on Friday, Julie, saying she has been buying more of Robinhood here after the company's earnings report last week. So we saw that reversal in Robinhood on Friday. Perhaps it was because of this Cathie Wood buying. Nonetheless, Wood continues to be all in on this new age digital economy.
Yeah, she definitely does. And we saw those Robinhood shares, by the way, rebound on Friday. I'm looking at the Wi-Fi Interactive at the performance that they have seen specifically. But of course, the year-to-date chart looks ugly, and the one-year chart looks even worse. But let's look elsewhere. We're going to get to meme stocks in just a moment, but I want to look at some of the large cap tech movers. Here's the intraday move and the bounce that we saw on Friday for many of these companies. But that bounce coming on the back of some pretty dismal performance here. There's less than 10, as you see here in the Nasdaq 100, that have actually risen on the year. 10 little tiny spots of green in what is a very red screen. as you can see from this chart, Tesla, one of the worst performers on the year-to-date basis, and the declines that we have seen here, down by nearly 20%, which last I checked was technically a bear market. You've got Apple shares, even though they bounced on Friday following earnings, down sharply. Amazon down 13.6% as well. And that also brings me to the sectors. This has been really interesting because tech is actually not the worst performing group year to date. It's consumer discretionary, actually, down by 13%. We've seen some of the more recent spending numbers that have been kind of rocky. Maybe that's contributing to this, as well as the concerns over multiple compression here, down 13% year to date. The XLK, which is tech, is down 9% year to date. And communication services, which is XLC, which includes stuff like Facebook, is down by 7%. Real estate, also one of the worst performers. Of course, the standout is energy. And Saz, if you looked at a list of the S&P 500 individual movers year to date, the top 10 are all energy companies, and the XLE is up 18%. Of course, if I switch it on up here and take a look at what has happened with oil prices year to date, you can see why. There's the intraday move in oil prices, but year to date, 15%. Over $87 a barrel for crude. And so obviously you've got this intertwined move upward on concerns over supply, on a robust outlook for demand, and that all equals higher oil prices and higher energy stocks as well, Saz.
You're trying to get me excited about Schlumberger and Transocean. I know I joked a couple of weeks when these companies were a couple of weeks ago when they reported earnings, but look, I mean, the energy trade has been a consistent one throughout this year. You're having calls, I think, out there on the street. Many folks now looking for over $90 a barrel in terms of oil prices here. We'll hear from Exxon this week in terms of earnings here. We heard from Chevron last week, a little bit of a disappointing quarter from them. Exxon out this week. Maybe we'll hear some better news from them.
Yeah, and finally, meme stocks year to date. I know that's something that you've been watching closely as well. A lot of people have commented on. I've got that up on the Wi-Fi Interactive as well, in the year-to-date movement that we have seen here too. Not a lot of green to be found, Saz.
Nope, nothing doing. Look, the two names I'm looking at here, year-to-date, GameStop down 34%. Where are all of those GameStop apes here that are so excited about this company's prospects? How come they are not stepping in? Why don't they, just stop tweeting at me for a second and perhaps go reanalyze the company's fundamentals and to see if they should be buying on weakness? Along that same thread, Julie, AMC shares down 44%. Now I'm looking at a really good note from Julian Emanuel over at Evercore ISI. He dropped what he's calling a, quote, meme stock 180 list. A whole bunch of stocks, or meme stocks specifically, they're down more than 50% from their peak of the meme stock frenzy in the first half of last year. And some of these declines, Julie, are absolutely startling. You have Beyond Meat. I know I caught an upgrade this morning, but still down 75% from that first half peak last year. You have Lemonade down about 85%. They're an insurance company. Stitch Fix, a company we've been very critical of here, Yahoo Finance. That stock is down 87% from its highs. Peloton, another company we've been diving into recently, 86% down from its first half high. So the read is, where did all those retail investors go? They are not in these meme stocks. They have not come out here, Julie, to defend these names.
Well, according to the Wall Street Journal this morning, they're going to blue chip stocks. They're going back to quality. They're going back to good old-fashioned blue chips. I haven't even heard the phrase blue chips in quite a while, Brian Sosnick.
No, I thought they retired it.
What's old is new again. So let's take a step back. We've kind of drilled down here into what we have seen thus far in this January and a lot of concern that's being baked in here. But a couple strategists out this morning saying things might not be done. One of them has been a perennial bear, I think it's safe to say, and that's Mike Wilson over at Morgan Stanley. The other is David Kostin over at Goldman Sachs. And he's not necessarily as bearish here. To be clear, he's saying there are downside risks. But he also went back and did some research, looks at corrections that we have seen in the S&P 500, and says that even though those downside risks are there, that historically investors have been rewarded when they get in at the bottom of a correction. Now it's tough to say when the bottom of the correction will be, but this is the research that he provides for us. He says after you buy the S&P 500, if it's 10% off its high, you do well than just in a regular bounce kind of period here. So that's an interesting thing to keep in mind here, even if there's still going to be some near-term turbulence. By the way, Saz, one more thing that crossed this morning that caught my eye. from the GDP, from the economics team over at Goldman Sachs. They're cutting their GDP growth forecast for the full year to 3.2%, which is lower than we're seeing the consensus out there.
Top themes, if you're working on a Wall Street strategy shop. One, are you out there downgrading your GDP forecast fast enough because everybody's doing it? And then secondarily, everyone on the street seems to be tripping over themselves to forecast higher rates this year. So far, the winner on that is the team over at Bank of America looking for 7 rate hikes. That's out of Ethan Harris. He'll be on with us later in the show. Goldman Sachs now lifting their rate hike expectations this year to 5 from 4. So these are some of the two dominant themes out there on the street right now. And then looking at Michael Wilson, a friend of our program. He came on about a week and a half ago, stayed true to his S&P 500 4,400 call, struck a bearish tone. Now he's out this morning saying the S&P 500 fair value, Julie, might be 4,000, advising people to stay defensive in their stock positioning. Yeah,
and just to note, he says fair value remains closer to 4,000 tactically. Tactically tends to be a code word for sort of short term, right? This is not necessarily his long-term call. You probably know what's his year-end target for the S&P 500?
4,400, but also too important, Julie, to highlight why he is tactically saying 4,000 might be right here. He just says the Fed, the safety net of forward guidance from the Fed is gone. And another thing to watch out to, and I'm starting to pick up here in earnings. Earnings revisions are starting to come into the downside for many companies, and also manufacturing reads, as seen through the PMI reports. Those are starting to come in a little bit weakish here. So that's the next thing that I think Wilson is looking out for.
Well, it's going to be another busy week for earnings, so we should get some more context, commentary from all these companies about not just what last quarter looked like, but what this quarter and this year are going to look like. Now, as these economics and strategy teams consider how many rate hikes are going to happen this year, they also have to consider what the size of the hikes are going to be at each meeting. And Raphael Bostic of the Atlanta Fed reportedly saying could be 50 basis points if it's necessary at the March meeting. Our Brian Chung is going to talk to him later today. I imagine that's going to be a topic of conversation, Brian.
I think it will be as well. Obviously, when we talk about the Fed's next moves, it's going to happen not so long from now, in about 5 weeks. In that mid-March meeting, they're going to move. That appears to be the case, as we heard from Jay Powell last week. And we also hear from the more dovish members of the Federal Reserve, like, for example, Minneapolis Fed President Neil Kashkari, who I spoke to in Minneapolis on Friday, who said he appears to be favoring a first rate hike after the pandemic in mid-March. That's pretty remarkable for one of the members considered to be one of the more dovish policymakers on the Federal Open Market Committee. But take a look at what the Atlanta Fed President Raphael Bostic told the Financial Times over the weekend. Quote, "If the data say that things have evolved in a way that a 50 basis point move is required or would be appropriate, then I'm going to lean into that. If moving in successive meetings makes sense, I'll be comfortable with that." Now, what's interesting about this is that when we talk about all the Wall Street bets on how many rate hikes we're going to get, when you see, for example, Bank of America say 7 rate hikes, what that doesn't tell you is what might be the progression of those rate hikes and how large might those rate hikes be. Because when we talk about 1 or 2 or 3 rate hikes, oftentimes people are referring to each of those rate hikes being the equivalent of about 25 basis points in hikes to short-term interest rates. The reason why we talk about 25 basis points is because we haven't seen a 50 basis point increase in one move since 2000. It's been over 20 years since we've seen something like that. Should the Fed be expected to do something like that in March, it would not only be a precedent that we haven't seen in 2 decades, but it will also be interesting to see if it could do the job of quelling inflation. Keep in mind, Fed funds futures markets right now pricing in about a 15% chance of a 50 basis point hike in that next meeting. So it's definitely a non-zero chance. But of course, we'll have the Atlanta Fed President Raphael Bostic to perhaps elaborate on those remarks later on. That'll be coming on Yahoo Finance around 1:30 Eastern time, which you'll be able to tune in right here, guys.
Brian, you think as more of these Fed members hit the media circuit in the coming days, do you think we'll see more float the potential for a 50 basis point rate hike in March?
Well, I think that markets are already pricing that in, as I showed kind of with the Fed funds futures already pricing in that 15% chance. But we have to just kind of embrace ourselves for the volatility through that commentary, because again, that Financial Times kind of report that we had over the weekend, and we'll get more elaboration on that later on, was just embracing the possibility of a 50 basis point hike, which we already knew because the Fed chairman was asked about this in his press conference last week. Is it going to be on the table for the Fed to do increments in more than 25 basis points at a singular moment in time? And the Fed chairman kind of dodged the question, but he didn't say no. And that's important because if the Fed is actively not saying that something's off the table, that means it probably is on the table. So this, however, is a bit of a communications challenge. How do you say that something's possible without saying that's exactly what you're going to do? That's something that obviously markets might be sensitive to following the Atlanta Fed president's commentary and perhaps the commentary of other Fed officials in the weeks to come as well.
And the other thing that we have to talk about as the backdrop for this week is sort of global coordinated, or not coordinated, but global tightening, right? Because we've got the Bank of England and the ECB both meeting this week, and there's talk about Bank of England also doing back-to-back tightening.
Yeah, well, the Bank of England is expected to raise interest rates to a target of, I believe it's 0.5% on their short-term interest rate. And they're also expected to move on quantitative tightening. This is the process of allowing any assets that they've purchased through the course of the pandemic to fall off of its balance sheet. That means that the Bank of England is a few steps ahead of the Federal Reserve, because keep in mind, the Fed is still, as of right now, adding assets to its balance sheet, but the Fed has signaled that it's likely later in the year, after it eventually raises interest rates, to start to allow its balance sheet to shrink. So the Bank of England a little bit ahead of the curve on that front, but the bank or the European Central Bank is actually on a completely different side of the equation here. What's interesting is that the markets are not really pricing in any sort of quantitative tightening or interest rate hikes until 2023. And a big reason for that is because inflation and wage pressures just simply haven't been as elevated in the Eurozone as they are here in the United States. Take, for example, the data out of Germany just this morning, where inflation clocked in, I believe it was at 4.9% year over year in January. That's actually a step down from December. So inflation is starting to come down a little bit, although above target still. That's a big reason why the ECB might want to wait a little bit longer. But of course, we'll see if the Federal Reserve's hawkish pivot maybe convinces the ECB to do something the same very soon.
We will keep an eye on it for sure, and we will as well keep an eye on that interview that you're doing with Raphael Bostic. As you mentioned, that's this afternoon at 1:30, the president of the Atlanta Fed. Going to be a lot of interest in those comments, especially given what he said to the FT. So we'll get some more color on all of that coming up this afternoon. But coming up next, final trading day of January, as we've been talking about, what does this terrible performance mean for what happens next? We're going to talk about it with Interactive Brokers chief strategist Steve Sosnick. That is next.
January hasn't been too kind to the bulls as traders hit reset on hot areas of the markets with interest rate increases around the bend. So will February be any better? Steve Sosnick is the chief strategist at Interactive Brokers and is here with us now. Steve, always nice to see you. As someone who religiously follows all the moves in options, probably futures, stock markets, is there any sense that we may see investors step up here in the first part of February and go shopping for stocks that have been sold off aggressively?
Oh, good morning, Brian. Yeah, of course. I mean, buy the dip has been a strategy that's worked. First of all, it's probably been a strategy that's worked, since there have been markets. But a lot of investors have been trained to realize that buy the dip works. Now, to be glass half empty about it, the environment is changing, and I think investors and traders need to recognize that. But the impulse to look for stuff that's beaten down, anytime you get a move like this, where a lot of stuff is beaten down, there will be bargains to be had, and it's human nature to expect people to be looking for them. The question is, are you doing it reflexively or are you doing it intellectually?
Well, the question also, Steve, I would argue is buy the dip, to your point, has worked very well for investors. But ahead of what looks to be a series of rate hikes, do you think the Fed ultimately crushes out that mantra, that buy the dip mentality that has worked so well?
Yeah, and I think that's exactly it. I think it's, think of all the investors who've joined the market, let's say over the past 2 years since March 2020. They've known an environment of perpetual monetary stimulus, of recurring bouts of fiscal stimulus, of various payment moratoria. That's really unnatural. And now you've got the Fed shifting gears. One of the things I've been trying to do in my work is there's two parts to the phrase. It's buy the dips and sell the rips. We've kind of forgotten the second part of that. And I think that this is an environment where you're going to get the opportunity to do both. Whereas over the last, call it since March 2020, I'm just going to use 2 years as a shorthand. Over the last 2 years, selling the rips wasn't really a great strategy unless you were just trying to lock in a gain, because most things continue to move higher. We're really seeing an erosion in that. And you alluded to that in your prior segment, with a lot of the real winners that had been working for people just not working anymore.
So there's something else I want to bring into this, which Sazi kind of mentioned as well, and that's options activity. And I know you told us on your platform, Interactive Brokers, you've seen a 60% increase in options volume in the 25 most active names. Now, when we see the kind of activity we've seen in the market, in other words, what am I trying to ask here? If people are playing all of this through options, does that mean their downside in these recent sell-offs has been limited? And does that mean you don't get the typical capitulation or exhaustion or end of a downturn that you would typically get? Is there any kind of that interplay?
The difference is, if you're speculating with options, it's more death by a thousand cuts, because, assuming you're speculating by buying put and call options, your downside, an advantage to it is your downside is predetermined. It's whatever the premium you've paid. So, that actually, in many ways, until you run out of ammunition for doing that, you're going to keep doing it. The pickup in volume that we saw over the last week, I guess, makes sense because the volatility was enormous. Think about the intraday swings that we had, just think about over the since Martin Luther King Day, we've had some staggering moves. And so, in many ways, the best way to play that is indeed via options. And also, I do think you started to see people clamoring for protection, which is what you saw in the sharp rise in VIX. The interesting thing to me is, I haven't redone the work this morning, but as of last week, as of last Friday, prior to when we started to rally, throughout all of last week, people were pricing in upside. The highest probability outcome on S&P options, we have a function called Probability Lab that sort of displays this as a histogram. The peak probability was up 1% to 3%, depending on where you were, depending on which month or expiration you were looking at. So there is still a lot of residual bullishness out there. That's not necessarily wrong, But it's going to be a process as people readjust their thinking about markets.
My fellow Soz, starting the week correctly for us, Steve Sosnick, Chief Market Strategist over at Interactive Brokers. Always good to see you. We'll talk to you soon. All right, straight ahead, we have a big tech deal we'll dive into, and Tesla getting an upgrade after a muted reaction to its earnings report last week. Stick around.
Well, setting up for the open on this Monday morning, which also happens to be the last day of the month. And there's a saying in the markets, as goes January, so goes the rest of the year. And January hasn't gone well, as we've talked about. The Dow is off by about 4% this month, the S&P off 7%, the Nasdaq off 12% this month, and it looks like it is going to be the worst performance for the Nasdaq in a January ever. 9.9% was the other worst January for it. That was back in 2009. So not great, I think, is the way to paraphrase it. As we talked about earlier, we've got Goldman Sachs saying things could get worse before they get better. We got Mike Wilson saying the current fair value for the S&P 500 is 4,000, which would obviously leave more downside. All of that said, it is a mixed picture this morning. Nasdaq futures are actually in the green at the moment, but Saz, as you said earlier, in these markets, just because futures are pointing one way doesn't tell you much about how a session is going to go. So let's take the opening bell here this morning. Let's see how things go. We've got Shell ringing the opening bell this morning, getting rid of its dual share structure. So it is marking that change for the company. As we do have stocks open up here this morning, you know, we're coming off of, as you can see, that's Friday's close for the Nasdaq, coming off of a big increase in the Nasdaq on Friday. We did see a little bit of follow through here this morning in the futures. We'll see what happens once it opens up. Yes, it's up just 1/3 of 1%. So we'll see how that ends up going. Let's talk about some big movers here this morning. And we got to start with a big deal. $16.5 billion, including debt, $13 billion, not including debt. That's how much Vista Equity Partners and Elliott Investment Management are paying for Citrix Systems, which is a virtualization software company. And the shares are down 3.5%. A little bit unusual here, Saz. 104 is the per share price. It's a 30% premium to where the stock closed back in early December before reports of a possible deal started to materialize. So interesting here that we're seeing the stock pull back.
The only thing I care about this in this deal, Julie, is the word software, because this is another thread in this narrative we're building here that perhaps the sell-off in software stocks we have seen year to date, really across the board, perhaps it has been overdone. If you're getting an Elliott and a Vista to step in here, pay top dollar, $16.5 billion to buy a software company and get that company's recurring revenues. ServiceNow, big quarter out of them last week, bullish outlook from them. You had Snowflake CEO Frank Slootman come on with us a couple weeks ago, really said, hey, I don't understand this stock sell-off here in software. And I know these guys are talking their books, but still the fundamentals of these businesses appear to be strong. I got a good note out of Dan Ives previewing some of these software notes some of these software earnings out this week, saying that investors may be starting to kick the tires on some of these stocks that have been beaten up.
I mean, it looks like it's going to be a record month for software deal announcements, Saz. So to your point, there's a lot of people seeing value, in the corporate world in their competitors. Of course, Microsoft buying Activision is a big part of that as well. But there was value of software transactions, software M&A in 2021 was $674 billion. That was a record as well. So that also tells you, but that was also even when values were going higher.
Hey, this ain't my first rodeo. I've seen these games before, Julie. That's how it goes. It's all cycles.
True. Definitely all cycles. So we'll see what ends up happening. Let's talk about Tesla, shall we? Because the stock's getting an upgrade this morning. Credit Suisse upgrading the stock to the equivalent of a buy, basically saying that it's because it's gotten punished, as we talked about earlier, it's down 20% this year thus far, that it is looking more attractive now. Dan Levy is the analyst on this over at Credit Suisse, and they've been neutral in the stock since April of 2020, Saz.
Yeah, big Dan Levy just coming out here saying, quote, Tesla checks all the boxes for him. So clearly he's very excited about this Tesla after some weakness on the company's quarter a couple weeks ago. At least to him, where Levy stands, he still sees Tesla remaining in the lead. And I understand this call. It does make sense, but that's where I would take a little issue here with Levy. I mean, I see what Ford is doing. I see what GM is doing. Toyota, the Chinese electric vehicle makers, they are finally putting up credible vehicles, credible news to expand their capacity. A lot of these very large companies that are larger than Tesla, are coming for Tesla's market share position. And really, I think this is the first year we might start to see some of that market share position that Tesla has enjoyed the past few years in EVs really start to take a hit.
Yeah, I guess then the question becomes, is the market for EVs large enough that Tesla, even if it doesn't have as large market share, can still prosper, right? Certainly when the company came out and said it wasn't going to come out with any new models this year, that also challenges some of the assumptions about the company. But should also mention Levy's price target, by the way, which is 1,025. That is where he sees this stock going, which would be a 20% increase from Friday's close, and obviously making up a lot of the lost ground that we have seen for Tesla thus far this year. Finally, on the movers front, I want to talk about Blackberry, which has become sort of a meme stock here. And the company announced it is selling its legacy patent portfolio. Now, its legacy patent portfolio is something of value at Blackberry that it has held on to and continued to make money from. It is selling them for $600 million to a company called Catapult IP Innovations. Back in December, an analyst over at RBC said if it was selling this patent portfolio for less than about $1 billion, that it would have a material impact on the stock. And by my math, $600 million is less than $1 billion. So I guess that explains why Blackberry shares are not doing so hot this morning, Saz.
Yeah, this is disappointing, Julie. Really, I would say for the better part of a year, we have seen Blackberry, I think, they have been very out in front saying they have been shopping this patent portfolio here. And to that analyst's point, I think the street was looking for well over $1 billion for here, whatever is actually in this portfolio. So now this portfolio is no longer inside of Blackberry. What does that leave them? Essentially a business that provides software to cars, and also I also believe cybersecurity here. So it's tough. I mean, BlackBerry's about an $8 stock here. Not a lot of enthusiasm.
Yeah, definitely not. Although we'll see if it starts getting mentioned on Reddit boards and if that gives any fuel
Well,
to
I hope
the
the new
stock,
owner
as we have seen.
I hope they bring back phones, Julie. I hope the new owner takes these patent portfolio and comes out with a true iPhone rival. I, for one, would be open to trying the next level BlackBerry. Count me in.
Do you still miss the keyboard?
Yes, I do. Yes, I do. Yeah, it always broke, but still, I didn't care. I was able to close my eyes and just do and send messages. I miss
Like a little,
that.
but
I
you
really
needed
do.
both thumbs. You needed both thumbs. That was one. I don't know.
Love that
Wasn't
thing.
great about it. All right, Jared Blickery, did you have a BlackBerry? Talk to us about what's going on in the markets
he had one.
today.
You know what? Everybody thinks I had a BlackBerry back in the day. Never had a single one, and I don't know what all the hype. I never quite got it. I understand the tactical feedback with the keyboard, but I just never cared about that. I don't send that many text messages, and I don't really use my phone like that. That's how old I am. Anyway, let's go to the Wi-Fi Interactive. I've been charting what has happened so far this month, and let me just show you where we are. It's going to be a two-day view of the S&P 500. Just want to show that nice melt-up that we had into the close, and we are maintaining those gains in the market, just barely in the S&P 500, but here's a year-to-date chart, and I'm going to put on some candlesticks, and here we are. Let me also put the 200-day moving average, because that's exactly where we are right now, kind of a critical moment for the S&P 500. I do think we have the juice to get up to at least 4520, maybe even 4600, but this is an area that we're going to see targeted by short sellers. Doesn't mean that the market has to turn around there, but that's going to be another important area to look at. Today, we have some tailwinds benefiting from end-of-month pension fund rebalancing. I think that's what was going on late on Friday afternoon. Probably going to see a little bit more of that today. So here is the VIX. Just want to show you that the VIX over a longer time frame has been trending up here, just kind of putting in a little bottom. So I think this is going to be a year of volatility. And I also just want to show the sector action. We see consumer discretionary and tech as the two outperformers today, but check out the year to date. Only energy in the green, and boy, is that in the green, up almost 18%. So as we set to close the worst January in the Nasdaq ever, that value trade, at least in energy, looking pretty good, guys.
Yeah, we'll see what ends up happening over the course of February and the rest of the year. Thanks so much, Jared. Appreciate it. Well, coming up next, the latest in the Spotify back and forth controversy. We heard both from the company and from Joe Rogan, who is the host who has been under fire. The shares up almost 6% today. We'll be right back.
In response to mounting criticism from artists like Neil Young and even Prince Harry and Meghan Markle, Spotify said it's adding a content advisory to any podcast that includes discussion about COVID-19. Spotify podcaster Joe Rogan, in a new 10-minute Instagram post, defended his decision to book controversial guests, apologized to Spotify for the backlash, and detailed how the podcast may change going forward. Take a listen.
Neil Young has removed his music from the platform of Spotify, and Joni Mitchell and apparently some other people want to as well. I'm very sorry that they feel that way. I most certainly don't want that. I'm a Neil Young fan. I've always been a Neil Young fan. I'll tell you a story at the end of this about that. One of the things that Spotify wants to do that I agree with is that at the beginning of these controversial podcasts, like specifically ones about COVID, is to put a disclaimer.
Julie, so we're seeing Spotify shares rally back a bit on news of this, but is this really an apology by Rogan?
It doesn't feel like entirely. I mean, he sort of said, I'm sorry this is happening to Spotify also, which I thought was quite interesting, that they've had to deal with this. The other thing that Spotify itself did was make public its misinformation policy, something that other sort of social media companies have done long ago, or at least released details of those policies. Now, when you look at the stock action today, Saz, it seems to me it has a lot more to do with the fact that Spotify has fallen 48% over the past year going into today than it does with anything necessarily to do with Joe Rogan. We don't even know. What we do know is that Spotify pays Joe Rogan a deal whose total value is $100 million. What he is worth to the platform, we don't really have any idea, do we?
No, it's not something that
in dollars and cents. Like, we don't know how many people sign up for Spotify because of Joe Rogan.
They have not disclosed that, but as an investor, I think this is, if you're an investor in Spotify, this is something you should want to know about, especially with all these headlines and Spotify being in the news. And a good note, just quickly, by Stephen Cahill over at Wells Fargo, saying that Rogan sounds like he's searching for a heart of gold, but he's getting old. So I think Cahill, who covers media and covers Spotify for Wells Fargo, being critical of Rogan here. But the real question too, Julie, is when Spotify reports earnings soon, have they lost subscribers? And if they did lose subscribers quarter over quarter, what part of that was caused by any controversy related to Rogan? And then going further, is that something they now have to bake into their guidance? I suspect all these questions will still last after the earnings call, but nonetheless, these are the things I think investors want to start hearing about from this company.
Yeah, I mean, I think, again, if you look at the reaction and performance of the stock of the last year, they've got bigger issues here than Joe Rogan in terms of their ability to hold on to and monetize subscribers, in terms of their cost outlays as well on things like podcasts. So I'm really curious to see what these numbers are going to look like when they come in. One other note I would make on a separate front, not having to do with Spotify directly, these various artists who are pulling off of Spotify and then signing deals elsewhere. It is fairly astonishing to me that the likes of Neil Young is signing a deal with Amazon, for example. That, in other words, Amazon frequently gets criticized on a number of different fronts, right? Here's Neil Young partnering with them. SiriusXM, which has channels that carry lots of talk shows that probably he would find as questionable as Joe Rogan, he is also still partnering with them. So, it's just very interesting when you see these artists take moral stands, which is certainly in their right to do. But I don't know where the last refuge is in corporate America for a musician who wants a place where they're going to be completely morally clean, so to speak. I don't know how else to put it. I don't know what the answer is to that puzzle.
Perfectly worded, Julian. I'll just quickly add too. I know Prince Harry spoke out again here. It would just be nice if he actually created some content for Spotify after inking a $30 million deal. But let's switch gears here to the Yahoo Finance stat of the day. Want a flavor for how pressured the markets have been this year? Check out these stats from Charles Schwab's Liz Ann Saunders, a friend of the Yahoo Finance Morning Show. About 46% of the Nasdaq members are down at least 50% from their 52-week high. Zooming out doesn't paint a better picture here. Roughly 76% of the Nasdaq's members are down at least 20% from their 52-week highs. All right, Apple shares are still on the move higher as the street embraces the company's latest earnings report from last week. We're back with one analyst who sees more gains ahead for the tech giant. Stay tuned.
We saw Apple shares rally on Friday. They continued that move upward in today's session on basically relief after the company's earnings report. Let's bring in Wamsi Mohan, he's senior IT hardware analyst at Bank of America. Thanks for being here. So what's interesting to me is that for a long time, there was this narrative around Apple that they had to come out with something new. And yet, I think quarter after quarter, they show such strength and growth in their core products that continue to do well and services that it's not necessarily as necessary. What are we going to see from Apple next? Is it going to be more of that narrative, or is there going to be something new and exciting?
Hey, Julie, good morning. Thanks for having me. I think that there's a lot to parse in what you just said, right? I mean, people are looking at Apple through a lens of there isn't a lot of innovation. It's the same old products that are continuing to drive year-over-year revenue growth in categories that feel saturated. But I would take some exception to that and say, really, they have been innovating, and that innovation has been coming really at the crux and the gut of their devices, right? When you look at what all Apple has been able to do from a semiconductor perspective, the M1 chips that they have introduced, the Apple A12, 13, 14 chips that they have introduced, which are just enormous pieces of silicon technology that are enabling Apple to really leapfrog the competition in this vertical integration process where they're able to generate amazing photography out of it, amazing videography out of it, and just some of these capabilities that are so important to the user. That is where Apple is really innovating. So I think that the upgrade cycles of each of these products is coming through the guts of these products, the innovation, both at the software and hardware level, the AI that's being infused in there. There's a lot that's going on in the existing product line. Your question regarding what should we expect next is more of the same. We really should expect in very sophisticated devices that play at the heart of hardware, software, and services integration for that matter. And we've seen some of that in many products that they have launched, like wearables, for example. And I think you're going to see more and more of that. You're going to see augmented reality in particular, where Apple has had a huge focus on. I think that's going to be a very big market for Apple down the road. We view augmented reality glasses as, frankly, a driver even for an upgrade cycle on the phone. So when I put a lens of sort of what are the future products that are going to matter in the near term, I think augmented reality more so than virtual reality. And down the road, if there is a car or not and autonomous in their efforts down there, I think it's too early to say. But I think augmented reality is going to be the next most exciting thing that the company is going to launch. And that's probably within the next 2 years that we're going to see a lot more about it. We've followed patents, and there's been just a whole host of those that Apple has filed, which have to do very specifically with this technology.
Now, it all sounds very exciting, Wamsi, but do you think augmented reality glasses are a mass market product? With the iPhone, we all need to stay connected. Do we need glasses like this?
Yeah, no, it's a great question, Brian. And look, I mean, I think that new products like this take time from an adoption standpoint. Apple typically, does not bring products to market before they're really user friendly. And the UI, the interface, the seamlessness, the connectivity with your other products, the information overlay, all these are very, very important. So when you think about something like AR glasses, the transparency of the glasses, how well can you see the outside world at the same time, be able to focus on certain electronics, how responsive is this product? All these are going to be crucial for the success of the product. Now, Apple has had products like the watch, for instance. It was originally tethered to the phone. The AirPods, which were deemed very funny looking device that people sort of made fun of, and it took time, but just the user interface of them just made them extremely popular and successful. There are a billion iPhones out there. There's going to be a billion glasses? No, of course not, but not in the near term. But I think that these things start small in scale. And then depending on the utility that they bring and the success that they bring with it, that option rates start to increase. And Apple has historically had, on this wearables category in particular, a focus where they want to let pricing not be a hindrance to adoption. And that really helps. When you price a product in that sort of between, call it $300 to $500 range, and it starts to generate enough appeal, and then you go generation by generation where you're lowering the price of the older generation and maintaining the price of the new generation with new feature functionality. That's been a time tried and tested sort of strategy at Apple, and they've done phenomenally well with that. So is it going to be mass market? Not immediately, but I think that it has a lot of relevance and a lot of utility. Think about, people walking on the streets in New York, holding a phone up, trying to get directions to get to the coffee shop or their next meeting or whatever it be. And I think that it's actually unsafe. We've all watched people sort of step into traffic, unfortunately, and it's scary to do that. Augmented reality glasses would be a way in which it would prevent that, right? You could get an overlay of directions, and it would work well with your AirPods that's telling you the directions, but you could watch that on your glasses. So there's a lot of utility factor. And by the way, augmented reality is not a new thing for Apple. They've introduced this at their Worldwide Developer Conference a long time ago as ARKit, and the sophistication of those apps is only increasing over time. They just have not had the perfect physical device to go along with it, which I think is on the way.
I'm picturing people walking around New York City with glasses and AirPods on, and it's a funny picture. Maybe not an unrealistic one, but it is a funny one. Wamsi, finally, I just wanted to ask you about the general movement that we've seen in technology going into those Apple earnings on Friday. It's been lower, obviously. And so I wonder, in your mind, and in your coverage universe, how much the fundamentals of even a giant like Apple are going to be outweighed by the outlook for rising rates and concerns over compressed multiples?
No, it's a great question. And I think that tech investors are really struggling to find names that are likely to play out in this rising rate environment, right? And tech historically has been an area of growth. Now, within my coverage universe, I would say, we really like Apple, obviously, but we also like other companies like IBM, like Seagate Technologies, like Dell. And all these companies have really very good cash flows. That safety in cash flows is very important at a time like this. When you look at the volatility that comes from companies that are not generating any cash, and all that future earnings potential is dependent on growth that is coming down the road in 5 years, 10 years. These are companies that are not throwing off any cash flow. And frankly, when rates go up, the valuation multiples really don't have a very good floor that you can stand by and say, well, this is the absolute lowest level the stock's going to go to. Whereas with companies that I just mentioned, like IBM and Seagate, IBM is going to be throwing off between $10 and $11 billion of free cash flow annually in the near term. And then looking out 2 years, it could be north of $12 billion easily. That gives it some real stability in terms of valuation floor. The same thing for Seagate Technologies. We think that that's really interesting because the market has really evolved from being one that of PC drives, that is what it was exposed to a decade ago, to now cloud data centers. And that is a really fast growing market. The margin structures are improving, the profitability and the cash flow is structurally improving. And and Seagate trades in the teens from a multiple PE perspective relative to the market trading closer to 20 times. So you just have a very different set of stocks that investors are going to start to focus on, which have cheap valuation relative to the market. But at the same time, there is a confidence that valuation, maybe the cash flows have a 10% plus minus uncertainty. They're definitely not the 50, 60, 70% that you're seeing in many of the high flying stocks that are subject to this real multiple compression in a rising rate environment.
Indeed. All right, Wamsi, thanks for being here. Good to see you. Wamsi Mohan is Senior IT Hardware Analyst at Bank of America. We're going to take a quick break. When we come back, quick check on markets for you. Stay with us. Let's get a quick check on markets here because we are seeing really outperformance of the Nasdaq continuing today, quite notable. It's up by 1.4% as we see a big comeback there. Doesn't necessarily look like it's going to be enough of a comeback necessarily to salvage January for the Nasdaq and keep it from being its worst January ever. But we'll see. If we see a real big extension of gains by day's end, that could potentially happen. The S&P and the Dow also trading higher, but the Dow just barely at this point in time. Coming up next, we are going to talk to the man behind a call for 7 rate hikes this year. Ethan Harris of Bank of America will be with us next.
Welcome back to Yahoo Finance Live on this Monday morning. I'm Brian Sozzi alongside Julie Hyman. As always, the markets are a little tame this morning, rather different from the wild gyrations traders witnessed last week, seeing all 3 major indices nicely in the green to kick off this week's of trading. Now, here are a few other things we're watching for you right now. Monday is for deals. Software player Citrix said it would be acquired for $16.5 billion by Vista Equity Partners and Elliott Management. Keep a look on those beat up software stocks off a mega deal like this. The whales are out there hunting for value. And weighing in on the Supreme Court, New York Congresswoman Alexandria Ocasio-Cortez talked with Yahoo Finance editor-in-chief Andy Sower about potential changes to the Supreme Court. Andy will join us for a chat on his discussion with AOC. And putting it down on paper, the world's largest learning company, Pearson, just made a $200 million acquisition. We'll talk all about it with Pearson CEO, Andy Bird. Now over to Yahoo Finance and Nez Ferre for a Wi-Fi interactive rundown. Nez.
Brian, let's take a look at the oil market because we have seen a strong January for WTI and for Brent crude. Let's take a look at WTI. It's up about 0.3%. Brent crude up almost 1%. But I do want to note year to date, Brent up more than 15%. In fact, its biggest monthly rise since February of 2021. Year to date, WTI is up 14%. Let's take a look at the Nasdaq because the Nasdaq right now at session highs up about 1%. 1.5%. The Nasdaq 100, we're seeing quite a bit of green on the left side of the screen. You're looking at Tesla up more than 5% after that upgrade from Credit Suisse to outperform from neutral, with the analysts saying Tesla checks all the boxes. Also looking at Netflix up 7% after Netflix was upgraded at Citi. I want to mention the electric vehicle space because I did mention Tesla, but that Tesla bump is also giving a bump to all the other electric vehicle stocks as well. If you take a look at a year-to-date chart, though, for the month of January, quite a bit of red when we're looking at the electric vehicle makers, especially Rivian, Xpeng, QuantumScape, the battery maker, ChargePoint down 30% for the month of January. I want to look at the travel stocks where they're at today. We are seeing a little bit of a mixed picture with travel. Year to date, we're seeing some of the travel names that have been underwater. And then looking at the meme stocks, we've been talking a lot about these throughout the last few weeks. This is a year-to-date chart of these stocks. I do want to point out Robinhood because even though it may not be a meme stock, it is a sort of a proxy for retail trading. Robinhood up 6%. I want to mention that Cathie Wood's ARK Investments stepped in and bought more Robinhood shares on Friday, more than 2 million of those shares when Robinhood shares were trading at one point below $10 a share. The stock is down more than 60% from its IPO price back in July. Year to date, it's right now down 23%. Brian, Julie?
Thanks so much, Inez. All right, the market is still trying to get a handle on how many interest rate hikes we may get from the Federal Reserve this year. Our next guest, though, thinks we will get 7 rate hikes this year. Joining us now is Bank of America Head of Global Economics, Ethan Harris. Ethan, good to speak with you here. Wow, this note from you and your team certainly getting a lot of attention out there in the street. What is the biggest factor behind you and your team moving to 7 rate hikes for this year?
Well, I think it's important to understand that the Fed is a bit behind the curve here. Normally at this stage of the cycle, the Fed would have already hiked 100 or 150 basis points, and they would still be hiking as I speak. And what's happened, I think, at the Fed is last fall, they decided, okay, we're going to wait until we're absolutely certain that this is a serious inflation acceleration, absolutely certain that the labor market's going to remain strong. Now they've shifted gears. And so what we're calling for is not at all radical. We're saying they're going to hike 25 basis points at the next 7 meetings. And by the end of the year, get close to 2% on the funds rate. It sounds very radical because investors have gotten used to a Fed that's always very friendly. But when you have inflation, the Fed's got to shift gears, and they're beginning to do that.
Ethan, it's Julie here. I guess what I'm not quite understanding in this call is you're also cutting your GDP growth forecast to 3.6%. And so you have the Fed consistently raising rates as the economy, it's not slowing, but the rate of growth is slowing. And won't that also, slowing growth, sort of take care of some of the inflation on its own? So put all this together for me.
Yeah, so slower growth on its own doesn't contain inflation, because the growth we're talking about, 3.6% this year, will mean continued tightening of conditions in the economy. This imbalance we have right now with limited supply and strong demand is partly a supply story, but it's also a demand story. Demand is extremely strong, and we're likely to see a continued drop in the unemployment rate and other measures of spare capacity. We think the unemployment rate will hit 3% by the end of the year. So even with the slower growth, the Fed has to think about where we are a year from now. And a year from now, we're going to be in an environment where inflation's still a problem, that it hasn't completely gone away. And it's simply not appropriate to have near zero interest rates when you have inflation of 2.5% or 3% or wherever we're going to end up a year or two from now.
Ethan, what do you think, if we do in fact get these 7 rate hikes this year, what do you think that does to consumer spending and household wealth?
Well, it's a dent in the economy, right? And again, you can't fight inflation without any pain at all. I mean, it doesn't make any sense. I mean, if you don't impose any restraint on the economy, why would inflation come down at all? So the Fed has to impose some constraint on the economy, but it's against a backdrop of an economy with tremendous momentum. The household sector has easily record net worth as a share of income. If you add up their homes, their stock portfolio, their massive liquid savings in banks, households have $4 trillion in above normal bank deposits and money market funds right now. All that money they couldn't spend in the last 2 years is just piling up in their bank accounts. And so the fundamental backdrop for the consumer is extremely strong. And while I do think that the stock market's going to be constrained by this Fed policy, we've already seen a correction in the equity market. The outlook for the consumer is still pretty good. We don't really think the Fed starts to have an impact on the economy until the end of this year and into next year, after cumulative hikes start to put some real restraint on activity.
Ethan, this all raises a question that I've had pretty consistently during this inflation cycle, which is how much of what is going on is because of low rates and how much of it is because of constrained supply in various ways. So if there has been this outlook that the supply side of it is going to work itself out eventually, how eventually is up for debate. But what happens when that supply situation is taken care of and the Fed is raising rates?
Yeah, I grew up in a big family, and my mom used to say it takes two to tango. It's both sides of the equation are at fault here. And I got a lot of fights with my brothers, to be honest. Anyway, so the story right now, it's a mixture of things. There's certainly the COVID shock has constrained supply. I mean, it really has caused a big pullback in the labor market, and that's creating some of this inflation pressure. But we can't completely ignore the demand side. You have the most aggressive fiscal policy in history that has left households flush with wealth and liquidity. Now, of course, the fiscal policy is starting to go away, but the liquidity and wealth is still there. And you have a central bank with a zero funds rate. So the Fed's job can't control the supply side of the economy, but they can put a little bit of constraint into demand, and that's what they need to start doing. So I don't view hiking interest rates, 175 basis points, 1.75% over the course of this year as being a body blow to the economy. I view it as a leaning against the inflation pressure. And inflation is going to come down partly on its own as imbalances in the economy ease. But the Fed has a role in that too. They can't step back and say, it's not our fault, we have nothing to do with this. They have to do their share, which is put a little bit of restraint on the economy and recognize that some of this inflation is permanent, not just a temporary supply shock.
Ethan, real quickly before we let you go, if we're sitting here at this point next year and we get those 7 rate hikes, do you think the stock market will have been positive for this year?
I think it's kind of a flattish market, to be honest. I'll fudge a little on that. I'm not sure. I mean, I think that for now, we've had the near-term correction as the markets had to deal with the fact that the Fed isn't going to be completely friendly going forward. I mean, last fall, the Fed said, don't worry about inflation and don't worry about us. And they really helped drive the stock market. Now they're taking back that promise. But I think the market will do okay. I don't think it'll be a great year, be more of a flattish year.
Duly noted. All right, we'll leave it there. Ethan Harris, Bank of America, head of global economics. We'll talk to you soon. All right, and before we head to break, we're keeping a close eye on one trending ticker on the Yahoo Finance platform, and that is metaverse company, I guess, Roblox. The shares absolutely rip higher, over 11%. I should note the company shares are still down about close to 40% on the year, certainly swept up into this tech stock rout. The company reports earnings on February 15th. Perhaps you're seeing investors there position in Roblox ahead of Facebook's or Meta's earnings in a couple of days, where I'm sure Facebook founder Mark Zuckerberg will talk all about the metaverse. All right, coming up, AOC weighs in on potential changes to the Supreme Court in a new chat with Yahoo Finance Editor-in-Chief Andy Storer. Andy will join us next.
Alexandria Ocasio-Cortez, just say her name? It's a lightning rod for a lot of folks, particularly folks on Wall Street, by the way. Our editor-in-chief, Andy Serwer, had the chance to talk to her for the latest episode of Influencers. I'm sure it was an interesting conversation, Andy.
It was wide-ranging, and we'll get to some of it later this week. But one thing that I wanted to ask her about right away, Julie, was the fact that President Biden has pledged to nominate a Black woman to be the next Supreme Court justice to fill Justice Breyer's spot. Of course, she would have to be confirmed. But I wanted to get AOC's take on that. Here's what she had to say.
Identity is just the starting step when we are discussing a Supreme Court justice. There is no shortage of incredible, qualified, leading Black female candidates to serve on the Supreme Court. But the question is, what is going to be that nominee's worldview? And what I hope is that what we see is a nominee that is truly rooted in not just public service, but with a protection towards the very rights that frankly have been eroded over the last not just 2, 3, 5 years, but the last 10 years. What their stance on something like Citizens United would be, what their stance would be on expanding the right to vote. I mean, these are central questions about our democracy, both in the financial capture of our democracy, but also the racial injustice capture of an erosion of our democracy as well.
Well, usually always know where AOC stands on things, and it is going to be a battle in Congress. So we'll be watching that closely, Julie.
Yeah, we definitely will. I mean, it's interesting that she framed it that way, that that's just one piece of it. And I also wonder about the speed that this is going to get done, because there's now a sort of a debate about, that President Biden shouldn't be hasty to nominate someone, but there's also pressure to sort of to get it done, right?
Get it done before the midterms, of course, is
right.
The proximate cause to do that, of course, because the Democrats are anticipating losing the Senate. And I think still the Republicans are going to make it tough, even if the president tries to do it before then.
Well, Andy, talk about a really well-timed newsletter. Hard right turn here, I should note, over the weekend from you, looking at the ownership structure inside the NFL, the wealth amongst the owners. You look like you were watching those football games yesterday.
I was. Well, first of all, Brian, the NFL is back. And of course, back from COVID, back from the kneeling controversy, I guess you could say, although those issues are still there. But the games have been outstanding. And of course, we had some great games the prior weekend, and people were wondering if they could match that this weekend, and they did. And no one's happier about that than the 32 NFL owners, which are, if you think about it, really this kind of fascinating parallel universe of private wealth in this country. And we think usually about wealthy people, Jeff Bezos, Elon Musk, Mark Zuckerberg. But these guys are up there too, and they really have a very powerful position in our society.
And Andy, and then we're still trying to figure out if NFL great Tom Brady will be retiring. There was that ESPN report saying that he is retiring, but then he reportedly called the Bucs saying no decision is there yet. But look, Tom Brady, he has more on the gas. This decision is ultimately his, though.
I'm going to predict that at some point, Brian, Tom Brady will retire. How's that for?
That's a good prediction. Yeah. Well done.
Going way out on a limb. It's pretty amazing. I mean, he is the GOAT. So, but we have some new, GOATs here as well. I know Patrick Mahomes is out, but he's incredible. Joe Burrow is this wunderkind who is really amazing and brought the Bengals back from, just years of futility, which is pretty incredible. And it's nice to see, Stafford sort of get his shot. Even the people in Detroit, I hear, are rooting for him. So the drama and the narrative is there, and these owners benefit. The teams have never been more valuable, and I think they've really done an incredible job of stealing away the mantle of America's pastime from baseball, and they really did that by revenue sharing, which allows smaller market teams to succeed. something that baseball has not been able to figure out.
Interesting. The business of sports here, the behind the scenes is always fascinating. Thanks so much, Andy. Appreciate it. Our editor-in-chief, Andy Serwer. Coming up after the break, an offer he could refuse. Elon Musk made an offer to a teen to take down his Twitter account, and the teen said no. We'll tell you why next. Kia is recalling over 410,000 cars in the US to fix an issue with its airbags. The recall covers certain 2017 through 2019 Sedonas and Souls and 2017 to 2018 Forte vehicles. The Korean automaker says the airbags have a problem that can stop them from inflating during a crash. Owners are going to be notified by mail starting in late March. The 19-year-old creator of the Twitter account that tracks Elon Musk's jet, Jack Sweeney, he rejected a $5,000 offer from Musk to delete his account. Back in November, Musk asked Sweeney to delete the account because he said it's a security risk. Sweeney rejected the offer, though, and asked for $50,000 instead, or an internship opportunity. Musk said he'll think about it, but he never got back to him. In a recent interview with Business Insider, Sweeney went public with that $50,000 request. Again, though, Musk has not responded. Spanish tennis star Rafael Nadal has won the Australian Open. After a 5-set match, Nadal defeated Daniil Medvedev and became the first man to win 21 Grand Slams. The triumph represents a huge comeback for Nadal after spending the past 6 months battling injury and illness. His victory leaves both Novak Djokovic and Roger Federer still tied at 20 Grand Slams each. Well, coming up next, we're going to be talking about the business of education with the head of Pearson, which just announced it's buying certification group Credly in a deal valued at $200 million. That's right on the other side of the break.
World's largest learning company, Pearson, said today it will spend $200 million to acquire Credly as it works to boost its presence in the workforce skills sector. Let's talk more about the deal with Pearson CEO Andy Bird. Andy, good to see you this morning. Congrats on this transaction. Take us through the deal a little bit. Is part of the reason why you pulled the trigger because of this labor shortage that has been caused because of the pandemic?
Good morning. It's great to be on the show with both of you. We've known Credly for a long time. In fact, we had a 20% stake in the company. So the deal today is really about us paying $140 million for the remaining 80% of the company. And during the time that we've been on the board and been involved with Credly, we've been so impressed by the quality of the management, the leadership team, and the growth, as you say, in the need for accreditation amongst individuals beyond formal education, particularly when we look into what's happening, as you say, in the labor market and the need for employers to offer learning opportunities to their employees at a scale that we've never seen before.
Andy, it's Julie here. So I'm curious, more writ large, how much of your business going forward do you think is going to be sort of reskilling and professional education, and how much is going to be traditional education, college education, lower education, et cetera?
Well, I really believe in a lifetime of learning, and I think the pandemic has acted as an accelerator in that regard. And what we see is, firstly, a huge opportunity. It's the biggest addressable market for learning in terms of learning in the workforce. And we're really building Pearson around a number of divisions to really focus on key aspects of learning at key moments in an individual's life, and then bringing all of those together. You know, one of the interesting things with the announcement today of the acquisition of Credly is how it aligns with an acquisition we made at year end of a company called Fathom, which is an AI-driven data analytics company that focuses on employees and employers and really gets employers to understand the needs, the learning needs of individual employees. When you take that and you put in Pearson's core competencies around designing and delivering courseware, and now you add Credly, the accreditation piece. You know, Credly have issued over 50 million accreditations to over 25 million learners around the world. It starts to bring a unique end-to-end solution to employers and employees.
Andy, the pandemic has really, I think, forced a lot of folks to enter the job market very quickly, perhaps skipping college or just forcing them even early, perhaps foregoing a master's degree. What do you think the longer term impacts from the pandemic will be on your education business?
Well, I think greater fluidity. I think there is a point about maybe redefining what higher education means to certain individuals. Certainly, individuals now are used to more bite-sized education, learning on their own time. And higher education, formal education, plays a very, very important part in that. Clearly, it's been disrupted during the pandemic, but those fundamentals that exist within the college and university system are invaluable to an individual's learning journey. But what we're seeing now is that being supplemented by opportunities to continue your learning journey as you gain employment.
Andy, I have what might be a strange question for you. Do you think that, not necessarily because of our education system, but maybe partly so, but also because of the social media ecosystem, that people right now are undereducated, not just about their expertise, but sort of about life and how to approach the world?
Well, indeed, and I think there's a great question there around how you define education. And really, at Pearson, you know, we're building the world's leading digital media learning company, and so we're really focusing on learning, of which education and formal education is a subset. And the way that you receive your learning can take many, many different forms and can take place at many different times in your life. And that's all being driven by technology, by AI. I think the introduction of 5G, virtual reality, the good old metaverse and everything like that are all interesting areas in which an individual is going to be able to learn going forward. And I want to ensure that Pearson is front and center in that development.
Andy, I'm sure you definitely understand the importance of the metaverse. I mean, you were Disney International chairman, coming from that consumer company before you joined Pearson. I mean, do you view yourself as a future player in the metaverse? Are you developing technologies to be part of that?
We're certainly spending time studying it. I think it's very interesting if you look at the opportunity to have immersive learning experiences. I mean, there have been examples already in games such as Fortnite. They've done Ariana Grande concerts and things like that within the Fortnite game, but they've also started to play with learning experiences. You see platforms such as TikTok getting into the learning business and getting into the resume business. And so I think the opportunity that technology now provides an individual to choose not just the form of learning, but where they learn and how they learn, bite-sized learning is now very possible because of the advent of technology. And as we see the strides that 5G will enable in terms of augmented reality, virtual reality, imagine the three of us being able to go off to the Colosseum in Rome and have a lesson being surrounded by our environment in a much more rich and immersive experience.
Hey, sign me up for that, Andy. None of that was in existence when I went to school. I know, as I think I'm still paying stuff for college that I really learned anything about. But we'll leave it there. Pearson CEO Andy Berg, good to see you. Congrats on the deal. We'll talk to you soon. All right, up next is our call of the day. Barclays is getting bullish on Beyond Meat with a double upgrade on the view that its partnerships with restaurants will boost its stock price. More on that after the break.
Buzzy stock Beyond Meat is getting a double upgrade today from Barclays, going to overweight from underweight. The price target going to $80 a share. You see it's trading at $62.58 right now. It's up quite a lot in today's session, more than 10%. Let's talk to the analyst behind that call. That is Benjamin Teurer. He is Barclays head of Latin America equity research and focusing on the international opportunity in part for this company. Ben, thanks for being here. So, why now? Why did you see this as sort of a good time to pivot on Beyond Meat?
Yeah, that's a good question. Thank you very much for having me on the show this morning. So, in summary, I think what happened over the last couple of months, particularly since the company reported results back in late October, early November, and the outlook that was given for the fourth quarter, obviously it was somewhat muted, and we've seen certain data points coming in, just confirming that initial muted view by the company. And we haven't made any changes to our estimates. I mean, we continue to be within the broader range of expectations with around about 100 million in revenues for the quarter. Now, clearly, a few things we're seeing and where we think the stock has a little overreacted, it's really on the downside, just more recently with the recent sell-off. We do think that there's more to the story of Beyond than just the US retail piece, which has been the one that's been struggling. I mean, we've seen a couple of announcements on the food service side. We've seen investments on the international market, and big part of our upgrades really driven on the potential for the company in the US food service recovery, as well as in the international food service and the international retail piece.
When do you think we will start to see an improvement in their restaurant service business?
I mean, with current situation doesn't bode well to see any more an immediate recovery here, and we've pointed it out in the report that we would expect this to help recover sometime in the second quarter of this year. First of all, comp prices are going to help out, and it feels like that right now what we're going through is a relatively fast level of contagion with COVID, and there's some desperate willingness to go back into food service and to go back outside, dine out, go into restaurants, and we would expect this is going to ease as the summer comes, spring into the second quarter.
Do you think investors or even just consumers are too down on the potential of the plant-based meat market? Certainly, we've seen a lot of stories written about the health of what is being produced or lack thereof. How do you think about it?
Well, the health or the lack thereof it's a good point, and it's definitely something that shouldn't be underestimated. Now, what we've been seeing a lot within the category, but also within Beyond in specific, is really trying to work on to get the ingredients cleaner, right? To get a cleaner label, to get away from the amount of processing that's still needed. And we're actually very optimistic that over time this will be achieved. There will be improvements. It's not obviously happening overnight, but in a similar way as we've seen already improvements over the last 2 years, I would envision that within the next year to 2 years, we're going to see a different level of ingredients being available. And with that, obviously, as well, the health profile is likely going to improve and not worsen.
You're based outside of the U.S., and I am curious what indeed the international appetite is. I mean, it used to be you would travel to parts of Europe, for example, you would ask for a vegetarian meal and they would offer you chicken. Now, I assume we've come a long way since then, but I do wonder what the international appetite is for these types of products.
Yeah, it's funny that you mention it. I mean, if I take a look at Latin America, the region I'm also overseeing, and taking a look what's happening in some of the big beef producing countries such as Brazil, Argentina, there's a trend and a willingness to adapt to new products. In particular, it's gotten to the pace that, for example, in countries like Brazil, there's been even more inflation on beef price than what we're seeing in the United States. So obviously the price gap has narrowed even faster. in big beef consuming countries down in South America. So the appetite is increasing, and we're seeing a lot of announcements and products being rolled out in food service and retails by big players, and Beyond is one of them, actually going into the Brazilian market as well, which has a huge potential. If we think of Europe, Europe for Beyond is a great opportunity. It's a big market, hundreds of million, big population. They obviously fulfill the need to be and having a non-GMO product that gives them a foot into the door to basically promote the product over there. They're building their own production capacity, and which should be supportive to some of the supply chain issues they've had more recently. So all in, the appetite is there, and it's not something new. I remember when I'm originally from Germany, but even years back, I mean, there were already vegan/vegetarian options of sausages available, and it'll require different sets of product development and different sets of developing maybe new categories within the market like Europe. It's a very diverse market, but the opportunity is great. And once you have the basics done, I think there's a lot of growth potential.
Where else do you see, in terms of new categories, where else do you think Beyond Meat may play over the next 24 months? So they recently rolled out nuggets at KFC. There's been a report that they're also working on beef jerky. What else do you expect on the innovation front?
I mean, the beef jerky piece is obviously something like the quick snack category. I would envision that a lot could potentially go into what might be needed on different pizza toppings, pepperonis, etc. That could work out. Just giving it a little different touch to it, creating new ingredients that can be applied within food service. So to get away a little bit from what the typical breakfast sausage / burgers used to be, to basically have a broader portfolio that may include some different type of sausages, some different types of hams that could be potentially replaced. Pepperonis is another market. I mean, there's some big potential in just the entire pizza topping category.
I love this deep dive into plant-based meat and Beyond Meat. Thank you so much, Benjamin. Appreciate it. Benjamin Teurer, Barclays head of LATAM Equity Research, on his Beyond Meat call today. Thank you. Coming up next, we'll dive into today's market action once again and focus in on Otis specifically. Following the elevator giant's quarterly results, Brian had the chance to catch up with the company's CEO. We'll be right back. one of the individual movers that we and Brian Sosnick are watching today, Otis Worldwide, the elevator company. You had the chance to talk to the CEO following better than expected earnings for the company. The share's up about 2% today, Soz. What are your takeaways?
Yeah, in terms of takeaways, first let's start with what CEO Judy Marks, who's about to become chairman of Otis as well, what she told me on a couple fronts. First up is commodities. Now, there were some parts of the business for Otis that saw pressured operating margins, most notably their new equipment sales margins there under pressure a little bit. Here's what Marks told us about inflation here. Commodities for us are still going to be a headwind in the first half. So the first half, especially the first quarter, will look a lot like the fourth quarter 2021 in terms of new equipment. So just another leading executive, Julie, warning that inflation is not going to subside anytime soon. It will be with the company throughout 2022. It may subside a little bit in the back half of this year, but still, inflation is not going anywhere anytime soon. Also, too, there was initially, Otis shares were down a little bit in the pre-market, I think, on the company's outlook. Here's what Mark said about that outlook. Quote, while the growth will be more tempered in 2022 based on our guidance and based on what we're seeing happen economically, especially in China, this will be our third year of growth on growth. So in other words, Otis is in fact looking for growth this year, calling for about earnings of $3.20 to $3.30. The street was at $3.27. By and large, a good quarter for here in Otis. Solid outlook. Company generated about $1.6 billion in free cash flow this year, looking for about $1.6 billion in free cash flow this year as well. And for what she's making the case, why that outlook is seemingly okay in her view, is this service. So they're seeing a lot of service calls, and they're able to also increase prices inside their service contracts for elevators, even despite what's happening in inflation. And then she really made the point that Otis is not just tied to elevators inside of offices. Actually, 50% of the business is tied to residential development. Said the company has won a lot of new contracts to build out elevators in hospitals, elevators in other residential buildings here. So by and large, I think you're seeing shares just digest everything the company put forth, and the stock's up about 2% here.
Yeah, really interesting stuff. You don't want to mess around with a broken elevator, so that explains the need for service calls, no matter what. I want to broaden it out a little bit, talking about individual companies. Let's also talk about what's happening writ large today. And if you take a look at the Yahoo Finance Interactive, we are closely watching these January numbers for the Nasdaq Composite, right? It's down 10.3% year to date because of the bounce we're seeing today. To be the worst January ever for the Nasdaq has to be worse than 9.9%, which is what we saw for the January back in 2008. I keep saying 2009, but it's 2008 that saw that 9.9% drop. So 10.3% right now, on track for the worst January ever for the Nasdaq Composite. That's even though things are coming back a little bit today. Here's the intraday look for the Nasdaq 100. We talked about Tesla earlier getting an upgrade over at Credit Suisse. That's helping the stock to the tune of 8.5%, even though, of course, it's down still 13% year to date. But recovering something somewhat in today's session. You see a lot of green on the screen here. Nvidia, which has been really beat up 4%. And Amazon, which reports earnings this week, up 2.5%. Apple, which of course reported late last week, extending those gains with another 1.5% gain. So we're seeing this broad bounce today, not necessarily enough to salvage things overall, but nonetheless a bounce. And let's look at the sectors as well. We are seeing consumer staples down. Consumer discretionary, which as we showed you earlier, is the worst performer in January. It's down 10.8% in January. It's recovering today, up 2.5%. Tech, communication services also helping lead the gains today. We've been talking about meme stocks a little bit today, Saz. Look at these Robinhood shares. This is something I know that you've been watching quite a bit. The declines that we've been seeing. Robinhood's getting a little bounce today. I didn't see any sort of headlines or reason necessarily that it's getting a bounce. Maybe it's Cathie Wood coming in here and buying here. Is that, I don't know what's going on.
Cathie Wood buying, Julie. I think it's that Cathie Wood buying, but let's be clear. I mean, January has been a tough month for Cathie Wood. It was a tough earnings report out of Robinhood. Really didn't give you any indication that they are going to be profitable this year at all.
Yeah, and there's the max chart of Robinhood. So obviously down 60%. So that little bounce that we're seeing today is just that. It's a little bit of a blip today. Elsewhere, though, meme stocks are doing a little bit better. You've got AMC and GME both trading higher. And then finally, also, why don't we take a little bit of a check on what's happening in crypto today? Not much action. Look at that. That's interesting. Just a little bit of a move downward in Bitcoin, a little bit of a move upward in Ethereum, and sort of the other various coins are seeing a mixed picture here today. So it doesn't happen too much that you see not so much movement on that side of things, Saz. So we're setting up here for a big week in terms of the earnings that we're watching for. So that's something we got to keep an eye on the ball when we're talking about what could happen this week in markets. It's going to continue to be an earning, with the exception of today, which is a bit of a quieter day on the earnings front. It's going to be an earnings-driven market.
Well, speaking of earnings, I'm excited. We have an exclusive interview tomorrow morning with UPS CEO Carol Tomé. Really going to dive into the company's quarter outlook, what they might be seeing in terms of COVID-19 vaccination deliveries. It feels like yesterday I was watching that first UPS truck roll out of their distribution center with those vaccines. So lots to get to with UPS CEO Carol Tomé. Again, exclusive interview with us tomorrow morning.
Yes, indeed. I'm very much looking forward to that. Well, Akiko Fujita is going to take you through the next 2 hours of trading. As promised, Saz and I will be back tomorrow morning with that interview and with much more. Keep it right here. Yahoo Finance Live continues in just a couple minutes.
Welcome to Yahoo Finance Live. I'm Akiko Fujita on this Monday. We're seeing green across the board to round out a choppy month of trading. Tech helping to lead the gains, with the Nasdaq up more than 2% now. The Dow up just slightly here, although the index is headed for its worst month since March of 2020, along with the S&P 500. Spotify backlash. Podcast host Joe Rogan responds to critics as a growing number of artists pull their work from the streaming platform over his comments. Spotify unveiling a new content moderation policy in response over the weekend. And buying the dip on Hood, ARK Investments, Cathie Wood steps in to buy nearly 2.4 million shares of the online broker as Robinhood touches a new low. We talked to one analyst who says commission-free trades on the platform could be coming to an end. But first, though, we are kicking things off with the market action. The S&P 500 bouncing back for a second day, but headed for its worst month since March 2020. For the Nasdaq, it is now on track for its worst January on record. Things could remain choppy, though, going into February, with Goldman Sachs now forecasting 5 rate hikes from the Fed, as one Fed official hints at a more aggressive hiking cycle. We've got team coverage here with Brian Chung following the latest comments from the Fed. But let's kick things off with Jared Blickery and the market action. Jared.
Well, Akiko, hate to end the month on a down note here, even though we're seeing some green today. We are experiencing some pretty steep gains or losses for the month of January here. It is January, yes, until tomorrow. Let's take a look at the Wi-Fi Interactive, and we can kind of chart what's been going on this month. Here's the Nasdaq. You can see it's up 2% today. Now, still down 10% for the year. You'd have to go back to 2008 to find a similar loss for the Nasdaq. It was down almost 10%. In fact, I was going through some of the worst years, and 6 out of the top 7 worst years for the Nasdaq occurred since the year 2000. So pretty interesting stat there, writing this up for Yahoo Finance later today. Now, I want to take a look at the Dow as well, if we can get some of these working. Here's the S&P 500. You can see that's down about 6% year to date. Also, the worst month since March of 2020. Think back to those days. All right, I want to take a look inside the Nasdaq 100, and we can see over the last 2 days getting a really nice pop in a lot of these names. Tesla up 11.5% since Friday, Apple up 8%, Amazon up nearly 6%. But I want to go to the sector action. I think that's pretty revealing. Today we have tech and also consumer discretionary. Those are the 2 leaders here. Also communication services. So it's really about the mega caps. That has not been the case for the year so far. We can see energy sitting on gains of 18%, but nothing else in the green. Financials and staples close behind the unchanged line, but consumer discretionary really taking it on the chin here. Also, real estate, a big loser, that's down 9%, and material. So all pretty tough month. And we were talking about the ARK innovation components. Just take a look at the carnage that we have seen this year. Shopify at the bottom, down about 31%. Roku down 30% as well. And as you noted, Akiko, ARK loading up on more Robinhood. So let's take a look at the meme stocks as well. Not a lot of green for the month of January, for the fledgling year of 2022. But take a look. At the bottom here, we got AMC close to the bottom. That's down 40%. Newegg down 36%. Now, a lot of people are wondering, when will the market action return? We've seen a nice bounce in risk markets over the last 2 days, and that's partly, I think, because it is the end of the month. Whenever you are sitting on a bunch of losses, pension funds try to rebalance, and so they're selling bonds and they're also loading up on equity. That could be what we're seeing here. If that's the case, then probably going to see that fizzle out tomorrow. Now, in the S&P 500, let me pull up a year-to-date chart. And we can see we have not even clawed back half of the losses. And in fact, that's where short sellers are going to be looked to re-enter trades, is right around 45.30 to 4600. This zone in right here is something I'm going to be watching for any pops. But in the meantime, just check out the 200-day moving average, the S&P 500 finally trading above that. So finally reaching that first hurdle. Taking a look at the VIX is back below 30, but let's take a look at a 5-year chart here. We can see that we were trending lower and now we are trending higher again. So I think volatility, the name of the game here for 2022 is going to be navigating a lot of market volatility. And Brian, I know that you had a chance to speak with one person who might have some control over that volatility. Can you tell us a little bit about that interview?
Yeah, well, last Friday I had the chance to speak with Minneapolis Fed President Neil Kashkari, who's considered to be one of the more dovish members of the Federal Reserve, meaning that he tends to prefer a slower path to normalizing policy than others. And he said that he could favor a rate hike, the first one since the pandemic, as soon as the Fed's next meeting in mid-March. And we also heard commentary from the Atlanta Fed President Raphael Bostic over the weekend that he might feel it's appropriate for a 50 basis point hike in one meeting, that coming in perhaps that next March meeting. Keep in mind, the Fed hasn't moved 50 basis points higher in a single meeting since May of 2000. But take a look at March rate hike odds as priced in by betting markets. This is the Fed funds futures contracts market. 85% percentage kind of expectation for only a 25 basis point hike in that meeting, but a non-zero, in fact, about a 15% chance of a 50 basis point hike in that meeting. And here's why that's so important, is because of the possible inversion of the yield curve that could happen if the Federal Reserve hikes interest rates at a more aggressive pace. One way you can measure that is by the spread between the U.S. 10-year and the U.S. 10-year Treasuries. Now, historically, this has been a bellwether when it tips into the negative. That has preceded a recession by as much as 12 or 24 months. And take a look at the decline that we've seen between these two spreads over the last few months. As of late, it's been about 60 basis points. Again, we're not quite getting close to zero, but you can see that decline clearly trending down as the Federal Reserve raises interest rates, which is on the short term. Maybe that takes the 2-year yield higher. That could dip below the 10-year at some point down the line. That could possibly be a bellwether for a recession. So that's something that Neil Kashkari told me last week he's paying very close attention to as well. So when we take a look, for example, at the U.S. 10-year floating right now at about 179 basis points, it's not good just to look at that in its singularity. You have to take a look at it across other maturities across the curve as well. Could indeed be a very interesting discussion for the Fed as we start to hear anecdotes like Bank of America's Ethan Harris on our show earlier this morning saying he could call for 7 rate hikes over the course of this year. Does that invert the yield curve and induce a Fed-induced recession in the economy? Something we'll need to pay attention to later in the year, Akiko.
We went from 3 to 5 to now potentially 7. Pretty wide range there, but of course, I know we've got much more Fed speak later on here on Yahoo Finance. Brian's going to be speaking to Atlanta Fed President Raphael Bostic. That interview is coming up at 1 p.m. Eastern. You certainly want to tune in for that. Let's turn to our first guest for the hour. We've got Tony Monopoly, Knights of Columbus Asset Advisors President and CIO. Tony, let's start with some of those comments that we got from Raphael Bostic over the weekend, sort of floating this idea that the Fed could be much more aggressive. How are you looking at that trajectory right now?
Well, good morning, Akiko. Thanks for having me. No, we are looking at that. And I guess I'm old enough to remember that last 50 basis point increase back in 2000. We think the Fed's going to be in line for probably 4 or 5, but we are telling our clients, we're telling our investors, do not rule out a 50 basis point hike. And part of this is that what's causing the inflation that we're having in the market, we've not been in the transitory camp because if it's wages, it's energy prices, it's the continued kinks in the supply chain. These are things that are not going to be solved in a month or two. We think these are with us for the rest of 22 and maybe into 23. And I think the Fed's trying to get ahead of it. And those comments about the potential for an inverted curve, certainly it's something that we're keeping an eye on, but we actually think the inflation's in the system may see more of a parallel shift with the curve moving just upward as opposed to just the front end being fulcrumed around maybe the 5 or 10 year. So a lot to unpack for the moment.
Specifically on those price pressures you alluded to, we're already at a 40-year high when it comes to CPI. How much higher do you think that goes?
Well, it's not as much as does it go much higher. It's that we just don't see it coming back down into that sort of 2 to 2.5% range where the Fed was being more comfortable. I'm definitely in the camp that energy prices are going to stay this high for a bit. You've got some folks on Wall Street now calling and saying, look, we could see $100 oil. And with what's going on just in the energy complex, giving the political tensions now with Russia and the Ukraine, it's going to push natural gas prices up higher as well. So there are pressures. We haven't really had to deal with geopolitical issues in a major way. Not that we haven't had geopolitical problems, but geopolitical issues weighing consistently and so heavily on the financial markets. It's been quite a while. And if any action happens within the Ukraine, we certainly think you're going to see energy prices just across the board, natural gas and oil increase. But I will add to that, I think you're not going to see anything, if anything happens, if diplomacy doesn't win, we really don't think anything is going to happen until after the Olympics. Because Russia has been trying to remain friendly with China. And I think it's quite possible that they're not going to look to disrespect their friends in China by taking an action during the Olympics when China's going to really want to shine as much as they can.
Tony, specifically on oil, when you talk about prices potentially reaching $100 a barrel, does that factor in a potential Russian invasion of Ukraine, or is that even without that?
I think it's even without it because we've got supply constraints and demand is definitely coming back. I just was able to sneak away for a few days to Florida last week to try to enjoy some warmth, and airports were full, roads were full. So we're definitely seeing the demand side. And as you know, in the U.S., we've had the XL pipeline, and not a political statement, but that pipeline's not being built. We've had more challenges in terms of drilling on federal lands or getting drilling leases. So it's causing a scarcity. Man-made perhaps, but it's causing a scarcity that certainly is causing upward pressure on prices. And as you know, once this starts, it can begin to feed on itself. So we think it's not going away anytime in the short term, and that's feeding into that potentiality for 100. Certainly, if you have military action, and if Russia does cross the line and there's a full-blown incursion into the Ukraine, I think that could put even more upward pressure on oil, which is going to put even more upward pressure on inflation.
You said that you were advising your clients not to discount a potential 50 basis points hike when we're talking about the year. What does that mean from a strategy standpoint? Does that mean a big push into value, or do you tell your clients right now, just kind of stay put until things shake down?
Well, we have been talking to clients. So we with our clients, we basically develop two sets of models. We have strategic models that are meant to be 5 to 10 years. Then we have tactical models. And on the tactical side, we are looking at growth at small cap and at international, maybe as being better places versus longer dated bonds and growth stocks. And energy, consumer staples, those are areas that we think can continue to do quite well. Obviously, energy's had a great run in January thus far, but we still think if prices are going to be stabilizing here or even increasing a bit, they can have some room to roam. Finance, again, there's still a lot of good stuff going on with banks. If you've got rising interest rates, it's going to help their net interest margin. And certainly consumer staples, we think are a good place to be right now, particularly as we have, yet another, is there a potential variant behind Omicron, Omicron 2.0? Does that cause more of a delay returning to work and more work from home, people concerned about going out, which may cause things in the staple side to be better places to be. So those are some of the things that we're looking at, and certainly some of the things we're talking about tactically with clients right now.
What about tech? Are you in the camp that, given the declines that we've seen this month, you go in and buy the dip on some of these opportunities, or do you think there's further downside, especially when you consider the jitters around higher rates?
My view on tech is basically pretty simple: wide moat and tall walls. With interest rates starting to increase, so many of these tech stocks did well, fueled on the back of, the theory of there was no alternative, or there is no alternative, the Tina theory, as well as the low rates really propelling some of these stocks. So if you've got some tech stocks trading at pretty sporty multiples, but don't have a reason for doing well, those are the stocks that may not perform so well. Apple, I always like to quote on Apple, rarely first with an idea, but often best, right? They didn't come up with the MP3, but look at the iPod. They didn't come up with cell phones, but look at the iPhone. Same thing with tablets, with the iPad. So they will continue to innovate and drive demand. But then you look at a company like Netflix, if the content expense continues to increase, it's going to be very difficult. So they've got to drive subscriber base on the one hand, so they've got to draw top line, and they've got to help manage their bottom line when at a time everyone's competing for content, right? Streaming services, Fubo TV and all these different streaming services that are out there, the fight for content is going to continue, and that's something that could be a headwind for a stock like Netflix.
Tony Monopoly, appreciate you stopping by on this Monday, President and CIO of Knights of Columbus Asset Advisors. Well, let's turn our attention to one trending ticker in the session. Tesla shifting into high gear. The stock up more than 8% after an upgrade from Credit Suisse to the equivalent of a buy rating. In a note to clients, the analysts argue this year's sell-off in growth stocks has created a buying opportunity for the EV maker, and what was holding them back before was valuation. Coming up, Joe Rogan breaks his silence, what the podcast star is saying after Spotify faces backlash over COVID misinformation. That backlash, or at least the protest led by Neil Young. That's coming up on the other side. Welcome back to Yahoo Finance Live. Podcast host Joe Rogan is speaking out after several artists, including Neil Young and Joni Mitchell, pulled their music from Spotify over comments, COVID misinformation that was made on his podcast. Rogan taking to Instagram over the weekend, responding to some of that criticism. Take a listen.
My pledge to you is that I will do my best to try to balance out these more controversial viewpoints with other people's perspectives so we can maybe find a better point of view. I don't want to just show the contrary opinion to what the narrative is. I want to show all kinds of opinions so that we can all figure out what's going on, and not just about COVID, about everything.
Spotify also responded over the weekend by taking measures to add new platform rules and warning disclaimers to podcast episodes about COVID-19. Spotify CEO Daniel Elk saying, in part, in a statement, personally, there are plenty of individuals and views on Spotify that I disagree with strongly. We know we have a critical role to play in supporting creator expression while balancing it with the safety of our users. In that role, it is important to me that we don't take on the position of being content censor while also making sure there are rules in place and consequences for those who violate them. For much more on this, let's bring in Axios media reporter Sarah Fisher. And Sarah, it kind of felt like watching this over the weekends that this could really blow over. We saw Neil Young first, and then Joni Mitchell, some other artists kind of starting to weigh in. Has Spotify been able to contain this with that statement coming from Joe Rogan as well as the company, or do you think there's still more to come?
I think it's a little bit of both. I think there's still more to come, so long as any tech platform is trying to figure out how they manage content moderation in an era where we don't have updated internet regulation. There's going to be these types of issues. But I think they were able to push off a lot of the concern with the announcements that they had on Sunday. Primarily, they finally unveiled their content policies. One of the big issues with Spotify that people had said was, we don't even know how you regulate content. Well, they finally put forth their rules. And luckily for Spotify, once they put forth their rules and once they said they were making some changes, adding labels to conversations about COVID, they didn't lose their top podcaster, Joe Rogan. I think this could have been a massive story and a huge problem for Spotify if Joe Rogan responded negatively. But he didn't. He said he agreed with the changes that Spotify was making and that moving forward, he would try to present more sides of the story.
In many ways, Spotify has been able to stay out of the conversation on content moderation. We've seen Twitter, we've seen Facebook really hit hard with that. How much of this kind of opens this big can of worms, if you will, though? I mean, sure, Joe Rogan responded saying, look, I understand there needs to be a balance here. And yet there's artists out there who are saying, we're going to think twice now about, posting our music or allowing Spotify to post our music.
I think artists that make that call are going to have to start putting pressure equally on every platform. So is Neil Young going to delete his Facebook page? Is Joni Mitchell going to get off Twitter? Every single platform is dealing with these misinformation crises. Now, I'm not saying that they should get a free pass, but I don't think Spotify is in any way different from some of the other big tech platforms that algorithmically distribute content. The key difference with Spotify's Joe Rogan situation, though, from some of those other misinformation tech platform problems is that they do exclusively pay to have Joe Rogan's podcast on the platform, $100 million reportedly over 3 years. So they may have some added incentive to make sure that their rules don't, explicitly target Joe Rogan. But I think that, Spotify isn't any more exposed than Twitter or Facebook. You might see their name dropped in a few more press releases from Capitol Hill, but it doesn't mean that anyone's going to come after them more aggressively.
Yeah, let's talk a bit more about that business decision for Spotify. As you noted, I mean, Joe Rogan, certainly a significant name. They've been able to bring a lot of subscribers on board since they signed that roughly, $100 million deal with Joe Rogan. Can you talk about how big of a bump they've gotten out of that and how that really affects their decision making on something like this about content moderation, given that Joe Rogan is such a cash cow for them now?
He is. And the thing to remember with podcasts is that they're really good for growing Spotify's advertising business, which every quarter is getting bigger and bigger and bigger. Now, music, on the other hand, is not good for advertising, but it's not as strong as an ad-supported business. So you can see why they want to continue to lean into podcasts. For Joe Rogan, who's by far the most popular podcaster on the platform, he not only brings in that advertising revenue, but he brings more people to the platform. His audience is split among people who will listen to it for free, but also people who will listen to it on that paid premium tier so that they can avoid the ads. So overall, I mean, it makes a lot of sense that Spotify wants to do what they can to protect Joe Rogan as talent. And it also sets a precedent moving forward when they have other exclusive podcasters come onto the platform. If Spotify were to have changed its rules to target Rogan in response to backlash, what would other podcasters have said when they're trying to book exclusive deals with Spotify? They'd be worried maybe they'll do that to me.
I mean, that's the follow-up question here, right? How does this particular controversy affect the way that Spotify, or how aggressively Spotify moves in podcasts, specifically trying to sign other big names that could bring audience with them, but equal controversy?
Big platforms like Netflix have always said we want to avoid news for these types of reasons. But you know what? You can't really avoid this type of saga, even if you try to avoid news. Look at Netflix. They had a huge boycott and a huge backlash against comments made by Dave Chappelle. Dave Chappelle's a comedian. He's not a newsmaker. Joe Rogan's not a journalist. He's really entertainment. And yet he's still having these issues because he's addressing some sensitive topics. And so I don't think this is going to stop Spotify or Netflix or any other platform from trying to book exclusive talent because it's good for their business. And I don't think it's going to, change fundamentally the way that they moderate content. I think it just forces them to be more transparent about where they hold the line. And I think as Spotify CEO Daniel Ek clarified yesterday, they have to now be more transparent about the way they enforce those policies so that no one's caught off guard.
We'll certainly be watching how this all plays out. Axios media reporter Sarah Fisher, appreciate you joining us today. Coming up, going under the hood, New Construct CEO David Traynor joins us next to discuss the path ahead for Robinhood as Cathie Wood's ARK buys even more shares of beaten down online brokerage. That's next. Welcome back to Yahoo Finance Live. We'll take a look at shares of Robinhood. We are seeing the move here higher on the back of ARK Invest. Cathie Wood stepping in to buy nearly 2.4 million shares of the online broker as Robinhood touches a new low. The move coming after Robinhood released their Q4 report last week, showing that they had missed revenue estimates by more than $7 million. Let's bring in David Trainer. He is CEO of New Constructs. David, I feel like we talked to you when Robinhood first debuted. Certainly, you have flagged all the risks that come with investing in Robinhood. What do you make of this latest investment from Cathie Wood and, saying, look, this is an opportunity to buy on a dip, and we're not just talking about a small dip here?
Akiko, I don't think it makes any more sense to buy Robinhood at these levels than we said it made at buying at the IPO level. I mean, we were very clear about warning investors away from this before the IPO, and we feel the same way. And I think all that the latest earnings report reveals is that the business isn't working. They're not able to get to the scale they need to generate profits. And if the business doesn't make any money, how long does it survive? It's a very commoditized product. And look, I think most astute investors don't always put a lot of weight in Ms. Wood's analytics and what she's investing in. And I think Robinhood it's just one of those stocks that got hot in sort of the work from home COVID related theme, and it's petering out. And I don't know if the business has any legs going forward.
So we can talk about the business in the regulatory threat in just a bit, but specifically on the stock move. I mean, how much of these rapid declines we've seen in Robinhood are just about expectations being set too high? I mean, you could argue the company had kind of warned about the declines or the slowdown that could be coming, and we're a year out from what was at the height of the meme trade. Robinhood, a big beneficiary on that, but certainly investors couldn't have expected that to continue, right?
No, you're right, Akiko, and I think you bring up a great point about expectations. Do most investors really understand the expectations baked into stock prices? We talk about expectations all the time, but very few people go through the rigor of actually quantifying the future revenue, profit margins, cash flow expectations baked into stock prices so they can have a eyes wide open perspective on how expensive or cheap a stock is. And I think what Robinhood represents is a perfect example of a lot of enthusiastic investors, getting in over their heads, not really realizing just how expensive this stock was. Look, we pointed out, it came out around 32, 34 bucks. I think it went up a whole bunch after that. We pointed out in our pre-IPO report, it's probably not worth more than $9. And that was giving it a lot of credit for a growth that it's not yet to achieve. I think it's probably a low single-digit stock. I think they've got to hope that a bigger firm buys them out just for their user base. But the business, look, free trades, anybody can do that. All right, gamifying trades has proven to be something that regulators don't really approve of. I'm not really sure what kind of moat Robinhood's business has, if any at all.
Of course, there is the threat of the SEC cracking down on payment for order flow, which has been a big revenue driver for the platform. Number one, how likely is a ban? And number two, if there is any sort of regulation short of a complete ban, what's the alternative for Robinhood?
I mean, they're going to have to start charging for trades. And look, this is where they are at a huge competitive disadvantage to the bigger firms like Schwab and Interactive Brokers, and that they don't have the assets under management to generate fees from anything other than trading. If they lose payment for order flow, it's done. And I don't even know if regulators have to make it illegal, because I think investors are starting to be a little more sophisticated about just how much they're being surveilled and everything, but in particular their trades. And look, I don't know about you, but I would never feel good about doing trades for free because I'm giving my order away to someone to front run it. It's just not a good business model. It's not healthy. It doesn't feel very high integrity to me. And ultimately, we said this early on, in many ways, Robinhood is just a way to sell investors on exploiting other investors, right? I mean, if the business model is about making money by selling off your trades to people before they hit the market, and you get investors to buy into that, it's like cannibalistic, right? We make money by you preying on other investors, including you maybe, right? Because I know Robinhood has given their people who've invested in the stock, some extra additional access to IPOs and things like that. So what we may be dealing with here, Akiko, is really as the retail market becomes more sophisticated about markets and investing, they may reject this payment for order flow model regardless of what regulators do.
How does crypto factor into your base case for Robinhood? I mean, certainly, we're talking about payment for order flow. Robinhood there was wide adoption because of these commission-free trades, but we've also heard the company say that they see huge growth opportunities in crypto.
Yeah, again, what's the differentiation there versus Binance versus Coinbase? What other firms, even the larger traditional brokerages, are offering with respect to crypto? Crypto is not a get out of jail free card for a business model that doesn't work otherwise. What is Robinhood going to do in crypto that no one else does? I don't think there's anything there, right? Trading is a commoditized service. The value add that I think Robinhood and these other firms, especially all the robo-advisors, need to be thinking about is not just getting their clients to trade all the time, but helping them trade more intelligently, right? That's the new stage here. We think that's how you win business. That's how you build a moat around your business. Help your clients make more money, help them invest more intelligently, help them invest more safely, help them stay clients longer. Don't just try to get them to trade all the time so you can profit from that.
And finally, David, you said, potential alternative for Robinhood is that it becomes an acquisition target. But the question there is, what is there to buy? You mentioned the user base certainly could be attractive. What kind of acquisition are we talking about? Who could potentially be interested?
Yeah, Akiko, I'm not advocating an acquisition, right? I'm just saying that's the bailout here, because I don't know that the business ever really generates enough cash flow to trade more than a couple bucks per share. Maybe it doesn't even make it that far, right? Think about the competition they have and that competition's ability to give away trades for free in a way that Robinhood cannot without selling off the orders, right? So yeah, I think the best you can say is they have a decent amount of users, and maybe those users are valuable to someone. To whom? I don't know. I'm really just trying to kind of come up with things that might justify this stock not going to zero.
Well, David, we always appreciate your takes. New Construct CEO David Traynor joining us today. Coming up, new concerns looming over a mutated version of the Omicron variant as cases begin to spread across the U.S. What you need to know is coming up next. Well, there are new concerns growing over a mutated version of the Omicron variant, now dubbed the stealth variant, with more than 100 cases in the U.S. reported so far. Let's bring in Dr. Howard Foreman, Yale professor of radiology and public health and co-host of the Health and Veritas podcast. We've also got our very own Anjali Kamlani joining in on the discussion. Dr. Foreman, always good to talk to you. There's a lot of questions. Anytime our viewers hear another variant, what do we know about stealth so far, and how concerned should we be?
Yeah, look, all indications from the people that I trust who really this is their expertise are saying this looks to be more transmissible, not by a lot, but enough. But in every other way, it's functional like Omicron. It's going to be neutralized by the same antibodies. The body should respond to it roughly the same. It is very similar to Omicron, except that it is slightly more transmissible. And therefore, by being more transmissible, it probably extends out the tail of this outbreak a little bit more.
Dr. Foreman, I wonder about that and the concerns that we should have, considering everything we know about the level of vaccinations in the U.S., as well as the recent surge with infections. How concerned should we continue to be about not just this subvariant, but other emerging variants?
I think we're going to always be looking out for more variants, but I do believe, as most people do right now, that a combination of acquired and vaccine-induced immunity, so acquired immunity either through infection or vaccine, over the last 6 or 9 months is going to have an enormous impact over continued spread. And those individuals that have had a booster shot, those individuals who have had infection plus a vaccination and so on are going to be relatively more protected. Those individuals who are not had a booster shot or have had infection but no vaccination, or vaccination without the booster, as I said, are going to be less protected. We're going to have to keep watching this. The general sense is that severe disease, hospitalization, deaths should continue to be muted among people who have some level of acquired immunity.
With that said, in a place like New York City, where I am right now, we've seen past the peak of Omicron. And I wonder what you're seeing across the country. To the point you just made right now, how does this new variant, stealth, complicate the response?
Yeah, look, it is complicating the response only in the sense that it will extend the tail of the outbreak a little bit. And by that, I mean that whereas we might have expected levels to go down to 50, they'll actually go down to only 60 at a certain date. It'll take a little longer for us to extinguish an outbreak or mitigate the outbreak. I think the news out of New York City in particular has been really very positive, and I think it's being underplayed because the city has been so beleaguered during this outbreak. But the positive rate in New York right now, the number of cases in New York right now, the number of new admissions for COVID right now are way back to levels from December. And it indicates that transmission is probably getting really close to pre-Omicron levels. So New York has made it past to the other side of this outbreak. You're going to continue to have new infections, but at a much lower rate than we've seen over the last 4 or 5 weeks. So that's the good news. The bad news is that we're going to continue to have outbreaks over time, and it's not likely to be Omicron-related outbreaks that are going to pop up again in 6 months. It's likely to be something else, as we've come to experience, and we can hope that it'll continue to be less virulent, either because of existing immunity or because of sort of native lower virulence, native lower dangerousness of the virus, or the immunity that we've acquired over this time. I think we're entering a period that most of us are hoping will become the new normal. Until this point, there were still substantial numbers of people that had no exposure to either vaccine or prior infection. I saw somebody last evening in the ER. I was shocked by this, by a 40-year-old that was otherwise at high risk, presenting with COVID pneumonia. And I went into the chart to just see why that was happening, and sure enough, unvaccinated. So there still are people that have not had COVID in the past that are unvaccinated that are still showing up to the hospital, but fewer and fewer of them are available to be infected now.
I wonder about masking and all of this, Dr. Furman, because I know now that the U.S. is, providing masks to the general public, specifically N95s. And we've talked about, some people projecting that the end of the pandemic will be this year. Putting that whole debate aside, how do you see this surge and the protection that it's going to offer as it plays out through the rest of the year into fall and the whole discussion about returning to work and returning to normal and returning to schools?
Yeah, look, I've said many times on your show and others that we got to remain humble. The number of times I've heard people tell me this is finally over and in the next few months we'll experience life after pandemic is a large number, and it will probably continue to get larger. This is going to continue to befuddle us at various points in time. On the other hand, we understand much more about how to manage this day to day. We know that N95 masks will protect you individually and protect those around you. Other masks are probably more effective at protecting people around you, but not you. We know that we have a vaccine that works very, very well. I am continued by the opportunity I have to practice medicine in an emergency room as a radiologist. I consistently see how effective the vaccines are. And to those that have not been vaccinated, it is never too late to try to get vaccinated. And for those that are worried about a booster, you should get the booster, because we still are seeing a lot of younger people who have not gotten the booster who now show up with overdue for booster and presenting with symptoms. So we're still pushing those as one of our best remedies to get us out of this. We know masks work, particularly N95 masks. And as the winter turns to spring, we're expecting to see seasonal changes as well that should benefit us.
Doctor, let's talk about what's playing out over in China. We're 5 days out from the start of the Winter Games over in Beijing. The city now reporting its highest COVID case counts in 18 months. It's still relatively very small when you compare it to Western countries, but I wonder what kind of protection do you think is in place? I mean, they've had this zero COVID policy, but China has largely been closed off until now. And now you've got athletes arriving. Chinese citizens have been vaccinated, but yet with the Chinese vaccine that hasn't shown the same immunity as the mRNA vaccines, how do you see this spreading, or do you think China has a pretty good control with the protocols in place?
Look, China will get this under control over time, but not in enough time to spare a lot of Olympic athletes and others from being, having an experience that they didn't want to have during this time. China, as you say, is unique in so many ways. They've had very little infection-acquired immunity. They have vaccine-acquired immunity, but primarily from their vaccine. But none of the vaccines seem to be very effective at preventing transmission. They are effective at reducing transmission, but they certainly don't stop it. It would not be surprising that our athletes can get infected. And it's why I'm sure every one of them are doing everything they can to avoid infection and avoid losing this once every 4-year opportunity to demonstrate their skills. This is a tough time for China. This is a tough time for a lot of countries. There are countries in East Asia where vaccine hesitancy is highest among the elderly. And those countries are really in for a lot of pain if spread starts to take off, because in those countries, you have not protected the elderly and those who are most infirm, and you will see a disproportionate number of deaths with relatively smaller outbreaks.
Dr. Furman, finally, where do we go from here in terms of what we anticipate will be guidance for the rest of the year? And looking specifically at still the internationally unvaccinated population, still struggling to get vaccines despite commitments that we hear coming up. What do you see that as in terms of the timeline?
Yeah, we're still very far behind globally in terms of vaccination. Some of it has to do with making the vaccines available. Some of it is about access to the vaccines in those countries, the logistics of actually getting the vaccines into arms. And some of it, as I mentioned, is still about hesitancy. And we have to be able to tackle all three of those things. We have to do a better job. The less there is replication of virus inside humans, the less likely of having a new variant that is going to cause us to interrupt our lives again. Travel bans are continuing. There's a lot of frustration out there, and we're going to have to figure out how do we live with this, because this is not going away. It's never going away. But at the same time, in our country right now, we're watching roughly 2,300, 2,400 deaths a day. And that's only by our explicit count. It may, in fact, be higher than that. So we're not even close to a new normal yet. We have to figure out how to get our country and the globe to be able to cooperate with one another to get to a new normal.
Yeah, it's a sobering reminder of where things still stand. Dr. Foreman, always appreciate you hopping on with us. Dr. Howard Foreman, Yale Professor of Radiology and Public Health, and co-host of the Health in Veritas podcast. Coming up, new concerns over North Korea's missile test as the country conducts its biggest launch since 2017. That and much more coming up in our Worldview after this break. In our Worldview today, U.S. and Russian diplomats faced off before cameras at the UN Security Council meeting this morning as both sides look to dial down tensions along the Ukrainian border. The U.S. called the meeting last week to build international pressure on Russia as it beefs up its military presence along the border. Washington's called Moscow's actions a threat to international peace and security, while a senior Russian official dismissed the meeting as nothing more than a public relations stunt. The Kremlin has called on NATO and its allies to reduce their presence in the region. It is yet to provide a formal response to U.S. proposals on European security laid out last week. Meanwhile, over in Washington, the Senate Foreign Relations Committee is set to introduce bipartisan legislation targeting Russian banks, as well as Russian savings and pensions if President Vladimir Putin invades Ukraine. North Korea test-fired its most powerful missile since 2017 over the weekend. State media KCNA confirmed Pyongyang launched an intermediate-range missile, the Hwasong-12, capable of reaching the island of Guam. That has raised concerns the North could soon resume testing of its long-range missiles and nuclear weapons. Pyongyang has maintained a self-imposed moratorium on long-range missiles since 2018, but argues it is no longer bound by it. Japanese and South Korean officials condemned the launch, saying it poses a threat to regional security. This marks the 7th round of tests Pyongyang has conducted this month. And more than 20 people have now been confirmed dead in Brazil following heavy rainfall. At least 21 people have died since a powerful storm triggered floods and landslides across Sao Paulo. More than 600 people have been displaced. Images from the air show major roads underwater while rescue crews continue to search for any survivors. This is just the latest weather-related disaster to hit Brazil since the rainy season began in October. Sao Paulo's governor has set aside nearly $3 million to assist with the cleanup and repairs. Coming up, shares of Tesla accelerating in the session on an analyst upgrade, why Credit Suisse sees a buying opportunity for the EV maker straight ahead. Shares of Tesla are getting a boost in the session today, up roughly 9% after Credit Suisse upgraded the EV maker to overweight, citing an expected 20% rebound this year. Let's bring in Yahoo Finance's Inez Ferre, who's tracking that, along with the rest of the market action today. And as it sounds like this is more of a valuation play, especially given how far back Tesla shares have pulled back this month.
That's right. And the analyst note by Dan Levy and Stephen Young over at Credit Suisse said that this is a good entry point for Tesla shares, and that Tesla has been caught in this market downturn. And basically, the shares are now at $923, trading up 9% after this note. But the price target that these analysts have put on the stock is at $1,025, saying that the stock will recover. So the analyst note basically basically went through a series of points, basically saying that Tesla is a leader when it comes to the multi-decade secular transition into electric vehicles, saying that it's also the front runner when you compare Tesla to the legacy automakers, which are investing heavily in electric vehicles, writing that in the race to the EV world, Tesla remains in the lead. Also talking about Tesla's margins, that they've surprised to the upside, and these analysts are expecting those margins to hold up. Now, Tesla has had a volatile week last week after it reported a strong quarter, but warned about some supply chain woes. On Friday, though, it did close higher. Year to date, the stock is down 12%, Akiko.
And Inez, we've been talking a lot about Spotify today in the context of the controversy around Joe Rogan, but the stock doing pretty well on the back of an upgrade.
Yeah, that's right. The stock is up right now, up 12%. And Citi's analyst Jason Bassinet actually lowered his price target to $240, but increased his rating on Spotify to a buy from neutral. Basically talking about subscriber-based stocks, that they've really come under pressure recently, and that the equity returns for these have lagged the S&P 500. Now, the stock's value, he says, isn't really assuming subscriber growth in the future, improving subscriber economics going into 2023, according to this analyst. And he believes that Spotify can improve its ad-supported monetization. In the same note that he raised Spotify to a buy, he also raised Netflix to a buy as well, talking about Netflix's buying power and talking about Spotify's improved ad-based monetization, the ability for Spotify to do this. And that's why you're seeing a bump in the stock today as well.
Okay, certainly a lot of calls coming out on tech, especially on the back of the recent pullback. Inez Ferre, thanks so much for that. We've got much more to come here in our next hour. The S&P 500 now on pace for its worst month since March 2020, even as we see it push higher, up more than 1% in the session on this very last day of January. We're breaking down the latest market action straight ahead. Welcome to Yahoo Finance Live. I'm Akiko Fujita. It is noon Eastern, or shortly after noon Eastern here in New York City, and we are seeing green across the board to round out a volatile month of trading. Tech helping to lead the gains with the Nasdaq up nearly 2.5% here. We're also seeing the Dow up just slightly here, about 0.3%. The index, though, headed for its worst month since March of 2020, along with the S&P 500. Meanwhile, China's digital yuan taking center stage ahead of the Beijing Winter Olympics. But can the digital currency go for gold beyond Chinese consumers? We're going to be discussing the potential headwinds a little later this hour. And will he or won't he? We are breaking down the Tom Brady retirement speculation looming ahead of the Super Bowl. We're also going to be discussing the millions of dollars that could be tied to his decision. Let's kick off this hour, though, with a look at the market action. We've got Jason Draho, UBS Global Wealth Management, Head of Asset Allocation Americas, joining us to dive in deeper into the moves here. Jason, let's just take a deep breath here to look back at this month, because it has certainly been a very choppy one, largely trading around the speculation around the rate hikes with the Fed. What do you see when you look back here, and how much choppiness is there to come?
So I think you're right that the story this year so far has been the Fed's hawkish pivot. It began last December. The minutes at the beginning of the month were kind of a step in that direction. And then last week, the FOMC meeting, I think, kind of further moved in that direction. So the move higher in rates, that's been sort of driving a bit of the pullback. We've seen, especially in tech and growth stocks that are actually now fairly sensitive to higher rates. On top of that, you have to put the move this year in context of what's happened the past, really 2 to 3 years, where equities have done very well. The S&P was up 28% last year. So even the pullback that we had, at least as of Friday's close, of down 7%, it's still a very good performance if you think about it over the last 12 months. So I think some of it is just adjusting to this new reality of a Fed being a very different regime. Investors who are positioned one way now sort of readjusting their portfolios. And even on a day like today, where some of the balance we're seeing is probably a little bit of driven more by month-end sort of portfolio rebalancing. Investors are feeling like maybe the pullback is done. They're looking to buy some opportunities. So it's less about maybe new news today, but sort of taking advantage of some of the positioning. So I think it's really, it's been a Fed story, a rate story so far this year. On top of that, now I think it's kind of, the Fed raising rates into an economy that appears to be slowing, at least temporarily. I think that's just has created a little bit of anxiety among investors.
What do those trades tell you about the expectation for the Fed? We started off the last hour by talking about Goldman Sachs now calling for 5 rate hikes this year. Certainly a lot of speculation about how quickly things could move. What do you see in the market right now in terms of expectations?
So what the market is pricing is 5 rate hikes. And I think what's happened is if you look across different economists and forecasters, they've kind of consolidated around that range of about 5 hikes. There's a few that are kind of on the higher end of the range, some even saying as many as 7. Not too many that are still in the 2 to 3 range, given how aggressive the Fed has been in terms of guiding that they need to do something. So to me, like 5 feels kind of appropriate. But I think it's also important to think that the Fed clearly feels like it's behind the curve. It wants to get started soon and move kind of pretty quickly. So I think March hike is almost very certain unless something really bad happens with the data. We think June is almost also certain. May, I think, is a bit of a toss-up, but probably leaning in the direction of they want to maybe hike 3 times. Also announced the start of balance sheet reduction probably in May or June to begin no later than July. I think once they kind of get that lift off, though, I think the second half story is more about like assessing where is the economy, how much is inflation perhaps moderated at that point in time, have supply chains improved sufficiently, and has this move by the Fed really kind of started to tighten financial conditions. I think it's possible that we're actually almost at peak Fed hawkishness right now. They're trying to job on the markets that they're going to do a lot. They'll do a lot quickly and then maybe reassess once we get into the middle of the year, like how are things kind of playing out. And it's possible they can start to moderate at least some of the hawkishness as we move later into the year.
We've certainly seen a lot of de-risking happening this month, but you also pointed out there that there's also a sense here among investors that maybe we have overcorrected, especially in some of these high growth names. Where are you seeing the inflows when you talk about the moves in investors sort of reassessing their portfolio?
So I think so far it's been sort of selective. It's often time when you get these big pullbacks, especially in a certain area of the market, like we've seen in tech and growth stocks, that you get a bit of the baby with the bathwater gets thrown out, and you realize when you kind of have calmer heads prevail that there's opportunities there that you kind of look over. So I think some of that is going on right now, where people are selectively looking to add exposures. I think there's still a little caution about the fundamental outlook, so people are kind of apprehensive of adding too much risk. But I think even compared to today versus say a week ago, where people were very much in the mood of like, this could be a short-term balance, I think you're feeling some fundamental investors feeling a little more comfortable to start to selectively add risk, but do it at a more measured pace, as opposed to, last year, for example, anytime there's a pullback, any sort of dip was bought pretty aggressively. I don't think we'll see that this time, at least not yet, just given some of the uncertainty still about the data.
Where does geopolitics fall into your assessment? Certainly, we had a guest on in our last hour who was talking about oil prices moving even higher at $100 a barrel, even without any conflict in Ukraine, a potential invasion from Russia. How big of a risk do you see that as in terms of it being a market event?
So, typically when we get sort of these geopolitical tensions, it certainly gets a lot of headline risk, but ultimately it ends up being not very market moving, or it does for a day or two, but the market's going to look past, because ultimately you try and trace it back to what is the economic implication of what's happening. And in most cases, the economic impact is quite minor. Now, what makes the Ukraine-Russia situation more relevant to the markets right now is that oil prices are now like $90, a little bit higher. Oil supply is constrained. I mean, there's not a lot of spare capacity to kind of ramp up. Demand is increasing. So any sort of disruptions in potential supply could cause prices to go even higher. So I think that's a risk even without anything escalating in the middle or in Ukraine. But if that starts to go to like $100 or more, then I think it starts to become more impactful for the markets, because now you start to see some sort of demand destruction, consumer spending elsewhere might be impacted. And so I think there's not a lot of scope for or margin for error in terms of the supply side. Anything that escalates in the Ukraine or causes disruptions in Russian supply could probably cause prices to go higher. So I think that's where this is a little bit different. I think the geopolitical situation itself is sort of a second order importance to the market.
Jason Draho, UBS Global Wealth Management, Head of Asset Allocation America. It's good to have you on. Thank you. Well, let's turn our attention to some big earnings on tap this week, particularly in tech. Shares of Alphabet moving just slightly higher ahead of its results on Tuesday. We've got Dan Halley here to break down the numbers for us. Dan, it was a bit of a mixed picture last week on tech earnings, but we closed the week strong with numbers from Alphabet. What's the expectation with Apple, I should say? What's the expectation for Alphabet?
That's right. Apple did very well closing out the week. Microsoft, by the way, did well on its own, but there was a little bit of a pullback at first. And then we saw the expectations come through in the earnings call that they had done, and then we'd seen shares pop after that. But for Alphabet coming in this week, we want to talk about both the cloud side and the advertising side. Obviously, the advertising business is the big breadwinner for Alphabet. They, like other companies, have been impacted by Apple's recent privacy changes to apps on iOS and iPadOS. That basically allows users to cut off the ability for apps to track them across different services. That has impacted the likes of Snap and Facebook as far as advertising dollars go. But according to analysts, Alphabet doesn't appear to be getting hurt as much. And that's likely because they're able to capitalize on their search strength and pull advertising data from that. So that's why we may not see as large of an impact. Let's just go over the numbers real quick for revenue. Minus traffic acquisition costs, or ex-TAC, we're looking at $59.3 billion expected for the quarter. That's compared to $46.4 billion in Q4 last year. And then earnings per share, we're looking at an expectation of $30.01. That's versus $22.30 in Q4 last year. And I just want to go over their cloud business. Google Cloud obviously trying to catch up a great deal with Amazon and Microsoft, which are 1 and 2 respectively as far as market share. So Google, or Alphabet, is plowing money into the business, and that's why we're going to see lower margins there. We could see as much as a loss of $705 million. That's according to JPMorgan's recent analysis. And as far as shares go, while we've seen Amazon lose quite a bit over the last 12 months, we've seen Alphabet up more than 45%, and that's better than the broader S&P 500 at 19%. Facebook also at 19%. Microsoft doing well on its own at 33%, but Amazon down 7%. That's over the last 12 months, as I said. Year to date, nobody's really doing all that well. Everybody just looking at negative percentage points at this point. But as I said, over the last 12 months, Alphabet has just continued to dominate. So we'll look to see what they have to say on Tuesday when they report.
Okay, and I know you'll be all over that report. Dan Halley, thanks so much for that. Coming up, China's digital yuan takes center stage ahead of the Beijing Winter Olympics. But can the digital currency project go for gold with the games scaled back significantly? We're going to be discussing the potential headwinds ahead on the other side of the break. Well, we've got just 5 days to go until the opening ceremony kicks off the Beijing Olympics. The Winter Games were set to be the first real test for the Chinese central bank's digital yuan, but those ambitions have been scaled back dramatically, in part because of limited attendance. No spectators will be allowed into events out of fears of COVID outbreaks. Let's bring in Daryl Duffy, Stanford Graduate School of Business, Professor of Finance. Professor, it's great to have you on today. So this digital yuan has kind of been on a trial run for the last 2 years. This was supposed to be the big reveal with everybody flying into Beijing for the games. What can we expect now that that's been scaled back significantly?
Well, Kiko, it had originally been touted as a splashy opening of the new digital yuan in China. It's been in development for over 5 years with lots of technology and testing. And it's actually been rolled out in 10 major cities. It's on phone apps. You can use it if you're in China. But as you mentioned, because of COVID, at the Olympics, it'll be mainly local workers doing the Olympics and the athletes that are using it. And I think you're going to see some coverage just as you are doing this today. And it will help profile the ability of this new digital currency to serve everyday payment needs. But it's not a splashy event. You'll just continue to see it rolling out. There's now 260 million people in China that have downloaded the app to their phones. And the volumes are still quite low, but it's just going to keep increasing over time.
What's the experience going to be like for the international athletes who are going to be on the ground? I mean, the thinking initially before the Olympics were scaled back was that China would require the digital yuan to be used to really accelerate adoption. And yet, even before the games, we've heard from lawmakers over in DC, for example, calling on athletes to bring burner phones so that they don't necessarily get tracked. I mean, talk to me about the debate around that and what athletes can expect once they're on the ground.
Well, Kiko, it is true that the authorities are pushing the use of ECNY at the Olympics. You're only allowed to use paper Chinese money, Visa cards, or this new digital yuan. But the idea that you need to be worried about surveillance at this particular venue is not that great because most of the athletes are foreign. They won't have Chinese mobile phone accounts. So they're going to actually stuff US dollars or Australian dollars or euros into ATM machines, and out will come an anonymous card. And you'll carry that card around and tap it to travel on a local athlete's bus or get food at a concession. But the idea that you could be surveilled upon at the Olympics is not really a big of a risk. There could be risks, though, later in terms of surveillance of payments by US firms in China. And of course, the Chinese people themselves could have surveillance. But I think the athletes don't need to worry that much.
You mentioned that the digital yuan's been rolled out in a number of cities. I wonder what the adoption's been like domestically. I mean, anybody who's gone to China knows that in major cities, things are largely cashless with the use of WeChat as well as Alipay. I mean, how many Chinese consumers have actually taken to this shift when they've already got an app that basically pays for everything?
Yeah, some Chinese consumers have asked, well, why do I need another app? I already have WeChat Pay and Alipay, which dominate the mobile payment scene in China. Over 95% of Chinese consumers in the urban areas are using those two apps. But I think China's government really doesn't like that very much. They don't like it that these are private firms, that they've been taking business from the large Chinese banks, which are state-owned. And also they have these fintech firms have a lot of data, which concerns the Chinese authorities. They want the data. So they've been encouraging Chinese consumers to download the app, and that's been quite successful, over 250 million downloads of the app. But the volumes are still small, under about 15 billion US dollars so far, which is a drop in the bucket in China's payment scene, which runs into the trillions of dollars a year. So we'll have to see over time. I mean, the Chinese authorities can certainly encourage it to whatever extent they want. They can require it even.
I know you've been looking a lot about at what this rollout from China means for other CBDCs, and you've got a report coming up here in March that really looks at the implications specifically for the Fed and the digital dollar. Can you talk a bit more about why you think the Fed needs to take more of a leadership role? I mean, sure, we're talking about China right now, but there is an argument to be made about global standards that need to be set. And if the Fed doesn't move quickly enough, they're not at the table in crafting that.
That's absolutely right, Akiko. In early March, the Hoover Institution at Stanford is going to release a major policy report, which will involve experts from across computer science, former Treasury undersecretaries, former China directors at the White House, national security members, economists, and business people. And the report is likely to assert that the United States government needs to get moving in the area of digital currencies. China has taken the pole position. It's already laying out what it believes to be international standards for cross-border payments. It's interacting with other countries on infrastructure for cross-border payments. And meanwhile, the United States government is still making up its mind about how much to embrace digital currencies. The Fed released a major paper 2 weeks ago, laying out what it believes to be the future for a CBDC if it's adopted, but hasn't tipped its hand yet. It said very explicitly it wants the White House and Congress to move first and to give it direction in this area. So the US and other countries around the world, many of whom are exploring a CBDC, they do need to take a stand on exactly what they believe and get going on the technology. It's not clear yet, though, that the United States needs to have its own digital currency. It should develop the technology, and it should find out how good it is before it pulls the switch on using it.
What is the risk in allowing China to take the leadership on this?
Well, right now, the renminbi is not heavily used for cross-border payments. It's about 2.5% of cross-border payments, whereas the US dollar is around 40%. So there's not really a risk that the dollar is going to be suddenly, no longer king of the hill. That could happen in decades, but for the time being, the dollar is safe. But China does get to, establish leadership that the United States would like to have. China can influence regional use of currencies, including the renminbi. If it were to ever relax its capital controls, cross-border payments in renminbi would pick up dramatically. So the United States needs to get moving. The US is also concerned about whether other countries may adopt China's technology, which would give China a lead there. The US is concerned about sanctions. The ability to impose sanctions depends in part on the payment technology that's available. And you've been hearing, I'm sure, a lot about sanctions in the context of international security situation in Europe recently.
Yeah, certainly something we will be covering. Daryl, we'd love to have you back on the show. Daryl Duffy, Stanford Graduate School of Business, Professor of Finance. Coming up, the analyst who called the housing market peak ahead of 2008 is out with a new warning. Zelman & Associates CEO Ivy Zelman is going to be joining us to discuss after the break. Welcome back to Yahoo Finance Live. The expectation for a March rate hike from the Fed has led to a feeding frenzy in the housing market. So many potential home buyers looking to buy ahead of those hikes. Our next guest called the housing market peak back in 2008 and now says she's starting to see some warning signs in the market. Let's bring in Ivy Zelman, Zelman & Associates co-founder and CEO. Ivy, it's good to talk to you today. Talk to me about what you are seeing right now. It feels like there's a lot of FOMO that's setting in. How frothy do things look from your end?
Well, thank you for having me. Overall, the housing market has been accelerating and actually, which is hard to imagine because it was already pretty red hot, But because of the anticipated backup in mortgage rates, you do see a lot of fence sitters. It's usually 3 months that you'll see a pop in overall activity that then starts to diminish. But I think assuming rates go higher from here, we could see a pretty substantial slowing in the market that we're anticipating, not contingent on rates rising, but really the bigger factor we're worried about is the level of supply that's right now being governed by supply chain bottlenecks. But there's a massive backlog of both single family for sale, single family for rent, what we call build for rent, and there's a massive pipeline of multifamily that if all that product gets completed over the next year and a half, 2 years, we're going to have oversupply causing pressure on home prices. And that's aside from the risk that rates are going to go higher. But happy to drill in a little bit on the rate increase and what it will mean if you'd like.
Yeah, let's talk about that a bit, because if you think about where things stand right now, it kind of feels like the perfect storm. Number one, there's the concern about buying a home ahead of those rate hikes, but also inventory is just so low. So there's not a lot to buy. How much of that you think starts to balance out once we see that first rate hike in March?
Well, first you have to keep in mind that a lot of the momentum we're seeing incrementally is coming from non-primary buyers. And that is, a basket of investors that are private investors looking for diversity from the stock market that plan on buying homes and renting them out, people that are, trying to create cash flow income. You also have cash flowing assets. You also have second home buyers, and you also have institutional capital, fix and flip investors, and what we call liquidity investors like the iBuyers. And they're competing right alongside the primary buyer, and in most cases upfront are using cash. So that momentum has been accelerating really the whole second half of the last 6 months of 2001 and accelerating into 2022. And so the primary buyer, if you recall back in pre-COVID, inventories were at all-time tight levels. But housing home prices, a good year would be up 4%, like 19. So we went from 4% to up nearly 20%. And I think a lot of that was primary buyers in the market, a lot of who we pulled forward. But when we get to a mortgage rate, let's just say theoretically that we start to see a 30-year fixed mortgage rate as high as 4%, we have about 70% of homeowners in the United States that are already locked in below 4%. So if you're locked in at 3 and rates are now 4, it's a big disincentive to move. And we've seen this happen in the past. In 2018, mortgage rates went from 4 to 5 from the beginning of 18 to the end of 2018. They were at 5 and the housing market came to a screeching halt. You also have the risk of the wealth creation that we've had in the market, stock market, whether crypto, equities. A lot of people are attempting to diversify, taking money off the table and investing in residential real estate, and they plan on renting out those homes. So I think the mortgage rate increase will really hurt the primary buyer. Will it slow the investor is another story. That might have to wait for fundamentals to really be impacted by the incremental supply in the pipeline we see coming.
To what extent have the investors coming into the market pushed housing prices even higher? To your point, there's a lot of new wealth that's been created. There's number one, the investors who are coming in saying, look, if you consider just how choppy equities are, there's a better, more stable investment here in property. You've also got new wealth that's being created through crypto and other assets. How much has that, the increase of those buyers, how much have they pushed prices higher?
Well, to just give you some perspective, when you look at historically the trend line of renters that convert to home ownership, pre-pandemic for 3 years prior to the pandemic, it kind of ran about 2.3 million. And by the end of first quarter of 21, we got to over 2.8 million. Now that number has moderated back down to like 2.4 million. So when we look at the incremental demand, we know that that's coming from an investor that was, call it 21% of the market. That's now 26% of the market. And that's not necessarily including all the cash buyers that we're seeing. So I think to think about the surge in pricing, it's very difficult to quantify for you, but we know the impact is moderating renters relative to the peak are being offset by that momentum from the investors. So I would have to guess, if I was guessing to try to correlate the increase in home prices, I'd say it's a pretty substantial portion of the surge, at least within the dynamics that you're excluding the primary buyer. The second home buyer, has also been a big part of this market in the last 2 years. And one would argue maybe the second home buyer is a little stickier because they might be truly looking for a vacation home long term. But do they start to get nervous if home prices are hitting a wall, they've made a ton of money, and they decide that they want to sell now and take their chips off the table because resi's slowing? So I don't know if that really answers your question, but I think it has been a disproportionate part of what has resulted in the surging home prices we're seeing.
So Ivy, what do you tell primary buyers who are looking right now, who are saying, look, I kind of want to take my time a little more. I feel like I'm getting pressured to buy because those that first rate hike at least is coming. Is there, I don't know, value is the right word, but should they be waiting or should they rush in right now, even with low inventory, because waiting for those hikes and the price after those hikes will push things even higher?
Well, you know, I'm a mother of 3, and I can tell you that if you need more space and your current situation, you're paying in rent what would arguably be more than what your monthly payment would be if you were to buy today, then I think you have to make a transition. But if you're not sort of in a have to move mode, then I wouldn't. Because when you look at first-time buyers today, there's going to be a ton of product available coming. And, you know, they call it the winter's coming. But, you know, we have a backlog that's at 2007 highs in single family. If you go into the Southwest, Southeast, portions of the mountain states, the pipeline is massive. And when builders build all these homes, whether it's the for sale or the for rent even, there's gonna be a lot more choices. So I would be more patient unless you have to, because you're just busting at the seams and you can't get, you know, your family is just too big for your home. And you, again, the monthly payment on a relative basis, rent versus own, should be how you're thinking about it.
Some good takeaways there. Ivy Zelman and Associates co-founder and CEO and author of Gimme Shelter, Hard Calls and Soft Skills from a Wall Street Trailblazer. Coming up, will he or won't he? We are breaking down Tom Brady's retirement speculation looming ahead of the Super Bowl and the millions of dollars that could be tied to his decision. That discussion is coming up on the other side of the break. Well, the matchup is set for the Super Bowl with the Cincinnati Bengals and LA Rams punching their ticket to the big event this weekend. For the Bengals, it's the first trip to the Super Bowl since the 1980s. And for Los Angeles, my hometown, I should mention, it is one big home game with the or we should say the city hosting the Super Bowl for the first time since 1993. Let's bring in Josh Schaefer for a breakdown. What all this means from the business side of things. Obviously, I'm partial because I'm always rooting for LA, but this is certainly a big game. You know, a lot of people rooting for Cincinnati, given just the underdog story here, but it's also been really good for ratings for the NFL.
Yeah, the NFL's been crushing ratings so far this playoffs. We haven't seen the preliminary numbers just yet from the conference championship games, but the divisional round set records. I mean, the Chiefs-Bills game was the most watched divisional round game in 5 years. The 49ers-Packers game, which was going back to last Saturday now, 2 Saturdays ago, was the most watched Saturday night programming since the 1994 Olympics, Akiko. So it's been kind of some eye-popping numbers for the NFL. And this comes after ratings slump the last 5 years for the Super Bowl. Last year's Super Bowl was the least watched Super Bowl in 15 years. So I think that the numbers are starting to pick back up for the week. It'll be exciting to see what they did for conference championships and what kind of number the Super Bowl pulls. As far as live events go and the ticket prices, they're already skyrocketing. We've seen that Ticketmaster and a couple of those other sites like SeatGeek, Vivid Seats, StubHub, I averaged those out earlier today. And the average ticket price right now for the lowest, just to get in the stadium for the Super Bowl, is $5,500. Now, when you go and compare that to the last time the Bengals were in the Super Bowl back in 1989, tickets were $100 to get into that game. Even if you were to adjust for inflation or something like that, that ticket price only goes up to about $200. So we're talking from somewhere around $200 probably to get in today's terms to $5,500 to get in. I would say there's demand and people are excited for that Super Bowl to return to your hometown, LA, Kika.
Yeah, Josh, one marquee name that's going to be missing from the Super Bowl, Tom Brady. Of course, we've kind of become accustomed to always seeing him play in the big game, but there's a lot of back and forth over the weekend about whether in fact he's retiring. ESPN first reporting that he had made his decision, and then Tom Brady's agent coming out and saying, no, he's the only one that's going to announce that. What does this mean from a business standpoint if, in fact, the inevitable does happen and he comes out maybe after the Super Bowl and says, look, I'm really finally hanging things up after all these years?
Yeah, from a business perspective, what Tom Brady's doing here makes total sense. And it's not surprising because Tom Brady's proven to us time and time again in the latter part of his career, he is a very savvy business person. And why would he let reporters report that he's going to retire when he has so many of his own means to report his intentions? He has the Let's Go podcast tonight, which is rumored that he'll be on that again on SiriusXM like he is on a lot of Mondays with Jim Gray and Larry Fitzgerald at 7 p.m. And that's now being hyped that maybe Tom Brady will speak. If he speaks, how could he not address the rumors or reports, I should say, from ESPN that he's going to retire? He could also wait and do it on, there's still one more episode on ESPN Plus of Tom Brady's Man in the Arena documentary. We've been wondering, where is that 10th episode? Are they holding it because Tom might retire? What does that mean? I'm sure that would help ESPN Plus subscriptions and draw some viewership there. And then there's also Tom Brady's connection with Autograph too, which is an NFT company. And if I were Tom Brady and most people in the NFT collection space, you'd probably launch a one-of-one retirement NFT when you retire, right? We haven't seen any of that from Brady yet. So I think when he does retire, if it is this year, I would expect a whole media package with it.
I don't think Tom Brady is going to be short on money, right? He's probably getting so many calls even during the season about what business deals he could strike after his NFL career. But getting back to the Super Bowl, I mean, it kind of feels like there's a bit of a passing of the torch, if you will. You know, obviously Joe Burrow just in his second year in the NFL making it to the Super Bowl, but you've also got two millennial coaches facing off for the first time. When you talk about Sean McVay and Zach Taylor as well, what does that mean for the NFL in terms of their ability to bring in a newer audience?
Yeah, I think this is the changing of the guard for the NFL in a lot of ways, and the coaches especially. The younger coaches, Sean McVay, someone that just, I think, looks younger too. He dresses more similar to like a younger person in LA, right? He's got like Lululemon style pants on and his nicely gelled hair and things like that. I think people relate to that to some extent. And, you know, it's been building for a couple of years now. I'll say I met some of these coaches a few years ago at the Quarterback Collective out in Los Angeles, where they hold a quarterback coaching venue, and they coach together out there. And you could see that there was kind of something growing out there. These guys have all been together. Yesterday, Sean McVay coaching against Kyle Shanahan, a coach he's worked with for 10 years. So it's really kind of a fun business story from that sense too. These guys were working almost in a startup-like environment about 10 years ago with these generational type ideas, talking about different offenses and changing the game. And now we're seeing them do that. And Zach Taylor is a descendant of Sean McVay as well, and they're going to be matching up in the Super Bowl. We're kind of seeing that next generation of coaches that had that fun thought process together convert that into Super Bowl appearances.
It's certainly going to be a lot of fun to watch. We've got 2 weeks to talk about it, Josh. We're going to have you back on the show. Thanks so much for breaking that down for us. Coming up, the S&P 500 on pace for its worst month since March of 2020. We're going to be breaking down the latest market action straight ahead. Welcome back to Yahoo Finance Live. Markets looking to round out the month on a positive note after the choppiness we've seen. The Dow up 149 points. The Nasdaq leading the gains here, up more than 300. Let's bring in Yahoo Finance's Jared Blickery for a look at the market action. And Jared, things looking positive now, but if we're talking about the Nasdaq specifically, on track for its worst January ever.
Yes, but that could actually change into the close. And let's go to the Wi-Fi Interactive. I have been charting this all day, also writing up some end of the month stats here for Yahoo Finance, going to be available after the bell on our website. Let's check out the Nasdaq, because over the last 2 days, since Friday, we are now sitting on gains of 5.5%, but the year-to-date total is still 9.88%. Guess what? That was exactly what it was, I believe, in 2008. So now tied for the second worst month. And you know that's going to change into the close. But let's take a look at sector action. We do have a rally, and it's featuring the growth stocks today, particularly the mega caps, and we see consumer discretionary, that's XLY, that is up 3%, XLK up 1.5%, communication services up 1.4%. To the bottom, staples about break even. That's the only thing teetering on the red right now. Also have healthcare and industrials lagging, so the value trade flagging a bit here. But let's just take a look at the year to date. And wow, something really stands out here. Energy up 19%. Everything else in the red, consumer discretionary off the worst, that is down 10%. Well, we take a look inside the Nasdaq, and we are sitting on some nice gains for Tesla, bouncing back. I believe some analysts calling the bottom here in valuation, at least on a temporary basis, liking that stock. It is up 9%. Amazon is up 3%. So one thing I'm noticing is some of the things that have gotten beaten down the most this year are bouncing today. That's not necessarily the best sign. We do have end of month pension rebalancing, and that can be accommodating a lot of flows into stocks right now and out of bonds. So just something to think about as we head into February. This might just be a little bit of noise here. Sorry to pour cold water on the party here. Looking at the travel space, we do have Norwegian Cruise Lines up about 6%, Carnival Cruise Lines up about 4% there, and then the airlines, some of the airlines getting a nice pop. Delta Airlines up 3%. Want to round out the conversation taking a look at Bitcoin and see what it did over the weekend. Not a lot. We had a kind of a scary start to last week. If we take a look at the 10-day price action, you can see we're punching up against last week's highs. So be interesting to see if we can, in fact, move beyond there. Just want to get a quick check of Ethereum as well. Pretty similar situation, breaking to 10-day highs here. We'll have to see if that can continue. Akiko.
Okay. Jared, thanks so much. Coming up, retailers like CVS and Target facing new scrutiny from activist shareholders about their paid sick leave policies for employees. We are breaking down the backlash on the other side. Well, some of the big name U.S. retailers are in the crosshairs of shareholders, including CVS and Target, facing pressure, Jared, from these shareholders to disclose what their sick leave policy is. The FT has a nice write-up on this story today, looking specifically at Trillium. This is the asset management firm that filed a shareholder proposal aimed at CVS, specifically calling on the company to adopt and disclose a requirement that all of its employees receive some paid time off. But CVS, not the only one. Kroger, Target, as well as TJ Maxx getting the same type of proposal from shareholders. And this is an interesting one to me because it comes at a time when we have seen names like Walmart and Amazon cut back on some of the sick leave they offered to employees at the beginning of the pandemic. And of course, we've seen how the pandemic, specifically this latest wave from Omicron, has affected the labor market. We've heard a lot about shortage of employees. What's your hot take on this about whether, in fact, companies should disclose their policy and whether that actually is a reputational risk?
I think it's going to happen. Whether we want it to or not, I think stakeholder capitalism has introduced a number of ideas, and this is just another that it was kind of accelerated a little bit by the pandemic. But now, as you mentioned, companies scaling back on some of those health benefits. Now, paid leave for part-time workers, this isn't something that exists that often in the private market. You can look at Starbucks, a huge exception going back to the 90s. Howard Schultz did amazing things and trailblazed there. But a lot of these bigger companies offered, as you said, paid leave for COVID sickness or for some kind of sickness because of the pandemic and just having to deal with that. And now they're scaling that back. Why did they scale this back? I think in part the CDC giving companies cover to dial back those, some of those days to 5, because that is the new recovery time for COVID. There's a lot of push there. It's saving a lot of companies a lot of money. And so I think reading between the lines, companies are going, or at least certain activist shareholders are going to want to see companies disclose these kinds of things because their employees are potentially not as better off as they were a year ago, which is kind of crazy. So I think this is going to go through. And if you think about it, even historically, why do we have this arising right now? 100 years ago, we still had child labor to an extent, and it's not because people were inherently evil. It's because your children didn't work, you starve. But we're a much richer country now, and so certain ideas like UBI, universal basic income, which seemed inconceivable a few decades ago, now it's rearing its head. So I think we're going to see more of this and more of this play out in the boards.
Jared, I'd be curious to see how much of this pressure ramps up after we get the jobs number later this week, because we heard from President Biden's top economic advisor, Brian Deese, last week, kind of warning about how there could be a bit of a pullback in the January numbers, in part because those workers who potentially were infected with COVID and did not have sick leave, were not paid during their time off. That could skew the data that we're likely to see this month. So certainly that's going to be in focus as well. But I do think it's an interesting one because we've been focused so much on pay and some other benefits, paid sick leave, now really coming into focus on the back of the latest moves here from activist shareholders in CVS as well as Walmart and Amazon as well. By the way, Amazon had 10 days paid sick leave and has reportedly cut it back to 40 hours since then. So they're certainly getting a lot of criticism on the back of that as well. Let's do a quick check of the markets before we let you go. As we said, all three majors in the green right now to round out the week. Coming up in the next hour, though, we've got a live interview with Atlanta Fed President Raphael Bostic, who's going to be joining Yahoo Finance for an interview at 1:30 p.m. Eastern. You certainly don't want to miss that. That does it for me on these 2 hours. Much more to come here on Yahoo Finance Live. Keep it right here.
What a month. Markets wrap up a volatile January, but begin a big week of earnings and eco data, including Friday's job report, with some expecting soft results. Are we done with market shakeups, or does the January barometer signal what's to come? Atlanta Fed President Raphael Bostic does not vote on rates this year, but says if conditions warranted, the Fed could possibly opt for a 50 basis point hike in March. We speak to Bostic in his first post-FOMC broadcast appearance to discuss the way forward. Plus, even as a subvariant of Omicron gathers pace across the U.S., some governors say it's time to turn from a pandemic to endemic approach to the virus as cases start to ebb. We ask a medical expert to weigh in and on the move to clamp down on misinformation. Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor Alexis Christoforous, on this final day of January. And what a month it has been, Alexis. The Nasdaq set for its worst start to the year ever, tied for that position. But for a change, as we come on the air, the major benchmarks at or near session highs.
Yeah, Karina, I think investors won't have a problem saying goodbye to January. We have a nice rally underway now, as you can see there on your screen, but stocks are going to finish the month, a tumultuous month, in the red. The S&P 500, in fact, on course for its worst monthly performance since March of 2020, and the Nasdaq Composite going to be chalking up its worst monthly performance since 2008. As for sectors, winners and losers, we can only talk about the winners because all 11 sectors are actually in the green today. The big winners, you see there, consumer discretionary having a great day as some folks decide to pile money into that sector. Tech having a nice rebound as well. Other big winners today include communication services. We've also got real estate, materials, all on the plus side. And over in the bond market, last I checked, we did see yields moving a bit higher, and they still are. All right, we've got the 10-year yield now at 1.80%. and the yield on the 30-year Treasury at 2.12%. Want to check in now with Inez Ferre for a look at some specific stocks she's got her eye on today. Inez, what's catching your attention?
Well, Alexis, as you just mentioned, the market's at or near session highs. And if we just take a look at a two-day action with the Nasdaq, we're seeing that it's up 5% over the last two sessions. But year to date, as you were pointing out, down more than 9%. Looking at the sector action year to date with the sectors for the S&P 500, we're seeing that really the outperformer, the only one in the green for the month of January being XLE Energy. Looking also at the Nasdaq 100, that's a year-to-date chart, but let's take a look at a daily chart right now. We're seeing the top performers on the Nasdaq 100 are some of the most beaten stocks during the recent sell-off that we saw over the last couple of weeks. We're watching Netflix up more than 10% today. Netflix is higher also after an upgrade to buy from Citi. Also, we're watching Tesla, which is up 10%, nearly 10%. This is after Credit Suisse upgraded Tesla to outperform, saying that the stock is at a good entry point and that the stock should recover from the recent market sell-off, with the analysts over at Credit Suisse putting a price target of $1,025 on Tesla. Year to date, the stock is down more than 12%. Mentioning the electric vehicle stocks, we are seeing the other electric vehicle players in the green today. But if we take a look at a year-to-date chart, you can see some of the bottom performers for the year being some of the companies in the electric vehicle space, which don't have earnings yet or profits yet. They're mostly pre-revenue or low revenue for the time being. So you're watching Rivian down 38% year to date, but today seeing a nice bump. And then just looking at the travel sector, where we're going to end for the month, we're seeing a little bit of a mixed picture for the travel sector. Today, though, we're seeing a lot of green for the travel stocks. Karina, Alexis?
Okay, Inez Ferre, thank you so much for that report. We're going to stay on the markets and bring in our next guest, Matt Maley, Managing Director and Equity Strategist at Miller Tabak. Mac, thank you so much for being with us today. So what a month it has been. But is January just the barometer of what is to come, or have we actually seen the bottom? Does February get any better, particularly as markets now start to sort of factor in 5 rate hikes?
Yeah, that's, well, two things. Number one is that this whole thing about January being barometer, and it is true. I mean, there's no question that January goes the rest of the year. But I mean, in either direction, just think about it. I mean, if you're sitting there this summer and we have some unbelievably great news, you can make whatever up you want, but you can get some really, really bullish news. What are you going to say? Oh my gosh, January was a down year, so I'm not going to buy. I'm not going to buy any stocks. That doesn't make a whole lot of sense. So it's more of a trivia thing than anything else. Having said that, I do worry that we will have lower lows eventually in this market. We'll see bounces along the way like we're seeing today, and I think this one is one that could last for a little while anyway. But the problem is what the Fed is doing. I mean, they're just beginning their tightening cycle, and the biggest concern for me is that leverage, all that stimulus that they added gave investors, especially institutional investors, a lot of confidence to add a lot of leverage. Now that they're tightening, they're going to have to unwind some of that leverage, and only some of that has been unwound. As more of it gets unwound, I think we're going to have to see the market come back in again.
Yeah, Matt, leverage works both ways, that's for sure. I want to ask you where you stand on rate hikes. How many do you see? And do you think that perhaps markets are being too aggressive in factoring those hikes in, and that's leading to markets being oversold? In that case, is this the opportunity to perhaps step in and buy some of the stocks that are on sale?
Well, one of the things we learned is it's 5. Even this, I think Bank of America is looking for 7 rate hikes this year, or at least eventually. And so that seems to be extreme to me. I mean, one of the things is that at some point these rate hikes are going to have an impact on the economy and should slow things down. So I'm thinking more in the 4 rate hike type of situation. The problem is I don't think the market's fully priced that in yet. I mean, a 10% pullback, we got it at the lows last week, and the S&P 500, we're still just barely below 20 times earnings. As interest rates move higher, the justification for a high multiple like that is just not going to be there. So I think that even if rates, I guess my point is the fact that we may not get 5 or 7 rate hikes isn't really a reason to think that we can't go lower. As you just mentioned, leverage works in both ways, and at some point, I think we're going to see more of de-risking and deleveraging to take place.
So then what is your opinion as far as buying into tech? Because it's had a big rout. It's off to its worst start ever, tied for that since 2008 at the moment. But then do you see, the opportunities to buy selectively in the tech sector? Or is that something that you stay away from completely at this point because it's just too volatile right now?
Well, obviously, certain areas of the tech market you don't ever want to completely avoid. I mean, one of the things that's a little too bad is that, like Apple Computer, when they reported their great earnings, it saw a big rally. It's rallying further today, and it's already retraced almost 2/3 of its sell-off already. And so it's like people are really going in after these, the high-quality names in this bounce. The problem is they're still somewhat expensive on a historical basis for themselves. So stocks like Microsoft and Apple and some of these bigger names, I think we'll have to pull back a little bit more, but I think that's going to provide a great opportunity to buy on weakness. Again, I think we'll see lower lows, but corrections are things to be embraced, not to be feared. And but if we do get a few more bounces along here, raise a little cash so you have some money to put into things when they start to throw the baby out with the bathwater later this year.
Matt, we've seen some mixed earnings. We're in the thick of earnings season right now. You mentioned Apple that came in with that big beat, and thank goodness markets reacted. The Nasdaq reacted and got a lift out of that. How important are earnings this week from Alphabet and Amazon that are coming in? What do you need to see to them? How important is the growth margin story? And then do you think at this point earnings have lost some of their ability to sort of shore up and provide stability to market?
One of the things about these earnings that I'm worried about, to answer the first half of your question first, is that the earnings have been, remember last quarter, the earnings were so really, really spectacular. Those were the third quarter earnings that, of course, reported in the fourth quarter. And those numbers, as good as they were, they still, the guidance wasn't enough to raise 2022 earnings. Remember, in the first 2 quarters, after the first 2 quarters, they raised earnings by 20%. It was a big increase. This time they didn't. Now, so far this quarter, nothing has moved up either. So I'm worried that these 2022 earnings aren't going to move higher like they did in the first half of last year. And if that's the case, again, in an expensive market, that's a bit of a concern. However, for the stocks that do report those good earnings, people I think, especially with the high quality names like an Apple, like an Amazon, and like especially a Google, those stocks are going to hold up quite well. They'll do very well. So again, I'm sure we've all heard a lot in recent weeks that it's going to be a stock picker's market. The way these stocks are reacting to earnings, I think, really highlights this, and it's be something that's going to be important the rest of the year.
So then in an environment when growth is slowing, inflation isn't going anywhere, volatility is still very much around, where do we look to help, shore up our portfolio? What sectors are you most interested in? Is it commodities? Is it energy? Where are you looking?
It's interesting. I've been very, very bullish on the commodities since June of 2020, and really bullish on the energy sector all the way since way back in October of 2020, a little bit later that year. So it's been 16 months. Having said that, the group is getting quite extended. Crude oil is getting extended on a technical basis. And as a former trader, I like to look at technicals. And so I think this is a group I don't want to chase right now because it had such a great move. But don't be afraid to buy it on any kind of weakness. I'm not saying sell your stocks at all. These groups should do very well. Hard assets do well in an inflationary environment, and certainly crude oil is one of those areas. The one thing I would mention, though, for people, and again, this is more of a short-term trade, people who got a little bit more risk tolerance and want to make a trade, is look at the biotech area. The IBB Biotech ETF is the most oversold on its weekly RSI chart, Relative Strength Index. So most oversold it's been in 20 years. Now, again, there's, it's an election year. There might be some more issues on drug pricing and things like that. But on a purely technical basis, looks like one where short-term traders could take advantage of to see a nice little bounce here.
All right, trade based on your tolerance. I think that's good advice. All right, we'll have to leave it there. Matt Maley, Managing Director and Equity Strategist at Miller Tabak. Thanks for stopping by today. And you can step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. You can check it out today at yahoofinance.com/plus. Alexis, I'll throw it over to you.
All right, thanks, Karina. Coming up next, we've got some encouraging news about the coronavirus pandemic to share with you. Our medical expert joins us after this short break. Welcome back. Moderna's COVID-19 vaccine has won full FDA approval for those 18 and older. It comes more than a year after the shot received an emergency use authorization, and word that kids 5 and under could soon be eligible for a COVID vaccine. Here with that and more is our health reporter, Anjali Khemlani. Anjali?
That's right, Alexis. We know that Moderna did get full approval today from the FDA, which opens the door for it to basically market its vaccine specifically for those 18 and older and for those 2 doses. It also gives the company an opportunity to ease up on any kind of restrictions that may have faced in shipping the vaccine overseas. So that really pushes it into a really new category, joining Pfizer and BioNTech really in being able to get that global market. Meanwhile, of course, we know that the pandemic continues to really hit a lot of places. We have seen those hospitalizations and cases come down in some of the markets where we saw surges. However, it is important to remember that with that subvariant still circulating, as well as concerns, about where else we might still see surges ongoing throughout the U.S., that tail of the current surges might be a little bit elongated, is what a lot of experts are saying. And all of that to point to the fact that we are still waiting on vaccinations for those under 5. We know that kids are still very vulnerable to this virus, to the emerging variants, because we will still keep seeing variants. It's important to point out. So we did hear from Dr. Scott Gottlieb, who we know is a board member on Pfizer and a former FDA commissioner, telling CBS this weekend that kids under 5 could get their COVID vaccines as early as March. So we'll be waiting to see how that all pans out. Back to you.
All right, Anjali Khemlani, thanks so much. And in some more encouraging news about the pandemic, cases are down in 41 states, including here in New York, and hospitalizations are also down about 10% in just the last week. But there are concerns about the low supply of what experts say may be a game-changing pill, Paxlovid from Pfizer, which is used to treat COVID-19. Joining me now is Dr. Manish Garg, emergency medicine physician and co-founder of World Academic Council of Emergency Medicine, and he is based here in New York City. Dr. Garg, good to see you. I want to get to that Pfizer pill because most Americans are not going to have access to that Pfizer treatment for at least a month or longer. What does that mean in our fight against COVID? And should the federal government somehow get involved to make it more accessible, do you think?
Yeah, thanks, Alexis. Thanks for having me on the show again. So I love the question about Paxlovid. This is really important because for those patients who would qualify, and we're typically talking about patients who weren't vaccinated, this presents at least an option for them so that we can help them to get treatment. Now, you have to make sure you understand that right now a person has to qualify in order to get this medicine, and it hasn't been available in the state of New York City, or in the state of New York for different weeks during the last month. So right now the demand is really, really out there and the supply isn't. But there's been assurances that there's going to be a large supply coming soon. So that's an exciting development for people who haven't been vaccinated. And I have to say that obviously that leads to the most important declaration, which would be that, right now we know it's a multi-layered approach, and vaccination is the most important thing a person can do to protect themselves and their family.
I just want to talk a little bit about what we're seeing here in New York City, where you and I both are, because Mayor Adams said we've hit some good milestones with this pandemic recently. He says 75% of all New Yorkers are fully vaccinated. That's 11% above the national average. Of that percentage, 85% of adult New Yorkers are fully vaccinated. What are you seeing on the ground in terms of new caseloads? Do you believe that we've hit a peak here in this city at the moment, especially with regards to Omicron?
Yes, Alexis, I do really feel that way. So when we get periodic assessments of where we are in our COVID trends, and what we're really seeing is a total decrease in cases, admissions, and our intensive care stays in the hospital. But, of course, just like you mentioned, you have to think about COVID as like a wildfire with its embers. And so there are other areas of the country that are still going through its surge right now. But we've seen a decrease around 10%, just like what you mentioned. And when I'm working in the emergency department at 3 different hospitals in New York City, I'm seeing that too. I'm seeing a lot less folks coming in. Interestingly, the CDC just came out with the data that showed that unvaccinated patients are really the ones who are ending up in the ICUs. And that's something that I'm seeing too. The numbers that they shared are about 1 in 10,000. And if you contrast that with the vaccinated plus boosted patients, they are dying at a rate more like 1 in a million. So the bottom line, counts are going down in New York City, which is great, but the vaccines plus the boost are working and should be a strategy that people are utilizing.
In terms of vaccines for younger people, those 5 and under have not been able to, or under 5, I should say, have not been able to be vaccinated. We don't know for sure, but former FDA Commissioner Gottlieb saying this weekend that he thinks that could be coming as early as March. What would that mean in our fight against COVID? Because is that group, those young folks, are they also contributing to the spread of the virus?
Yeah, Alexis, I think we've spoken about that before. You know, I certainly have a child who's under 5. And so for many families right now with children who are under 5, they do have to protect themselves in a way that other unvaccinated families would have to protect themselves, even if they have vaccinated members. So this would be really, really welcome news for a lot of people. Last I read, though, Alexis, about 20% of people in that 5 to 11 age group haven't really been vaccinated. So in addition to having it available, we really need to do good public health messaging to make sure that parents are in fact giving vaccines to their children. I mean, I can speak from personal stories that my colleagues, most of them are getting the virus not from work, where we're taking care of patients every day, but they're actually getting it from their kids. And so I know a lot of the kind of anti-vaccine in children sentiment really focuses on the mortality, like the death data in children. And thankfully, the numbers are really, really low. But when you think about it, these kids, it's not just about the death data. There's other conditions that they can have, like long COVID. They can have this multi-inflammatory syndrome. Certainly, there are other variants that are out there that are come, and we don't know if these newer variants will have a larger impact on children. So it's really important that they get vaccinated. And it would be welcome news if we can get this vaccine early to that age group. Only thing I'll say, Alexis, also is that right now, Dr. Gottlieb had mentioned that it's important to think about the dose regimen. So the March would be for the 2-dose regimen, which would really decrease any type of death or hospitalization in children, but it wouldn't really quite hit the symptoms. So hopefully they'll be able to get a product out there that matches what we have for everybody else, and that will take care of symptoms plus the death and hospitalization.
You know, Doctor, would love to get your thoughts on some new data showing that vaccination rates for other kinds of vaccines are way down during the pandemic. It seems like if people are getting vaccinated, it's for COVID-19 and they're forgetting about things like Tdap and HPV. What would your advice be to Americans hearing that? Because for some, it might be, you know, I don't want to put all of that in my body. I'll pick and choose the vaccines that I'm going to get during this pandemic.
Oh, yes, Alexis, great point. This is a really, really critical thing. In fact, right now, getting your flu shot, if you haven't gotten your flu shot, it's really, really important to do that. Flu is making a big case and it's making a big comeback. And so that's important. There are other vaccines that are really important for Americans and for people around the world to make sure that they're getting. And it's as I've read it and we've looked at the adverse events, it's actually quite safe to be getting the vaccines, other vaccines, or even around the same time. But if people want to stagger these, sure, if that makes them feel better, it's really important that you speak to your physician about getting these done and getting this through so you're protected against all of the different possibilities. We are seeing other conditions, people coming in with other types of viruses that they would normally be protected against, like the flu virus.
Right. We have to stay vigilant. Dr. Manish Garg, always good to see you. Thanks so much. Karina?
Okay, great discussion there. Thank you. Coming up, the controversy surrounding Spotify and COVID misinformation isn't going anywhere, leading a key player to shift his stance. More on that story ahead. Welcome back to Yahoo Finance. Well, podcaster Joe Rogan is backtracking as the controversy over Spotify heats up. That is, more artists raise concerns over COVID-19 misinformation on the platform. But is Rogan's mea culpa enough? Today, the stock is higher. Here with more is Alexandra Canal from Yahoo Finance. Ali, what exactly is Rogan saying?
You're right, Karina. There's been a lot of developments when it comes to this saga between Spotify, Joe Rogan, Neil Young. Of course, this reached a fever pitch after Young pulled his music from the Spotify platform last week, specifically citing Rogan's podcast for spreading misinformation. Let's start with what Spotify did, because on Sunday, we finally got word from them. They finally addressed all of this noise, deciding to release its platform policies public for the first time. In addition to adding a content advisory to any podcast episode about COVID-19 that will then direct listeners to a COVID hub to stop misinformation. Still, Spotify did seem to back Rogan in their statement, flatly refusing calls to, quote, take on the position of a content censor. Now, for Rogan's part, he did release a video yesterday saying that he does not want to spread fake info about COVID-19 treatments or the vaccine. He only wants to bring different types of perspectives to his podcast, which is the most popular one on the platform, boasting about 11 million listeners. But regardless, that did not stop other artists from coming out of the woodwork and siding with Neil Young in solidarity. Joni Mitchell, Bruce Springsteen guitarist Nils Lofgren, they all vowed to pull their music from the platform. We also heard from Prince Harry and Meghan Markle. They have an exclusive multi-year podcasting deal with Spotify. They expressed serious concerns over misinformation. So potentially we could see more developments there. But as you mentioned, if we take a look at the stock price, it's up almost 12%. So really investors, they don't seem too concerned about what's happening right now. We did get a couple upgrades this morning, one from Citigroup, which upgraded the stock from neutral to a buy. They said Wall Street is being short-sighted when it comes to potential upside, saying they see improvements when it comes to the platform's ad-supported monetization, although they did lower their price target to $240 a share, down from $275 a share. So despite all of this seemingly negative press, investors seem unbothered, and the stock is just continuing to rise.
Yeah, that's what I was going to ask was, what is the long-term outlook for Spotify? This certainly isn't the first time it's found itself sort of embroiled in this controversy.
Yeah, you're right. And Spotify has come down for other things in the past, such as the unfair treatment of artists over compensation. Critics have really zoned in on their quote unquote pro rata model. And within this model, users' monthly fees go into one single pot, and the money is then divided and distributed based on the total number of streams, with Spotify receiving roughly 30% of subscribers' total fees. So critics of that model say that this alienates smaller bands that don't have the backing of a big label. It takes the power away from the consumer, where they can decide where they want their money to go. And it was also created at a time when streaming was really an unfounded model. Fast forward to today, streaming is increasingly popular. It has just skyrocketed in popularity, with paid subscription streaming revenues rising 18.5% in 2020. That number is expected to go even higher and come in even higher for 2021. And Spotify leads the way in terms of market share, capturing 31% of the market. In second place is Apple Music, which has a market share of about half at 15%. So since Spotify is a leader here, it's automatically going to have a target on its back. But I did speak with one expert in the streaming field, Ola Sars. He's the CEO of streaming company Soundtrack Your Brand. He developed that with Spotify. And he said this really represents a grown-up turning point for the company. It's transitioning from a streaming company to an audio and media global powerhouse. And with that, they're going to have to address these types of situations. If we take a look at some of the other big tech firms, like a Netflix, for example, that company has dealt with its fair share of public scrutiny, from the Dave Chappelle controversy to the Cuties backlash, and yet has come out relatively unscathed on the other side. So I think unless we see a big name, social media driven younger artists like Drake or Ariana Grande drop drop out of the platform and decide to pull their music, I don't think we're going to see a major hit to the stock. I think artists understand that streaming has become increasingly important. It's just ballooned the value of songs and records. That's why we're seeing these sky-high valuations for publishing and copyright deals. And if you're an up-and-comer, you certainly want to be on Spotify to have that exposure. So, I just think this was really a business decision for Spotify. Spotify listeners have clearly connected with Joe Rogan, especially since it's the #1 podcast on the platform. Now, the consequences of that decision largely remain to be seen. But again, the stock up nearly 12% today.
Yep, and Rogan and Spotify both hoping that apology was enough. We'll leave it there. Yahoo Finance's Alexandra Canal, thank you so much. Alexis?
All right, thanks so much, ladies. And coming up next, a conversation with Atlanta Fed President Raphael Bostic. So stick around. Hello, everyone, and welcome back. Our Fed correspondent, Brian Chung, has a very special guest now. He is being joined by Atlanta Fed President Raphael Bostic. Brian?
Thanks so much, Alexis. Obviously, a lot of attention paid to the Federal Reserve with regards to the possible policy tightening over the course of 2022. So let's talk about this a little bit more with one of those key policymakers, Atlanta Fed President Raphael Bostic, joining us, of course, from Atlanta. President Bostic, happy Monday to you.
Happy Monday to you too, Brian. It's good to see you.
Great to see you too. So let's get right into it. Over the weekend, you made some remarks to another news outlet talking about the idea of the possibility of a 50 basis point hike from the Fed. I guess I'm just wondering if you could kind of very quickly elaborate on whether or not you meant that's your preferred policy setting for the next meeting in mid-March.
Let me just say, first of all, that's not my preferred setting of policy action for the next meeting. Really, when I started looking at this year, I had three moves, 3 rate increases in mind, and March increasingly was looking like it's the right time to do that. But the other thing that I've been very mindful of is that the economy has been a surprise to us and a surprise to the upside repeatedly in ways that has left me really just observing how the world works and keeping my options open so I can adapt my policy to what the world tells me is happening. So I just think it's really important for people to know that we're not set, or I'm not set on any particular set progression in terms of policy, and we're going to let the data and the evidence really guide us in terms of what an appropriate action might be.
Thematically, that kind of fits with the nimbleness that the Fed chairman was talking about in the press conference last week. But at the same time, you have market watchers that are trying to figure out how many rate hikes we should expect over the course of 2022. And it seems like now the prevailing expectation is for 5 rate hikes over the course of this year. And some, we had Ethan Harris from Bank of America on earlier saying possibly 7 this year. Do markets have it right?
Well, you know, a lot's going to happen over the course of the year. Right now, in my estimate, I've got 3, but there's a lot of data that's going to come in, and I'm assuming that those other forecasts have thoughts about what's going to happen in terms of inflation and what's going to happen in terms of job growth, and that's going to inform how policy plays out. You know, for me right now, I'm just staying laser focused on the next meeting and trying to see what the data is telling us about the trajectory of inflation for this first quarter of 2022. And what impact that's having on jobs and employment. That'll tell me what's going to happen for the next meeting and give me a hint toward the one after that. You know, what the long arc looks like, I think it's really hard to lean in too much on that at this stage.
So let's talk about optionality, because the Fed chairman used the word steadily, and you have Fed watchers obsessing over the difference between steadily and gradual. But I spoke with your colleague in Minneapolis last Friday who said he could see the case for perhaps, raising interest rates and then taking a pause after that to assess where things go. I mean, I guess all of this depends on how much of a hawk you might be. I know you're an avid bird watcher, so would you describe yourself as like a peregrine falcon hawk here, or more of like a red-tailed hawk here? How would you describe what you would like to see over the course of this year?
Well, I think of myself more as terms of an owl than a hawk personally, but what I would say is, look, the goal here is to move us off of our emergency policy stance of maximum accommodation, and also to try to push back on this inflation that has really elevated to levels that we haven't seen for quite some time. And how that plays out and the exact path of that, that's something our committee is going to sort of work with and work on. What I will tell you is that I'm at 3. When I started thinking about 2022, I was at 1, and that was going to be in the summer. As the economy's come back stronger than I expected, and inflation has gone up faster and more persistently than I expected, I've increased the number of moves I think is appropriate, and I've pulled them forward. So for me, I think we're going to need to be thinking very carefully about sort of how things are going, watch how the economy responds to our first move, to make a decision to give us information about what should happen in the next meeting and the meeting after that. I think the message that the chair was trying to offer, and that I would say as well, is we're not set on any particular trajectory. The data will tell us what's happening. And once the data come in, I think our decision for each meeting for the rest of this year will be clear.
An owl, I like that. I'm writing that down. Let's just switch to your overall outlook on inflation. Obviously, as the Fed starts to tighten policy, the idea is hopefully that would get inflation down later this year. What do you expect, or when do you expect to see some of these eye-popping numbers start to come down?
Well, I would say for me, for this year, I've penciled in a 3% inflation for the entire year. But we're going to have to see what happens over the next several months. I'm still seeing elevated housing prices. That's going to really make it harder for the baseline numbers to fall in a dramatic way through the course of this year. But all that said, I'm hoping that we're going to start to see supply chains ease. Some of the labor market tensions and shortages kind of relieve themselves as we get further on into the year. So I'm hopeful that by the end of the year, we will see a significant drop in inflation. What I'm really hoping for right now, though, I'm just going to say that, we've been seeing month-over-month inflation levels somewhere in the 0.5 percentage point area. I'm hoping that by the late spring or early summer, we can get that down to month-to-month changes in about a 0.25% range. If we can do that, I think that I won't have to adjust my policy viewpoints or forecasts in any particular significant way.
It seems like directionally, the worry is that inflation will not come down faster than expected. That's because of the raising expectations we've heard from you and your colleagues. But I guess on the other side of the coin, what happens if inflationary numbers actually come down faster than you expect? What would the policy implications be in that case?
Well, I'm glad you asked that question because, the data can go in one direction or it can go in the other direction. And I would expect that for me, I would adjust my policy to maybe not be as aggressive in terms of raising interest rates if it comes in and inflation responds very, very quickly. That's not what I'm expecting, because when I talk to business leaders, what they're telling me is that they've got some things priced in for the first half of this year that they're pretty sure they're still going to work out and put into place. So I'm not expecting inflation that's going to come far, far below what I'm hoping will happen in the first half of the year. But if that happens, I think that'd be good news for all of us, and it would give us some time to pause and see sort of how other parts of the economy are working.
All right, well, inflation obviously part of the price stability mandate, but want to explore the labor market side of the mandate with the Fed also trying to prioritize maximum employment here. But we're going to take a quick 2.5-minute break. We'll have more conversation with the Atlanta Fed President Raphael Bostic on the other side of this quick break. We'll be right back. Welcome back to Yahoo Finance Live. Again, we're joined here on the program by Atlanta Fed President Raphael Bostic for a conversation on Fed policy. President Bostic, we were talking about inflation before the commercial break, but now I want to shift over to the labor market. We are expecting a new print on the employment situation this week. What are you expecting out of that report?
Well, I'm expecting that number to probably come in a little lower than what we've seen for the last several months, because the impact of Omicron has been real. And it has created some tensions in terms of employers' ability to fill the positions. And I think that's going to reflect itself in this first number. I would say, though, that it's not my expectation that impact of Omicron is going to really last and persist for some time. And I'm hopeful that we're going to see a rebound in labor markets in the February and March reports. And that would be very consistent with what I've expected. The other thing I would just say in terms of labor markets in general, the rebound in labor markets has been incredibly strong by historical standards. And that should be very encouraging. And everything that I've heard from the contacts that I talked to across the 6th district are that they are still expecting strong hiring, a robust labor force growth through at least the first half of the year. And I think there's a lot of momentum that will be positive and that will sustain.
So let's talk then about the risk of Fed hiking. I mean, is there a risk that as you do this, it could actually raise unemployment in the process? Because I think it ticked down to 3.9%, which was below any projection that either you or your colleagues on the FOMC had in the December projections.
Yeah, I'm not really worrying about that too much at this point. You know, from what I've heard, the constraint on labor and hiring is really on the supply side. And when you think about the supply, the thing I try to tell people all the time is we are still in a pandemic economy. And so there are many people who are on the sidelines for virus-related reasons, either because their child care centers are no longer there, there's uncertainty about schools or senior care, and we still have a number of people who have just decided to retire, and that more than 1 million people have that, and they're not sure whether they're going to return or not. And so a lot of that's going to sort itself out independent of our policy. And to me, I'm expecting as we get more clarity with the virus, more normalcy in terms of people being used to living with it, we're going to see a number of these people who have not returned to labor force come back in. And I think that'll keep some momentum in terms of job creation through the economy.
So let's shift gears. We had talked a lot about interest rate policy at the beginning of this interview, but obviously the balance sheet is also a big part of that. Your colleague in Kansas City, Esther George, speaking earlier today about the importance of those two things working together. The Fed began the process of talking about and laying out these principles for how the Fed might eventually allow its nearly $9 trillion in holdings to actually decrease. How would you like to see that process unfold? And do you have a preferred time for when you would like to see that process begin?
Well, I think in terms of your second question, let's get a few of our interest rate moves in order, see how the economy is responding. And then after we've moved away from zero, I think it'll be time for us to start reducing the size of the balance sheet. Look, we increased the balance sheet far more dramatically than we did in any of the previous rounds because the crisis that we were facing was more significant. As fast as we increase it, I think we should be thinking about decreasing it faster than we have in the past. The economy is stronger, and we have that previous experience that gives us some guidance as to how markets are likely to respond as that balance sheet shrinks. So I think we can be more robust in terms of how we do that, and trying to get that underway as soon as possible would be my preference. Now, of course, we're going to have to see what the data say as interest rates start to move, but if the economy appears to still be strong and have some momentum, I'd say let's get that balance sheet to start to shrink and get back to a more normalized level.
Is there any interaction between the balance sheet and what you plan on doing with the balance sheet on long end rates? Because there's been some chatter about some doubt in the yield curve about the ability of the Federal Reserve to raise interest rates without inverting it or perhaps inducing the next recession. Are you gleaning anything from the fact that spreads between the 2 and the 10-year have narrowed considerably over the past few months?
Well, they have narrowed. I think partially because there's still a lot of uncertainty about how things are going to play out over the next several months. Look, we have in our balance sheet the ability to affect the rates at the longer end of the yield curve. And it'll be my desire to see that we make sure that the interaction between interest rates and our balance sheet moves occurs in a way that does not accelerate the flattening of the yield curve, but rather gets into a much more normalized trajectory. We have been for the last 2 years in really an unprecedented space. And as we go back to a more normalized policy posture and our society gets used to living into a new equilibrium with the virus, my hope is that all of the policies returning to where they were will get the yield curve to look the way it has historically as well.
Well, but I guess the concern here, though, is that people are worried that the next economic downturn that we'll experience will be Fed-induced. So I guess, do you have any concerns that the Fed could tighten, just broadly, interest rates and balance sheet policy, actually tilt us into the next downturn?
Well, I would say I'm always concerned about that. So as a general matter, that's something that I do worry about. But I do think that as we look at the economy and the situation that we have right now, the economy is far stronger than it has been during any of my time in this role, and certainly during any of the recoveries that we've been trying to navigate our policy through in the recent memory. So I think for me, the risk that our policies are going to lead to a contraction in the economy, I think they're relatively far off. But as I said at the very beginning, my job for the next several months is going to be to really observe the data, scour it carefully, go and leverage my team that is out talking to business executives on a day-to-day basis about what they're seeing and what the tensions are, and then discerning whether the risk that contraction is coming is going up. I will say, I'm not hearing that from any of my contacts right now, and I don't think the data is saying that in any way. So for now, that's not forefront in my mind, but I'm a central banker and central bankers get paid to worry. So it's something I'll be looking at and taking stock of over the next several months.
And last question here, down in DC, there are 3 candidates for Fed governor spots that will be getting a hearing in the Senate Banking Committee. And it's important because there could be the first Black woman to ever serve as a Fed governor in the central bank's over 100-year history. As the first Black president to head a regional reserve bank, are there any views that you can share about diversity within the functions of the central bank?
Well, I will just tell you, for me, diversity has really, throughout my career, helped my work be better. By having my ideas and my thoughts get challenged by people from different viewpoints and different lived experiences, it leads to different considerations in terms of what an appropriate way to characterize a problem is and what possible solutions might look like. So just speaking from my experience, I would expect this new diversity, to the extent that the 3 candidates do get confirmed, will lead to some different types of conversations and potentially some very, very interesting deliberations about how policy should move forward and whose factors or whose lifestyles or experiences we might be overweighting or underweighting. I think there's a lot of potential there for very interesting conversations.
All right, Atlanta Fed President Raphael Bostic, the self-proclaimed owl of the FOMC. Thanks so much for joining us on Yahoo Finance this afternoon.
Very good to see you, Brian.
And I'll toss it back over to you, Karina.
Yeah, absolutely. And again, that was Raphael Bostic, Atlanta Fed President, in his first post-FOMC broadcast interview, speaking to our Yahoo Finance's Brian Chung. We've got much more market action ahead. Stay with us. We're going to take a quick break. Welcome back to Yahoo Finance. Well, let's get you a quick check of the markets before we end the hour and what's been a rare upbeat day for the markets to end the month. Still, the S&P bracing for what could be its worst month since the start of the pandemic. Markets now rejiggering, factoring in 5 rate hikes by the Fed this year. So looking at the major benchmarks, they're all at about session highs. The Dow is higher there by about 212 points. The S&P is better by 54 points. The Nasdaq, the big winner there, up by nearly 2.5%, up by 335 points. Sector-wise, all in the green right now. Consumer discretionary and tech among the big winners. Healthcare was in the red, but has turned green, but among the laggards, along with consumer staples. Over to the bond market and take a look at what yields are due. First, we can take a look at the Dow laggards. We see Walgreens and Visa among those, and then over to Treasuries, we look at the 10-year and see that it slipped a little bit, now down at 1.78%. And then also the 30-year now positive, up by 2.10% there. And then just to get you a look at the Dow winners, some of those include Boeing, Salesforce, Disney as well as Goldman Sachs and Apple. We still have much more market action ahead. We're going to take a quick break, but on the other side of it, we'll take a look at some of the extra steps that companies are taking to make sure that they retain talent, as well as take a look as whether cryptocurrency might be the best way to go when it comes to your paycheck. Stay with us.
So much for the January effect. Despite today's rally, the S&P 500 is about to close the book on its worst monthly performance in nearly 2 years. What will it take to get the bull market back on track, and where are the pros putting money to work? New York Congresswoman Alexandria Ocasio-Cortez goes on the record with Yahoo Finance about the economy and why she says price gouging is what's fueling inflation. And from famous athletes to big-time politicians, more high-profile people are ditching the dollar and choosing to get all or part of their salary in cryptocurrency. But did they factor in a crypto crash? And what's their compensation worth now? Hello, everyone. Welcome back to Yahoo Finance Live. I'm Alexis Christoforous here with Karina Mitchell, and taking a look at the market. Today alone barely tells the story, doesn't even start for the month of January. We know it was a tumultuous one for investors, the market looking at its worst month in a couple of years. But today, at least, we're seeing some people cherry pick and pick up some bargains. The Dow now at its best level of the day, up better than 230 points. The S&P 500 rallying 57. We've got the Nasdaq having an incredible bounce back day, up now more than 340 points. Every one of the 11 sectors in the S&P 500 on the plus side, with consumer discretionary and technology leading the advance. Let's get some stock-specific news now and check in with Inez Ferre. Inez, I know you have your eye on Sony. There was some breaking news today. They're making a big purchase in the video games space. What can you tell us?
That's right. As that video game space continues to consolidate, Sony will be buying Bungie. This is an independent video game maker for $3.6 billion. The announcement comes in the same month that Take-Two Interactive announced that it's buying Zynga for $12.7 billion. And also weeks after Microsoft announced that it will be buying Activision Blizzard for almost $69 billion. Now, the irony of all of this is that Bungie is a company which is known for its games Marathon, for Halo, and its original Halo game had really put the Microsoft's Xbox on the map, because Microsoft had acquired Bungie back in the year 2000. In 2007, Bungie said it was splitting off of Microsoft and becoming a private independent company. So that's ironic, because now Bungie will be part of PlayStation Studios.
And as you say, Tesla stock is racing ahead today amid an upgrade from Credit Suisse. Analysts saying there that the stock checks all the boxes and it's a good entry point.
Yeah, that's right. With Tesla seeing gains today of more than 9% that we can look at our Wi-Fi interactive board. And the analysts there, Dan Levy and Trevor Young, are saying it's an attractive entry point, that Tesla has been caught in the sell-off and the overall market sell-off that we've seen recently, and that the stock will recover. He also says that Tesla checks all the boxes, talking about Tesla being a leader in the transition into electric vehicles, that Tesla also is a front runner when it comes to legacy automakers that have been investing heavily in the electric vehicle space, writing in the race to an EV world. Tesla remains in the lead. Also, the analysts saying that Tesla has surprised to the upside when it comes to margins, and they expect those margins to continue. Now, it has been volatile for Tesla and other growth name stocks. So Tesla down year to date 12%, but today seeing a big bump.
And finally, Inez, I see that Robinhood is still a favorite for Cathie Wood and her ARK investment. I know Robinhood had a tough day on Friday, and she bought up a lot more shares.
Yeah, that's right. She bought shares when Robinhood reached new lows. In fact, let me pull it up in our meme chart here. Now, Robinhood's not really considered a meme stock, but it is sort of a proxy when it comes to a retail trading. Robinhood today seeing a 10% gain. Cathie Wood's ARK investment stepped in and bought some 2.44 million shares of Robinhood. And if you just take a look at, I'm going to pull up a 3-day chart, you can see here that on Friday, it reached a new low, trading below $10 a share for the first time. And then it spiked higher. And Robinhood, though, year to date is down more than 20%. It's down more than 60% from its IPO price, or around 60% from that IPO price. Cathie Woods is a fan of Robinhood. She bought shares of Robinhood around that time of their IPO in late July. I also want to mention that Citi has lowered its price target to $24 on Robinhood from $51. We have seen analysts, since Robinhood had reported its quarterly results last week, where revenue missed, its first quarter also guidance missed street estimates. So analysts have been lowering their price target. The average price target for Robinhood prior to its quarterly report last week was $29 a share. Right now, that's at $21.60 a share. So certainly seeing one downgrade and some price target decreases.
All right, Ines Ferre, thanks for that stock roundup. Let's stick with the market and welcome in Lauren Hill. She is a consumer retail analyst and large cap value portfolio manager at Westwood. Lauren, good to see you. You know, I started the show by saying, what January effect? Usually we see investors put a lot of money to work early in the year. Do you think it might just be delayed a bit and we might see a February effect?
That's a great question. I'm cautiously optimistic. I think the U.S. consumer, which is the primary driver of the U.S. economy, responsible for 2/3 contribution to GDP, remains on really solid footing. Naturally, we are going to see less spending this year. I think January was tough for a number of reasons. Within consumer discretionary, we were lapping the stimulus that we received last year in January, so that was missing. I think as people look ahead, that other stimulus check came in April. That'll be missing again this year. So, I think things are going to shake out and renormalize. The Fed's making the necessary moves. So, we're going to have some volatility for a while, but I don't know if February will be the month, but I think it'll work out for the year.
Earlier we had Matt Maley on from Miller Tabak, and he was talking about how he thinks this is really going to be a stock pickers market for most of this year, and wouldn't be surprised if we saw another leg down for this market of at least 10%. Would you agree with him?
Yes. So I think it's difficult to call the very next move in the market, but I definitely think there's risk to the downside, and that there is a huge advantage that active management has right now to kind of cherry pick and stock pick and differentiate between the names. In an up market, it's easy to just passively invest, but now is the time to kind of sharpen your focus, sharpen your pencils, and make sure that the companies that you're investing in are that high quality and still a very good value, and have those very powerful forces behind them that are going to help carry them forward on a fundamental basis.
And in terms of that cherry picking, what are some things, a company sort of has to have as you, as a portfolio manager yourself, as you sit there and sort of tick through the boxes? What are you going to be looking for in particular, this quarter and next?
Yes, absolutely. I think there's a number of themes for 2022 that are important to pay attention to, when looking at the consumer. So a few of those, I think that the higher income consumer has the advantage this year. So I think that the savings are running out for lower income consumers. And while they have adequate borrowing capacity, we are starting to see credit card loan growth pick up. Last week, in fact, Capital One showed their U.S. card balances up 10% year on year. The higher income consumer still has excess savings left over from the pandemic, and they also have a positive wealth effect from both the higher equity markets this past year and also greater home values. And so that tends to boost spending 6 months later. So I think that side of the market is going to end up holding up a little bit better. Another theme is kind of the location and focus of the business. So I think U.S.-centric companies are going to fare better this year than, say, those that have more international exposure, or in particular China exposure. We're much closer to an endemic state here in the U.S. Omicron's fading, and I think we're on the very beginning of seeing a very dramatic shift in consumer behavior and where they're spending their money, which kind of ties into kind of the next theme, which is experiences over stuff. The last 2 years, we've been very, very focused on spending on goods and items, all trapped at our houses and not able to get out as often as maybe we would like to. And now I think that restaurants and hotels and those experiences and getting out and vacations and all of those things are coming. And I think that we're going to see a move in that direction. So that's something else really important to kind of pay attention to, as we move through the year.
Yeah, I'd throw cruise lines in there too for under experiences. So then what do you do with the stay-at-home trades that did so well, during the height of the pandemic, and we've seen have taken a big hit. I mean, does Zoom ever return to its record high we saw at the height of the pandemic, or even a stock like Netflix or Peloton, which we know has some of its own unique problems? But what do you do with that stay-at-home trade now?
Yes. So I think there's a natural skepticism for the COVID winners right now. So you have to be extra careful when picking those, but they won for all different reasons. Some companies were able to pull forward demand, but now that demand's kind of going away or falling off. Other companies actually really expanded their customer base, and they brought in a lot of customers that are very loyal to them, that discovered their products. And I think they're going to be able to hang on to them. And so once again, going back to the idea that this is a stock picker's market, it depends why you're a COVID winner, whether or not that's going to translate into ongoing strong sales and earnings beats, or if your best days are behind you. And as the economy continues to reopen, you're going to give all of that back.
Earlier we had an interview. Our Brian Chung did a sit down with Raphael Bostic, the Fed president, the Atlanta Fed president, and it was a far-ranging interview. But one of the things he said that stuck out to me was he said he's still seeing elevated housing prices, and he said that might make it harder for the baseline numbers to fall in a dramatic way through the course of this year. What do high, real estate prices mean for the consumer, but also for inflation as we move further into the year?
Yes, it depends on which consumer you're talking about. Obviously, homeowners are benefiting from that, are going to have greater confidence and be willing to spend more. That positive wealth effect is going to carry them forward. And then for many others, rents are up double digits. That there's also heating costs are up. Food costs are up, gasoline costs are up, medicine's as expensive as ever. And so people are feeling the pinch of inflation and are going to look to either trade down and spend less for the same items, or they're going to do without altogether for maybe some larger ticket items and things to, keep their budget in check. So it will affect everyone differently.
For sure. All right. Great insights there. Lauren Hill of Westwood. We appreciate your time. Karina?
Yep, great discussion there. Okay, coming up, amid the big quit, one firm is thinking out of the box when it comes to vacation time to help retain talent. More on that story ahead. Welcome back. Well, like many sectors, the legal industry is also finding it challenging to attract and retain staff. Here with insight on how they've been reevaluating talent recruitment and retirement and retention, rather, is Joshua Klatskin, Goodwin Private Equity Partner, Business Law Department Co-Chair. Thanks so much for being here, Joshua. So one of the things that you're doing is introducing tiered vacation packages. And I'm wondering, is that something that's unique in your industry? Is there any precedent? Is anyone else doing it? And then why vacation packages as opposed to just raising compensation?
Well, thanks for having me. Yeah, we believe we're the first people in the industry that's done this, and we've raised compensation. We've matched compensation with all of the industry leaders. But for us, vacations are different. Vacations are both a cultural touchstone that we want people to take time off, to be well, to think about themselves. And it was much more meaningful to us to provide someone with the opportunity to take time off and to help them do that than to just throw another $10,000 at them. We think that this really speaks about our values as a firm.
Joshua, what's sort of the turning point for you as a law firm to sort of pivot in this way? Because I think when we all think about lawyers, we immediately think of long hours, and that's sort of almost like a badge of honor to be a member of the industry and to work those hours. So explain to us why you've made that change within the firm.
Well, we've been lucky that we have great clients that have given us a lot of work, and our lawyers have been working harder during the pandemic than they ever have before. And from our perspective, as counterintuitive as this may seem, we want people working less hours. We want people, when they come to Goodwin, to be coming here for their future. It's not about 1 year or 2 years and having people be burned out. We want people to develop into their best selves and to really put themselves in a position to meet their professional aspirations. And doing that involves time off. So to the extent that we can facilitate that time off and we can help them take the time off, not only by paying for the vacation, but by planning it as well if they choose to take advantage of that service, we think that we can make them have a more well-balanced life that will ultimately lead to a longer and more productive career with us.
And as you've sort of been going through and reevaluating and taking this holistic approach to the people that you hire, when you do speak to people, prospective people who you want to bring on board, what are the things that matter the most to them? Is it time off? Is it compensation? Is it flexibility? What have you learned?
Really, it's the flexibility and it's the ability to create relationships. That there's a lot of great firms that all offer similar compensation and similar opportunities to work with great clients. But really what makes us different is the people and the culture and the ability to form relationships with those people and become a part of the culture. So we very much want to, and the vacation program is not a one-off program. It's part of a much broader Goodwin experience that we are rolling out, where we are committing to double down on our relationships with our people. We recognize we've grown a lot during the pandemic. People have worked very hard during the pandemic. And as we come out of it, we really want to make sure that we're investing as much in our people, in our relationships with our people, as we do in our relationships with our clients. We think that will lead to a happier, more productive group of attorneys, and they will do better work for our clients and stick around with us longer. We'd love everyone to stay here for as long as they possibly could.
So Joshua, I know that a place to find entry-level talent, of course, is law school, and lots of firms offer internships for law students in between their second and third years. And oftentimes those internships are in person, and it gives you an opportunity to actually observe them in the work environment. I'm wondering what the pandemic has done to that sort of dynamic for you, and how have you been able to find new talent?
So we're still recruiting with our summer associate program. We had about 100 summer associates. We have another 110 coming this summer. But the difference is it's been primarily, if not exclusively, remote. So the same way that we had to adapt with our day-to-day working environment with our full-time attorneys, we've had to do it with the summer associates. That's required us to be creative. It's required us to really find opportunities outside of just the workflow, to connect with people, to get to know the summers, to let them get to know people at the firm, and really ensure that this is the right fit for them. And we've been lucky that it's been so successful. Our class of 2020 has started, meaning the students who were summer associates remotely during the summer of 2020, and they have integrated and gotten off to as great of a start as the summer associates who spent time with us in person. So we feel like we've got a good mix on that, but of course, we very much want to be back in person, both with our summer associates and with our full-time attorneys, and are hoping that this summer will be an opportunity for that.
And Joshua, one thing that recruiters say is that applicants are very interested in wage transparency, right? They want to know what the minimum and maximum possible, wage is for a position. There's a law about to go into effect in New York City to that effect. And I'm wondering, is that something that you support within the rank and file at Goodwin? And more broadly, do you think that that's a good idea to help attract and then retain talent as well?
Well, our wages are open and well known. We've got a structure like every other large law firm, where as associates move up the rank in terms of seniority, the wages go up accordingly, and the bonus scale goes up as well. So we do let all of our associates know what our bonus scale is every year. We let them know what the top of that scale is for people who outperform and actually can achieve above this scale. And so we actually think we've got pretty good transparency, and this is an industry where everyone tends to know what everyone else makes.
All right, we will leave it there. Joshua Klatskin, Goodwin Private Equity Partner and Business Law Department Co-Chair. Thanks so much for stopping by and your insight.
All right, coming up next on Yahoo Finance Live, an exclusive conversation with New York Congresswoman Alexandria Ocasio-Cortez. So don't go away. Welcome back, everybody. Yahoo Finance's editor-in-chief Andy Serwer sat down recently for an exclusive interview with New York Congresswoman Alexandria Ocasio-Cortez, and he is here joining us now. Good to see you on the show, Andy. So I know you covered a lot of ground here in this conversation, everything from capitalism to the economy and inflation, right?
Yeah, and I wanted to ask her about inflation, Alexis, because Jay Powell had just had this Fed meeting in the press conference. And of course, the world was just talking so much about inflation and raising rates. And I asked her about that situation and the fact that Jay Powell seemed to suggest that wage inflation was driving inflation, necessitating him to raise rates. And I asked her about that. Take a listen.
I think particularly when we have this conversation in the context of inflation as well, it's really not just labor, it's not just rising wages, but there's a lot of different dynamics that I think are contributing to the increase in prices, whether it's supply chain complications, yes, labor issues, but sometimes lack of labor, a lack of the ability to be able to work consistently in their jobs, which is also tied to pandemic controls. And also, there's a real distinction to be made between inflation and price gouging. And there's a lot of evidence that particularly industries with high concentrations, corporate concentrations, whether it's almost oligopoly level industries, a lot of these price increases are potentially due to just straight price gouging by corporations.
Are you concerned about inflation and higher interest rates and the impact on working people?
I mean, wherever prices are increasing and it's making it difficult for someone to be able to feed their family, that is always going to be a major point of concern, a primary point of concern. But the real key is making sure that we're diagnosing the causes correctly, because the danger here is that if we say we're helping working people too much and say that the cause of this is, oh, it's because we provided too much assistance during the American Rescue Plan, stimulus checks were too generous, that is why we are dealing with the problems that we're dealing with now. What that's going to result in is a pullback in the assistance that some families need the most right now. And when we already talk about the cessation of the child tax credit with the failure to pass the Build Back Better Act before the end of last year, we really need to be very careful about diagnosing these issues correctly. Because on the flip side of that coin, if we say there are real antitrust issues here, there's a lot of corporate abuse of power leading to price gouging, then that allows us to pursue lanes such as antitrust and also pursue labor protections, COVID protections that can help people get back into the workplace and stay safe in the workplace.
Right, and so you are seeing those who are suggesting that it's because of the assistance that people had during COVID that's inflationary, and therefore we need to swing the pendulum back.
Yeah, and I couldn't disagree more.
Right.
I couldn't disagree more with that assessment.
You know, it's really fascinating to hear this particular perspective, because you don't hear people talking about inflation being caused by price gouging, you guys. So that's her perspective, and whether or not you agree with it, it's up to you, but it is a different way of looking at things.
Now, Andy, this is Karina. I want to switch gears for a quick second, because the two of you also talked about the retirement of Supreme Court Justice Stephen Breyer. I'm wondering, what did she have to say about what President Biden should consider as he decides who should fill that vacancy?
Well, that's right, Karina. And I mentioned to her that, of course, President Biden has promised that he will attempt to fill this seat with a Black woman, and asked AOC what she thought about that and what else she was looking for in this prospective justice. And she said, well, that's a great point, because identity is just a starting point, and that it's very important that this justice, meet requirements when it comes to concerns about working people, and also when it comes to, voting rights and a whole host of other issues that she enumerated. So in other words, sure, it's one thing to have someone coming from this certain constituency, but even more important are those persons' views and how they would vote.
Okay,
all right,
Andy,
Andy, sorry, Karina. Thanks so much, Andy. And we look forward to watching the rest of that interview. You can do that on the latest episode of Influencers. It's going to be airing at 4:30 p.m. Eastern right here on Yahoo Finance. Karina?
And coming up, it has been a big month in the energy sector. We'll get a check after the break and tell you how crude oil settled. Stay with us. Oil rose today to close out the month amid supply shortages and as political tensions continue to rise. Here with more on all of that, let's bring in Yahoo Finance's Ines Ferre and for a check on how crude settled. Ines.
And Karina, WTI March future settled at $88.15 a barrel. We are looking right now at those futures on our Wi-Fi interactive board. We're also taking a look at Brent futures up more than 1%. Oil seeing its biggest monthly gain now in almost a year. And Brent crude is up, seeing its biggest monthly gain since February of 2021. I do want to mention WTI as it hit $88 a barrel. That's the highest level since 2014. WTI rounding out the month up more than 15%. We've seen 6 straight weeks of gains for oil. Part of the uptick that we've been seeing has to do with the cold weather in the East Coast. You've also got that political tension that's in Eastern Europe with Ukraine and Russia. You had the head of NATO over the weekend saying that Europe needs to diversify its energy supplies. And members of OPEC Plus, they've been raising their output target each month since August by 400,000 barrels per day. The next meeting is on February 2nd, so watch out for that one this Wednesday. And Reuters is reporting that the oil producers are likely to stick with their planned output target of March. Karina, Alexis?
Okay. Yahoo Finance's Ines Ferre, thank you so much for that report. We're going to stay on the energy sector and bring in our next guest. Bob Yager is Executive Director at Energy Futures, Mitsuho America. Bob, thank you so much for joining us today. So you heard it there. Prices continue to skyrocket, up about 15% for the month. Where do you see crude headed by this summer? And what are the key upward pressures on pricing? Supply is tight and some OPEC Plus members are finding it hard to fulfill their targets.
I think that we'll be in this kind of area here. We may trade close to $100. We may trade through $100 between now and summer. As long as the Russians are threatening to move into Ukraine, this market's going to stay bid. They are the second largest crude oil producer in the world after the United States. They produce a good 10 million barrels a day. If that's sanctioned or if there's trouble moving barrels on their pipelines, if their pipelines are attacked or sabotaged, that's going to be a major problem for an oil market that is already rather tight. So yes, I think that we are in overbought territory right now. We're in RSI overbought territory. We may get a small pullback here. It's just so many specs are loaded up on the long side of the equation here. There's really nobody left to buy it to a certain degree against $88. But I don't think we'll pull back very far, and I think we may see some more upside here.
If sanctions are actually imposed on Russia over Ukraine, what does that do to the overall energy market? Obviously, Europe is very tight and needs Russia's energy. How much power does Russia actually have in this equation?
They have a lot of power. And not only that, that limits the options of the Western powers to confront Russia. It's almost economic suicide to a certain degree to cut production in Russia or deliveries to Western Europe. So that's tough. I know the German government has been taking a lot of heat because they do not appear to be fully on board here with the sanctions regime as far as energy is concerned. But they rely on the Russians more than anybody else, and for them to impose sanctions on the source of their energy, that's a tough call for them. We'll see what happens there, but yes, they can throw their weight around, or they can put pressure on other countries not to impose sanctions on them.
And back here at home, Bob, natural gas is a popular way to heat homes in the U.S. We just came through a blizzard in the Northeast. What do you see as far as we go through the rest of the winter as far as natural gas prices? They have been so volatile.
Yes, we've had a nice cold streak here for the last 5 days or so. Just a couple days ago, really 10 days ago, it was looking like storage was going to get through the winter, that we'd have adequate storage, that we'd have excessive storage at the end of the day. The March contract traded below the April contract. That's basically winter natural gas trading below summer natural gas. That's basically unheard of and should never happen, but it happened for 2 days in a row on January 20th and 21st. And since then, no, we've kind of been on a ripper. We traded to the highest level, $7 and change on expiration on Thursday, on a wild expiration, I may add, on Thursday. And it's looking like we're going to continue to tick higher. The temperatures are going to ease up a little bit over the next 6 or 7 days here, but then they're going to start to turn cold again at the end of the 10-day. Generally speaking, the most volatile contract on the natural gas curve is the March contract. That rolled to the front of the curve on Friday. We were up 8% on Friday. We were up 6% on Thursday. And now we're up 5% again today. So this thing is ripping higher for big numbers. And I don't see, this is just the way it is for natural gas, especially this March contract. People try to place storage at the end of the year. They're gauging, are we going to have a lot of storage? And then the rest of the year is going to be healthy. There'll be no kind of urgency to fill storage. Are we going to draw storage down so low because of the cold and the storm that we're going to have to go get really on our horse here to fill up storage again? So those are the problems confronting natural gas. Right now, it's behaving as if it wants to rip higher. And as far as that RSI is concerned, there's plenty of room for this thing to run to the upside until it runs out of momentum and enters overbought territory.
And then what do you see happening to shale production? So many say that that's going to increase. Is it going to be drill, baby, drill once again?
It certainly hasn't been yet. We were at 11.6 million barrels in the last EIA report. That's down 200,000 from 3-4 weeks ago. So we peaked out at basically a COVID era high 3 weeks ago at 11.8 million barrels. We've gone backwards by 200,000 barrels since then. So even against $90 in Brent, upper 80s and WTI, these guys are not stepping on the accelerator. It just ticks higher very slowly. So they're not believers in these big prices here yet, or they're certainly not increasing production to take advantage of it. So, the MO these days is to return cash to shareholders. They learned their lesson. They don't want their stocks to get destroyed if it all comes undone here. So they've been very disciplined. We're at 11.6 million barrels right now. The all-time record was 13.1 million in March of 2020, right before COVID hit. And then we traded to negative territory after that. It got really ugly. The energy stocks got creamed. And they learned their lessons. They do not want to return to that kind of situation. I think we'll see production tick higher, probably get to 12 million at some point, but I think 13.1 million, the record, is a thing of the past.
Hey, Bob, I want to get your reaction really quickly. Only about 20 seconds left. Obviously, the midterms coming up. Inflation is a huge issue. President Biden wants to get those gasoline prices down. What more can he do? Because it's not like he can pick up the phone and call Chevron and say, produce more. It's not possible. What does he need to do? And is releasing strategic reserves a good idea?
There's not a lot he can do. There's nothing available. He already tried his best with the SPR. It didn't work. You can't, there is no sizable SPR for gasoline. It's not like you can do it. So he needs lower crude oil prices so that the refiners can offer lower gasoline prices.
Okay, thank you. We will leave it there. Bob Yager, Executive Director, Energy Futures, Mitsuo America. Thanks for stopping by.
All right, thanks a lot, Karina. Coming up next, the best way to save for college and how to avoid costly mistakes. Welcome back to Yahoo Finance Live. It's never too early to start saving for college, but just how and when should you do it? Joining us with some strategies is Jason Bottenfield, Managing Director at Steward Partners. Jason, welcome to the show, and thanks for being with us. I know you brought a few different strategies with you. I want to start with one I employed with my children, and that is opening up a state-sponsored 529 plan. Tell us some of the benefits there and some pitfalls that we should be aware of.
Yeah, no, thank you for having me. With the state-sponsored 529 plans, those are pretty widespread. And I think right now with a lot of the conversations going on with inflation and potential, taxes rising, there's some benefits that are inside of those. So that's a unique area that a lot of people, hear the term, but they forget the 529 and they mess up, what it is. But there's other plans that are out there. But like you said, what you're deploying right now with the 529 is widely used, and I do think is the best option right now, depending on your circumstances. There could be some unique options for other people that are looking to save for education, but you have to be very specific on what you're looking for.
Is opening a 529 plan up immediately once your child gets their Social Security number the way to go if you can do it?
Yeah, that it really is. I mean, I have an 8-month-old, so I'm very I know what happens, with a new baby here. So, the Social Security number when it comes in, that's really the first opportunity you have. There are some creative techniques that some people have deployed in the past, and that's where they'd open up a 529 plan for themselves and save before a child came, and then convert that and shift the beneficiary over to the child. But I'd like to kind of keep it simple here. Don't get too complicated with it. As soon as you get that Social Security number, let's start putting a little bit of money in there. It doesn't matter how much it is. You're not really, there's not really minimums to it. So let's get $100 in there a month, $50 a month, or just $100 a year. Start now, because that compounding and tax advantage growth is just going to be, it's the eighth wonder of the world. I mean, you don't want to give it up.
I like the way you put it. That's true. I'm wondering if you favor an age-based 529 approach, because I know when you open it, you can choose one that will they'll change the balance of the portfolio as your child gets closer to needing that money, or do you like sort of a static portfolio allocation?
Yeah, there's a lot of other plans out there like I was kind of talking about, but just sticking to the 529 plan, it is restricted on the investments that you can get into. All of these are state sponsored, and they're using a widely known mutual fund company. And what they provide inside of there is the option for you to self-direct with some of the funds that they have inside of it that are for the 529, but they also have, like you were mentioning, this age-based option. I like the age-based option, especially for people that aren't necessarily working with an advisor, is because it changes with the age. So, 0 to 7, 7 to 14, 14 and on, it'll change the risk parameters inside of there for you, because, I know in working almost 20 years in the financial planning industry is that, a lot of people put things into place and then they kind of forget about it. And that age-based option allows you to potentially forget about it, but not stay risky a couple years before you're going to need that money. And in times where we're seeing volatility right now, you really don't want that 100% equities in that account the year before you're going to college, or you might use those funds. So, the age-based option I like to lean to, but if we want to get creative and use a more direct approach to the funds that we're going in there, we can do that as well.
All right, let's get to, in the time we have left, some other ways folks can save for college outside of the 529s. You mentioned child savings accounts and also something called tuition promise funds. Tell us briefly about those.
Yeah, so I'll start with the tuition promise funds. Texas has one. A few states have these, and basically it's essentially based underneath the wrapper of a 529, but you put in X amount of dollars up front, lump sum, or you can do a monthly addition to it, and it'll basically prepay 4 years of tuition. So that's the prepaid option. Some states have it. You got to really check your state where you're at. Using kids' savings accounts as an alternative, or also as a prelude to getting kids involved into investing, is a way that I like to use those accounts. Those are Minors Act accounts, and they're actually in their name. There is some savings on the income that's generated out of there, but it allows you to pick some direct individual stocks and maybe some ETFs or funds, but it gets the kid more engaged into investing. And I think that's good because they don't get it in school. but you can also use that money for anything for them, i.e. education. And, there's, so those are two, ways that I think parlay with a 529 plan, but there's also some other creative strategies using Roths and other things as well.
Yeah, real quick, can you just talk to us about the Roth IRA? Because I think people hear that, they don't associate that with college savings.
Yeah, it's a little unique. You have to be very specific in that the child needs to have income. So there are a lot of our clients that are small business owners, and their kids may start to work a little bit in the company. So you can start to fund some of these accounts, for them. But there's some unique options. Some people use a Roth IRA for themselves and then take the money out and use it for education. I wouldn't do that necessarily. I'd rather you keep that Roth IRA money that's in your account, because it is a great strategy. And if you can get the money in there, you should leave it in there and not use it for your kids' education. You should look at other strategies for that.
All right, lots of different ideas there for people to ponder, but whatever you do, put something away as soon as you can. Absolutely. As you say, take advantage of that compounding. All right, Jason Bottenfield, Managing Director there at Stewart Partners. Thanks so much. Karina?
Okay, and coming up, crypto is continuing its bumpy ride. So why are some people asking to get paid in digital currency? That story ahead. Stay with us. Welcome back to Yahoo Finance. Well, we want to get you a quick check of the markets before we send you over to the next show. It has been a busy end to the month, and all sectors looking in the green. The major benchmarks higher. The Dow is up by 257 points. The S&P better by 63 points. Still looking for its worst month to start the year since the pandemic began. And the Nasdaq is also higher by 375 points, so up at session high. Sector-wise, all in the green right now. Consumer discretionary and tech among the biggest winners, healthcare and consumer staples among the laggards. Let's get you over to the bond market and take a quick check of what is happening in that space there. The 10-year has come down a little bit, down to 1.78%, as investors await that big jobs report that happens on Friday, and the 30-year yield is now up at 2.10%. And with more on particular stock movers today, I'm going to send you over to Alexis.
All right, thanks, Karina. Actually, I'm going to go send it over to Jared Blickery and Brad Smith. They're going to pick things up here in the next hour and take you through the close, including taking a look at some of the big movers today in the stock market.
The end is near for a dismal January trading month. Fed policy has been a key driver of uncertainty early in 2022, pushing major averages into correction. Investors are now questioning where the bottom of the downtrend may occur amid an earnings season cross-current. Russia alleging the UN is misleading the international community during a UN Security Council meeting. Those comments later rebuked by U.S. representatives, all while Russia maintains 100,000 troops on the border of Ukraine. We examine what comes next as international tensions rise. Also, Spotify shares rebounding today even as more artists pledge to remove their music from the platform, distancing their catalogs from podcaster Joe Rogan, who's been a known proponent of vaccine misinformation. Will a new COVID-19 information hub be enough to keep more musicians from leaving the platform? All of that and much more during today's show. First, we want to get a check of the markets here. Let's see if we can get some of the major averages up on our screen, because we are seeing the market still in rally mode. We got the Dow up 268 points, as you can see on your screen, the S&P 500 up 1.4%, and the Nasdaq is the leader of the day, up about 2.75%. And for more on the markets, we want to bring in Yahoo Finance's Ines Ferre. And Ines, I know you've been looking at a lot of things today, particularly perhaps some of the mega caps. I'm just wondering what's catching your eye.
Yeah, that's right, Jared. And just taking a look right now at the mega caps on our Wi-Fi interactive board, you can see Facebook or Meta up more than 3%, Amazon up more than 3%. We've been watching really Tesla up 10% after that upgrade to outperform at Credit Suisse, with the analysts there saying that this is a good entry point, that Tesla has been caught in this recent market sell-off. And those analysts have a price target of $1,000, $1,025 on the stock. Year to date, the stock is down, though, 11%. In fact, if we take a look at the best performers right now on the Nasdaq 100, we are watching some of these stocks that have gotten hit recently. Netflix up almost 10%. Netflix was upgraded at Citi, so it's seeing a big bump today. But year to date, for the month of January, it's down almost 30%. We also want to take a look at some of the ARC innovation ETF holdings, because these are seeing a big bump today, of course. But if we take a look also at the monthly chart, you can see quite a bit of red on the screen. I had mentioned Tesla. We're just also watching year to date for some of the bottom performers. Oh, there we go. Looks like that little squiggly line went a little bit overboard there. But nonetheless, you get the drift. I do want to mention the sector action, because if we pull up the year to date sector, we are watching energy, which is really the only one in the green, up 18% for XLE. Of course, if we look at the intraday today, we are seeing consumer discretionary, technology, and communication services that are leading the gains. Jared?
All right, thank you for that report, Ines. And now we want to continue the markets discussion by bringing into the stream Ann Berry. She is a Wheelhouse Chief Investment Officer. And always great to see you here. Let's start off with the news of the day, because we've kind of been bucking the trend in the major indices over the last 2 days in rally mode, but we're still set for a very negative January. Just wondering, because all the investors I talk to are wondering, is the temporary bottom in here, or are we going to take out these lows sometime soon?
You know, I don't think we have hit the bottom yet, Jared. And I think as I look at what some of the uncertainty that still sits out there, there's still speculation that the Fed is going to be more hawkish than perhaps the markets have anticipated. So while I'm a little heartened by the recent rally, I think the bottom is still to come. So I'm still in watch and see mode.
You there, Brad? We've been having some technical problems with Brad, so I'm just going to field you this next question, Ann. We've seen a lot of acquisitions. We just got a few more announced today. In fact, it might be a record month, at least for tech. What are you looking at in this space?
Yeah, I do think that 2022 is going to be a blockbuster year for M&A, at least for those companies that have got lots of cash on their balance sheets or lots of ability to take out more debt or do new equity issuances to fund them. So we saw Microsoft moving in to buy Activision, the announcement today that Sony is looking to buy Bungie, so further consolidation in the gaming industry. But then also the big one, Jared, that I'm looking at, I have a private equity background, and we're seeing Elliott Management, the big activist fund, partner with Vista, the big private equity firm focusing on software and tech, move to take Citrix private, which to me is a really interesting move, because I do think we're going to start to see the private equity industry sitting on $1 trillion of cash start to deploy now and look to find some bargains, particularly in that more mature tech business where there might be some upside in growth. And they're going to go out and they're going to take advantage of still relatively low interest rates, I think, to go out and do some more hunting and some shopping in the public domain.
And will investors reward that activity, or are they going to look at this and say, hey, that's cash going out the door as of right now, depending upon the types of acquisitions that are made?
And I do think that last point is the kind of acquisition that's being made. So if we break down Citrix, for example, that's a $16.5 billion all-cash deal, which means if you're a Citrix shareholder, you've been holding a share that's gone from, at its highs in the last year, $144, at its lows less than 80, and now you've got the opportunity for about $104 a share to receive cash and get rid of that uncertainty if you've been holding through this roller coaster market. So I think in some cases it could be well received. In others, I think shareholders sitting there saying, well, wait a second, what is it that the private markets are seeing that the public market isn't seeing, or that the management team hasn't been executing upon as a public company? So I think it really depends. But I do think, just given the volatility we're all expecting, there might be more appetite than ever amongst public company shareholders to take the cash and run.
Well, I want to talk about taking all the cash on the Fed balance sheet, maybe running back with that. I'm not sure if that segue was very good, but we're talking about the Fed raising rates this year. We now have 5 rate hikes priced in the market, and we're also talking about quantitative tightening. Hasn't started yet, not going to happen until after the first rate hike. But putting it all together, what are you expecting from the Fed this year?
I do sit in the bucket that Goldman Sachs came out with a report very recently, Jared, and said they're now thinking it's going to be 5 hikes, not 3 or 4. What I do find quite encouraging is, despite the fact that the street has recalibrated its expectations, thinking there could be 5 or as many as 6 rate hikes this year, there is nonetheless some positivity, which tells me that there is still underlying positive sentiment around the fundamental strength of the US economy, bolstered by the fact that the jobs report was very positive in recent weeks. You've still got the consumer who's in a very strong position. The savings rate went through the roof during COVID. We're seeing consumers with a lot of cash, with a lot of savings, significantly above historical averages, which signals that even with a rate increase, the consumer is able to absorb higher interest rates. And I think what this ultimately says, too, is that inflation concerns are beginning to come down a little bit, that there is a belief that the Fed is going to get it under control. You put those things together, and the street's saying we still think the US economy is the place to park its capital and the place to invest behind. And I think that's why the market's rallying right now.
You have even more of the conversation around not just the quantity of hikes, but the quality of those hikes as well, and perhaps what they actually come in at, even from the Fed president in Atlanta, Raphael Bostic, and particularly with regard to the size of those hikes that we may see. What are your expectations there, even if we do see 5?
Look, I think it's still relatively gradual. And I think what Joe Powell has basically said is we're going to come out as the Fed and be very hawkish and move very aggressively if we need to. But we're also going to have several rate hikes so that we can take our time and be responsive to the data as it comes in around inflation and also job creation. So where I land on this is we're all in watch and see mode, but I think there is at least now a signal that there is huge confidence in the Fed, confidence that the Fed is going to move appropriately and with the right judgment. And I think that's why the market is still relatively calm, despite the fact that there are concerns that there'll be faster, larger rate hikes. So I'm fairly positive on the monetary policy front.
Ann Berry, Wheelhouse Chief Investment Officer, joining us today. Thank you so much for the time and the insights. Certainly do appreciate it. And everyone, coming up on the other side of this short break, hospitalization due to COVID-19 is trending downward, but deaths reach another grim level. Meanwhile, the FDA gives full approval to Moderna's COVID-19 vaccine. We bring you up to speed on the latest developments in healthcare and policy to counter the virus on the other side of this break.
Welcome back. On the COVID front, hospitalizations are finally ticking down in the right direction as Omicron infections ebb, and the FDA finally granted Moderna's COVID vaccine Spikevax full approval, and that's after a year following the first emergency use authorization, and that was greenlit, well, about a year ago. And for all of this and more, we want to bring in Yahoo Finance's Anjali Khemlani. And Anj, why don't you just give us a wrap up of what you've seen and all the developments over the weekend?
Sure, Jared. Well, as you know, we are continuing to see Omicron still affect parts of the country. While we are seeing nationally the averages come down, we are still watching those deaths. And there are some experts who believe that because of the subvariant of Omicron, we might actually see just a little bit elongated surge from what was initially expected. And for all of that, of course, we know that vaccinations are playing a key role to that point. Moderna getting their full approval from the FDA today. They can now market their vaccine, Spikevax, as well as help ease any sort of issues that might come from shipping overseas for a vaccine with emergency use authorization versus full approval. Meanwhile, we also know Novavax submitted for its first emergency use authorization in the US today. Meanwhile, we know that it has, of course, gotten some authorizations globally, but adding the US to that has really opened the door for some who have really been waiting for this right now. So no word on what the on how long the process will take after this, but that's where things stand right now. Back to you.
All right, appreciate that report, Anjali Khemlani. And now we want to continue the discussion by bringing Dr. Shikha Jain. She is the assistant professor of medicine at the University of Illinois, Chicago. Thank you for joining us here today, Doctor. And you were just listening to Anjali talk about the hospitalizations ticking down. I'm just wondering, what is the state of the hospital system in the U.S.? How overburdened is it? How much capacity is there? Also recognizing it varies by region.
So it's really important to remember, Jared, that right now we're in a very different place than we were 2.5 years ago when the pandemic first started. Not only do we have a very high number of COVID cases, we also have people who delayed their medical care for a significant amount of time because people were avoiding hospitals and clinics when we didn't know much about COVID and when we were trying to really get the pandemic under control. Now we're at a point where we have COVID patients. We also have patients with other medical problems. And then we have an immense amount of people who have left the healthcare systems because of burnout, because of work conditions that they're not happy with, because now healthcare workers are getting sick with COVID. So our hospital systems are really overrun. Even though our COVID numbers are starting to come down across the country, the hospitals are still bursting at the seams and are very overwhelmed because of this kind of multitude of factors that are impacting hospital systems' ability to treat patients effectively.
Doctor, do hospitals currently have the necessary inventory for treatment that we do know with the COVID-19 pandemic and what we've seen in the different variants? The treatment and the efforts there have been critical for them even being able to mitigate some of the more severe symptoms if a patient is hospitalized.
I think it really depends on where you're looking in the country. There are places across the country that are having monoclonal antibody shortages, that are having drug shortages, that are having other supply shortages. We know that there are blood supply shortages across the country. So many hospitals are struggling because they do not have either the supplies or the medications they may need because of the really big strain that is happening to our healthcare systems. And so it's impacting care not only to COVID patients, but also impacting the medical care being provided to people with non-COVID related symptoms and disorders.
And Doctor, one of the stories I was tracking with interest over the weekend, well, over the last week, is what's happening with Spotify and Joe Rogan. I'm not going to ask you to comment on Joe Rogan specifically unless you want to, but just in the general sense, there's a lot of misinformation about COVID that has been spread. And I'm just wondering how you think that the public, the media, et cetera, should be handling it.
I think it's really sad that we've gotten to this point where we have gotten to a point where people are taking opinions and trying to pass them off as medical fact. You know, as the famous Neil deGrasse Tyson has said, the good thing about science is it's true whether you believe it or not. The problem is we're in a society right now where people who are spouting incorrect, inaccurate information are being given very large platforms and are actually resulting in the deaths of thousands of people, because we see these celebrities with large platforms utilizing their platforms to give a voice to people who are not giving information based on data, based on science, based on evidence. And by having these conversations where you give a similar voice to people who don't have the evidence and who are spreading dangerous lies, to be perfectly honest, it's really impacting public health, it's impacting communities, and on a real basis, it's impacting people's lives and their ability to survive a pandemic. So I think it's really unfortunate that we're at a point where there are people out there who are spreading misinformation. They may not be doing it with the desire to hurt people, but what they're doing is they're giving a platform to people who are providing inaccurate information. And we're at a point where we should be trusting our scientists, trusting the people who have the evidence. And it's not a, well, we should hear all opinions type situation. There are facts and then there are opinions. We need to be using facts and data and science to be driving decisions, not opinions of people who don't have the expertise to really give an opinion based on science and data. So I think it has been very dangerous giving people a platform when they are spouting misinformation that's killing people.
Believing in that misinformation can also have employment implications as well. We do know many companies are trying to restart the ability to bring people back into the office. And with that comes policies that many companies have rolled out. We do know that on the other side of that, there have been memos that have been leaked, T-Mobile being one of those, where they were looking to terminate corporate employees not vaccinated by a set date, being April. And so with that in mind, how can companies who are looking to bring back their workforce in a safe manner best communicate that strategy and lay out a policy for vaccination and for reopening a corporate office or any type of workplace safely? I believe we may have
like the
boss, Dr.
Did you lose me?
I'm
Am
sorry,
I back?
Doctor, you froze there? Yes, you are back.
Yeah.
Go for it.
Okay, sorry about that. I don't know what happened. So I think it's important to emphasize the messaging that vaccines are safe and they're effective, and people are asking to be taking the vaccines to protect their coworkers. You want to keep businesses open. People need to be vaccinated to protect each other and to protect the businesses. So the vaccine, while people feel it's a personal choice, remember, your vaccine status will have a direct impact on people you come into contact with. And you getting COVID and spreading it to other people may result in your business getting shut down. So getting the vaccine should really be a way to keep businesses open and to protect your friends, your family, and your coworkers. So it should be required. If you're going to be working in spaces with other people, you need to be vaccinated to protect them and to protect the business.
Well, we always appreciate when you stop by here with your mountain avalanche of facts. Dr. Shikha Jain, Assistant Professor of Medicine at the University of Illinois, Chicago. Coming up next, with inflation at a 4-decade high, investors are pricing in 5 rate hikes this year. We talked to Atlanta Fed President about it, and Brian Chung stops by to break it all down.
Welcome back to Yahoo Finance Live, everyone. The Hawks are in play in Atlanta, and that's beyond the basketball court. Atlanta Fed President Raphael Bostic now hinting at the potential of a greater rate hike than anticipated at the March FOMC meeting. He spoke with Yahoo Finance's Brian Chung, and for more, let's bring in Brian now. Brian, take it away.
Yeah, well, as you mentioned, I did speak with the Atlanta Fed President Raphael Bostic. You know, markets were a little bit in a tizzy after he made remarks to another publication over the weekend, telling the Financial Times that a 50 basis point hike could have been on the table in March. So I started off the conversation very simply. Well, that might be a policy option, but is that your expectation for what the Fed should do in its next policy setting meeting? Take a listen to what he said.
Let me just say, first of all, that's not my preferred setting of policy action for the next meeting. Really, when I started looking at this year, I had three moves, 3 rate increases in mind, and March increasingly was looking like it's the right time to do that. But the other thing that I've been very mindful of is that the economy has been a surprise to us and a surprise to the upside repeatedly in ways that has left me really just observing how the world works and keeping my options open so I can adapt my policy to what the world tells me is happening. So I just think it's really important for people to know that we're not set, or I'm not set on any particular set progression in terms of policy, and we're going to let the data and the evidence really guide us in terms of what an appropriate action might be.
Thematically, that kind of fits with the nimbleness that the Fed chairman was talking about in the press conference last week. But at the same time, you have market watchers that are trying to figure out how many rate hikes we should expect over the course of 2022. And it seems like now the prevailing expectation is for 5 rate hikes over the course of this year. And some, we had Ethan Harris from Bank of America on earlier saying possibly 7 this year. Do markets have it right?
Well, you know, a lot's going to happen over the course of the year. Right now, in my estimate, I've got 3, but there's a lot of data that's going to come in, and I'm assuming that those other forecasts have thoughts about what's going to happen in terms of inflation and what's going to happen in terms of job growth, and that's going to inform how policy plays out. You know, for me right now, I'm just staying laser focused on the next meeting and trying to see what the data is telling us about the trajectory of inflation for this first quarter of 2022. And what impact that's having on jobs and employment. That'll tell me what's going to happen for the next meeting and give me a hint toward the one after that. You know, what the long arc looks like, I think it's really hard to lean in too much on that at this stage.
So let's talk about optionality, because the Fed chairman used the word steadily, and you have Fed watchers obsessing over the difference between steadily and gradual. But I spoke with your colleague in Minneapolis last Friday who said he could see the case for perhaps, raising interest rates and then taking a pause after that to assess where things go. I mean, I guess all of this depends on how much of a hawk you might be. I know you're an avid bird watcher, so would you describe yourself as like a peregrine falcon hawk here, or more of like a red-tailed hawk here? How would you describe what you would like to see over the course of this year?
Well, I think of myself more as terms of an owl than a hawk personally, but what I would say is, look, the goal here is to move us off of our emergency policy stance of maximum accommodation, and also to try to push back on this inflation that has really elevated to levels that we haven't seen for quite some time. And how that plays out and the exact path of that, that's something our committee is going to sort of work with and work on. What I will tell you is that I'm at 3. When I started thinking about 2022, I was at 1, and that was going to be in the summer. As the economy's come back stronger than I expected, and inflation has gone up faster and more persistently than I expected, I've increased the number of moves I think is appropriate, and I've pulled them forward. So for me, I think we're going to need to be thinking very carefully about sort of how things are going, watch how the economy responds to our first move to make a decision to give us information about what should happen in the next meeting and the meeting after that. I think the message that the chair was trying to offer, and that I would say as well, is we're not set on any particular trajectory. The data will tell us what's happening. And once the data come in, I think our decision for each meeting for the rest of this year will be clear.
So not a hawk, but he describes himself as an owl. You can leave that open for whatever interpretation you would like. But obviously, we had a number of other topics that we discussed, like, for example, how the Fed might prefer to approach its balance sheet roll-off at some point later this year. The Fed president in Atlanta telling me that he would like to have some optionality on that front, but said they can go faster this time than they did when they last tried to roll off the balance sheet after the great financial crisis. And of course, you can catch the full interview online at yahoofinance.com.
And Brian, I want to ask you about this big jobs report we got this Friday. Just looking at some of the survey numbers, there's a lot of focus, maybe an outsized focus on the headline payrolls number. But let me give you what the street is expecting. 150,000, that's the median, but it's a pretty big range here from 250,000 on the upside all the way to negative 400,000 on the downside. And there are 15 analysts who are now expecting a negative number. So it seems like it might be baked in, but I'm just wondering how the Fed is thinking about this. And part of it also as part of the larger trend, because we know that one payroll report a trend does not make.
Yeah, and actually I had the chance to ask the Atlanta Fed president that, and he was saying that he similarly would expect the jobs report covering the month of January to come in, quote, lower than what we've seen for the last several months. And that's because of the impact of the Omicron virus really taking full shape during that month, even though it kind of reared its head, especially in the East Coast around the later parts of December. Really, the full impact of it won't be seen until this jobs report that we're going to get on Friday morning at 8:30. Now, obviously, that means that we can see a low number. Whether or not that's going to be negative or not, the Fed president didn't say for sure. But the real question for him is going to be, as you mentioned, looking through what could be a noisy January print and looking forward to what we would see in maybe March and February. So he was saying that in those other 2 months that he would be expecting to see a rebound in the labor market at that point in time. Obviously, there's a lot of fixation on the multi-million amount of people that are still sidelined from the pandemic compared to pre-pandemic levels. Obviously, not all of them are going to come back in when you factor in retirements or people who were retired that are declining to come back into the labor force, which is a trend we had seen pre-pandemic, in addition to people who just have concerns about the virus and the inability to work because of childcare or home care or other types of those things. So again, the Atlanta Fed president saying, yes, indeed, that number that we get on Friday might be a little bit disappointing, but that we should expect to see a rebound, as has been the case in previous waves in February and March.
All right, keeping a close eye on the probabilities for hikes and then the additional extent of the hike as well in the future here. Brian Chung, great interview with Atlanta Fed President Raphael Bostic. Appreciate it. And everyone, coming up on the other side of this short break, we've got much more. With 30 minutes left in the session, we're going to give you a check of the key tickers that we're watching going into the closing bell, plus the Unicorn Supplement subscription service that's attracted the eye of Lewis Hamilton. The CEO joins Yahoo Finance next.
Welcome back. Time now for 2 and 2, where I take two stocks and then turn it over to Brad. I'm going to go first here, starting with Robinhood. Now, Hood is popping today. You can see on the Wi-Fi Interactive, it is up 8.5%, continuing the rally that it had Friday. You can see it's up 19% over 2 days. Guess what? Cathie Wood was buying the dip on Friday, and she bought $2.44 million or 2.44 million shares worth of Robinhood. That was the biggest purchase to date. You can see it's underwater by about 22% this year, and the stock still down 60% from its IPO. But guess what? We got some stocks that are in the green as well, and we're checking out AMD and some of the semiconductors, including NXP, which is reporting after the bell. Let's take a look at AMD first. We can see it's up 7% today. Nice little chart right there. Year to date. Now, this is a stock that's still underwater by 21%. All of these growth names getting hit pretty hard, but we're going to see if that can turn around after the bell. As I said, we have NXP reporting they're looking for revenue of $3 billion, along with EPS of about $3.01, live in about 30 minutes here. So stick around for that. And on that note, it's your turn, Brad.
Yeah, I'm going to take a look at Boeing Aviation first and foremost. Boeing, of course, has been in focus here, especially as any type of new order has the propensity to move the stock higher. They just saw that come through a little bit earlier on today. And so with regard to Boeing and what we're going to be seeing with some of those new orders, it also comes at the same time with regard to their expectations of a negative operating cash flow in future quarters. And so that particularly is going to also be something that investors really have to navigate and price in here. Then you're taking a look at shares. Of course, we should note that they're towards the lower end of their 52-week spectrum. I believe that low for the 52-week scale was at about $184, 183.77 to be exact there. So continue to keep a close eye on Boeing. It is up here on the day by about 4% with just about 25 minutes left until the market close. And so on a new order and then the expectation of the operating cash flow to be negative in future quarters, that's going to be something that investors have to continue to navigate throughout the rest of this week. And we'll see what more details potentially we get from the company. But then on the other side, if we come back down to the ground level here and talk a little bit about Tesla shares moving higher, and they are ripping on an upgrade that they received today from Credit Suisse. And we have the note here, and just taking a look at it, they are citing highly favorable fundamentals, the pullback creating an attractive entry point. We have been tracking this one over the past couple weeks as well, just keeping in mind some of the declines in the volatility that shares of TSLA had seen here on the day, up squarely by about 10% with about 25 minutes left in trade. But there you're taking a look at the broader 2-day period and seeing just how far they've come, even in spite of the dip that we had seen in recent sessions last week, especially coming after some of the earnings reports that have moved companies like Tesla, Netflix. And so with regard to those moves, it'll be interesting to see where some of the investors out there continue to chart their own entry point going forward from here. But Boeing, Aviation, and Tesla are the two that I'm keeping an eye on here today, Jared, for our 2 and 2.
And now another fun fact about Tesla, I was just checking my charts. This is the best days Tesla is having since the very first day of the year. They got a 13% pop that day and didn't do much in between. All right, we want to switch directions here because the pandemic fitness boom might not be helping Peloton shareholders, but one supplement company is capitalizing on the extant Fed liquidity, raking in $115 million in funding for a $1.2 billion valuation. And this would be Athletic Greens. Guess what? We got the founder and CEO of Athletic Greens, Chris Ashenden, here with us. And Chris, thank you for joining us. And we were just talking over the break. You bootstrapped it all the way. This is your first round of financing. I'm just wondering how you got to this point and where you launched from here.
Thanks so much for having me, Jared. Yes, we bootstrapped last year to over 150 million monthly revenue run rate before we deployed our first equity dollar in external equity capital. We did a small raise last year, which we announced in July. This far more significant raise we recently closed was $115 million, which is here to drive continual innovation back to our customers and really lean in to growth as we scale.
As you think about that growth, what type of additives, if you will, come along with that? Is it in addition to the types of products that you're putting into the subscription service? And what are some of those figures looking like in terms of the performance indicators about subscription growth and the types of products that are being leaned into by your subscriber base?
Well, AG1 is a foundational nutritional drink. We pioneered this category. It's 9 synergistic products in one, 75 of the highest quality ingredients in the world. We've been really innovating around this product for over 10 years. We're on our 52nd iteration, and it's all about driving value back to the customer and really removing the friction from how they can ultimately cover their nutritional bases every day. And it covers all sorts of things that you'd frequently expect to see in someone's cupboard: a multivitamin, a multimineral, pre-pro and symbiotics for that gut health element, and daily love for all sorts of your bodily systems. Now, at its core, we try to take the friction out and make it really, really simple. And so we do that in a beverage, which is literally a moment in someone's day. It is a 90-second investment in your health, which we believe is the highest ROI 90-second investment in your health you can possibly make. And I think our continual focus on innovation and value to the customer has been reflected by our growth curve, which is hitting an inflection point. And it's to seize that opportunity, which frankly, the opportunity greatly exceeds our ability to bootstrap into, that we went to the market to raise this latest financing round.
And I want to talk to you about your distribution model, your subscription model, and where I've seen this in other industries. Let me just give you an example. So I'm a customer, I want athletic greens. I can't necessarily buy one package or one container. It requires a subscription. And obviously there's a thinking, a calculus that goes on with that. I'm just wondering if you considered any other distribution models where people are allowed to buy one at a time, or is this something that you've said, this is our business model?
So we're not rigid in our thinking. I think a lot of folks get a little bit confused about the word D2C. We don't even use internally the word D2C. I think it loses the power of the real power of that particular model. We call it direct with the customer. It's about forming a two-way relationship with your customers. This allows us to be better informed by them, how we can add value to them, and allows them to empower us to be a better business, to better serve them. And it's a two-way thing that I think is the future of brand building. Now, because AG1 is about foundational nutrition, it's a beverage you take daily. It is perfectly suited to a subscription-first business model. We'll always look to meet our customers where they want to be met. We'll always look to make it as convenient, as simple for them to invest in their health as possible. So we're never so rigid that we won't look outside our existing core model, but we have a staggering amount of demand and runway just executing on this existing direct with the customer platform that we have.
What other retail partnerships would you look into then if you were looking to expand outside of, even though we're not calling it, I guess, the direct to consumer, but the subscription model that you have right now, if you did look towards expanding that into other retail opportunities, where would they lie? And are those conversations already on the docket right now?
So for us, if and when we step into retail, it'll be very strategic, and it'll be a narrow, focused test, learn, and iterate. And we'll be about meeting our customers where we want to be met. We have a phenomenal relationship with our customers. We know how and where they want to be served. And over time, we aren't ruling out any other formats and changes to our business model as it relates to that, but it'll be very...
All right, we're gonna have to leave it there. Really appreciate you stopping by here. Chris Ashenden, Athletic Greens founder and CEO. Coming up after the break, Russia has now amassed 100,000 troops along the Ukrainian border. That's as the UN Security Council meets today. A Eurasia Group senior analyst comes by to tell us what we need to know.
Welcome back to Yahoo Finance Live, everyone. Russia alleges the UN is misleading the international community during a UN Security Council meeting. Those comments were later rebuked by U.S. representatives, all while Russia maintains 100,000 troops on the border of Ukraine. Here with what you need to know from today's UN Security Council meeting is Zachary Whitland, Eurasia Group Senior Analyst. And Zachary, if anything, going into this and kind of right out of the gate, it showed us that there wasn't going to be any firm type of resolution. What most notably, if anything, from this particular council meeting, though, could we potentially see some type of footing be gained off of in terms of the relationship between the international community and Russia?
Right. So first, thank you for having me. I think we're going to be stuck in a period of negotiations for at least for the next few weeks, assuming that we don't get to a major military escalation. A lot of what we saw today at the United Nations was repeating talking points. I think that the US and allies in particular wanted to make sure that on the world stage, they made their argument quite clearly. And for Russia was the same. I think one of the most interesting points that actually came up today was China repeating many of Russia's talking points, which is something that could be expected, even though one can only assume that China does not want to see a major military escalation in Ukraine during the Beijing Olympics.
Let me ask you about that. How close is the alliance, or is there an alliance between China and Russia right now? What kind of information do they share with each other, and how deep do those ties really go?
Alliance is too strong of a term. Partnership is better. Certainly, Russia and China both see it as long-term and strategically important. But there have to be quite a few caveats. One being that Russia economically is far more dependent on selling commodities to Europe and further afield than its actual relationship with China would suggest. There is growing cooperation in strategically important areas, as well as sharing of intelligence and communications from the security apparatuses. But ultimately, China and Russia see overlap in their view of the world, particularly of the US's role in the current world order, and see themselves as in an alliance of convenience, not alliance, I already said, in a partnership of convenience for wanting to push back on the role of the US in the world and promote their own views of things. But it should not be overestimated.
I want to play a quick clip for the sake of this conversation with regard to how we've seen this play out thus far. And in the UN Security Council discussion, some of the very elements that we're discussing here, we've got even more comments from in this quick clip here between Russian military and intelligence services and the type of disinformation through state-owned media and proxy sites. Let's roll the tape real quick.
Russian military and intelligence services are spreading disinformation through state-owned media and proxy sites, and they are attempting without any factual basis to paint Ukraine and Western countries as the aggressors to fabricate a pretext for attack.
And I would just want to get your reaction to that and what this positions in terms of the U.S. messaging directly to Russia and even to China as well, perhaps.
Well, certainly, the U.S. wants to make it clear that Washington and its allies are absolutely prepared if it comes to a major military escalation. I should say that our view at Eurasia Group is that on balance, we expect that a diplomatic resolution is still possible. Not a quick one, as I was alluding to before, one that still has room for significant escalation. But given the significant deployment of forces on a level that has not been seen since the last time that Russia intervened militarily in Ukraine in 2014, it's a significant enough possibility that the US wants to signal that it understands that the groundwork is being laid if Russia chooses to take that option and wants to be prepared for either possibility.
And I want to talk to you about the leverage that Russia has over Europe vis-a-vis its energy situation and its notable deficit in liquefied natural gas, which has been a point of contention over the winter. I just got a report today that EU is actually shutting down the Nord Stream 2 pipeline on hold for compliance review. I guess that's going to take more supply or potential supply offline. How much is Russia holding this over the negotiations table right now?
I think it's tangential. There has already been problems with natural gas supplies to Europe. From Russia's point of view, they're meeting contractual minimums, but as this has been a particularly cold winter and there's been supply shortages, I think Europe has been disappointed that they have not been able to secure additional volumes. And it seems that Russia is taking that as an opportunity to point out why a good relationship with Russia is important for Europe to ensure continued supply in the future. That said, Nord Stream 2, though it is constructed, has not been operational. And Germany has gone as far as to make it clear that if there is a significant military escalation in Ukraine, scuttering the project completely is not off the table. And that remains part of the equation here, that Europe wants to remind Russia that even though there are some differences with Washington over how aggressively they should respond, over their assessment of how likely it is that Russia is about to choose the military option over the diplomatic one, I think that there is a reminder there that if push came to shove, there would not be nearly as much daylight between Brussels and Washington, as well as European partners, as it might seem from the past week.
And so with U.S. Senate back in session this week, what effectiveness at this point would sanctions have, if any?
So the threat of sanctions, it's meant to pile on the costs and to make it hopefully less likely that we get to a significant military scenario beyond what we've seen in Ukraine since 2014, 2015. The White House has been providing information either directly or into the press about the types of options that are on the table. These would absolutely be more significant than what we've seen if we get to that point. This could include blacklisting Russia's major financial institutions that would impair access to hard currency in the dollar. It could include expanding export controls to Russia to include semiconductors and chips, pieces of high technology that have not been touched before in this situation. It could include an expansion of sovereign debt. And then, as I mentioned before, Nord Stream 2 absolutely could be on the table if we get to one of those worst case scenarios.
Zachary Woodland, Eurasia Group senior analyst, joining us here to break all things foreign policy and these international relations down, especially given the tensions that are still extremely high on the border of Ukraine. All right, great to have you here with us today. We got to leave things there. It's Zachary Woodland, Eurasia Group senior analyst, everyone. And coming up on the other side of this short break, major averages, they are holding on to gains right now with just minutes remaining in the final session of January. We count you down to the market close next.
Welcome back. We've got the markets in rally mode to end the month of January. And if you're paying attention here, the Nasdaq is now avoiding the worst January it has on record. It's going to be number 2, but also putting in the best performance of 2022. We want to talk about the markets with Yahoo Finance's Ines Ferre. And Ines, what do you have your eye on right now?
Yeah, Jared, and just taking a look at the NASDAQ right now, take a look at our Wi-Fi interactive board. It's up 3.25% at the highs of the session. In fact, let me pull a 2-day chart for last Friday and today, up more than 6%. Year to date, though, down more than 9%. Taking a look at the sector action as we go into the last few minutes of trading, we are seeing consumer discretionary, technology, communication services. Those have been the sectors leading the gains today. And on the NASDAQ 100, we're watching some of these mega cap names. Take a look. Amazon more than 3% higher. Tesla up 10% after that upgrade at Credit Suisse. And we've got Meta that's up more than 3%. And I do want to mention the participation of these semis as well. A lot of green on the screen over the last 2 days. You can see the action there in semiconductors year to date. Quite a bit of red, but still, nonetheless, today seeing some big gains.
Big gains indeed. All right, thank you for that, Ines Ferre. And stick around, everyone. After this, we got our sprint to the closing bell. Welcome back. Well, with less than a minute to go to the closing bell, I want to introduce our panel here. We have Jeff Klingelhofer, Thornburg Investment Management, co-head of investments, and also Andy Capron, the Region Atlanta co-chief investment officer. Guys, stay where you are. I just want to take a quick check of the markets before the bell here on the Wi-Fi Interactive, and we can see that the NASDAQ is in rally mode. We have that up 3.4%, so another surge into the close, similar to what we were seeing on Friday. S&P 500 also adding to gains, up nearly 2%, in the Dow now topping 400 points. If ever so briefly. Also looking at the sector action, it's really been all about the mega caps today. We have consumer discretionary up nearly 4%, the tech sector up 2.5%, communication services up 2%. Even the laggards, staples and energy, are each up about 0.4%. And here's your closing bell.
All right, there you're seeing the markets close, a live shot of the New York Stock Exchange here as we end January 2022 in the trading month that has been. And taking a look at where things end, we end on a good note as the Dow ends the day higher by about 1.2% for this final session in January. We're taking a look at gains of about 406 points. We'll round that off to S&P 500. That sees gains on the day come in at about 1.9%, 83 points to the upside there. The Nasdaq Composite, the tech-heavy average closes up 3.4% to end the month. Okay, 469 points on today's activity added for the NASDAQ. And let's get back to our panel discussion here. I want to bring back in Jeff Klingelhofer, who is the Thornburg Investment Management Co-Head of Investments, as well as Andy Capron, who is the Region Atlantic Co-Chief Investment Officer. And Andy, I'm going to begin with you because when you think about the month that has been, if you just kind of round out and take a 1,000-foot view at what we saw and what type of momentum this sets up for, what notably sticks out and where are there perhaps some tailwinds that could be in play, even despite all of the cross currents and headwinds that we've been tracking over the course of January?
Sure. The entire month of January, I would argue, has been the month of the Fed and changing expectations about what the Fed will do. It was clear at the start of the year that we expected a relatively slow response from the Federal Reserve to a hot economy and inflation. And now it's clear at the end of the month that it's going to be a substantial one, from expectations of two to three rate hikes to now it's not beyond the pale to expect 5 rate hikes. That's really moving the market, and it's moving the market in big ways, especially for less profitable and unprofitable firms, growth names that have a longer runway to being able to produce cash flow. But the rest of the market is actually holding up quite well, which is really what we're seeing, and it's really coming in spades as earnings announcements start to roll in.
All right, Jeff, we're in earnings season. We're about to get some from the semiconductor sector. All I think investors are asking themselves right now, this nice 2-day bounce, is it going to last?
Yeah, absolutely. And I think that's exactly the right question to be asking, right? I agree with Andy that ultimately this is a question of not only the Federal Reserve, but really it's a question about the shifting underlying regime that's bigger than the Federal Reserve, I would argue. So earnings thus far have been relatively strong. And on that back, we think the underlying economy still has a long ways to go, right? We are emerging from COVID, and consumers do have a significant stockpile of savings that they're still able to spend down. But the regime really started its shift a number of years ago, where the Fed reordered its mandates, right? It's no longer purely about maximum employment. Today, they've reordered it to where they're having to face the trade-off between high employment and high inflation. And that's feeding through the economy in significant ways. And ultimately, as rates rise and spreads widen, it will act to slow the economy. But when we take the very high level view, the 30,000-foot view, we do still think that we have a notable more period of economic expansion, which should be good for equities. But we should continue to expect these elevated periods of volatility, not only in the short term, but really for a long while to come as we march forward into a higher regime or a regime of higher rates.
Jeff, staying with you for a second here, as we're looking for kind of exactly where some of those bets, some of those kind of long-term perspectives are going to be placed. You've talked about this battle between two camps as well, those looking at energy and financials versus those who are looking at a reversal in some of the high growth tech. And so where exactly would you be aligning right now?
You know, the biggest thing that challenges me isn't so much the growth prospects of high growth tech. They are fantastic companies. They've got fortress balance sheets, and they really have shifted the world that we live in, and they will continue to shift the world we live in. But that doesn't necessarily mean that they're the best equity stone in any single period, right? When you look at where multiples are on a number of those companies, relative even versus their growth potential, that's really where investors should take a step back and begin to digest whether those multiples are sustainable into a higher rate regime. This gives me significant pause, and where in the portfolios we're managing, we're broadly taking a step back from those high multiple companies, waiting as they adjust and then beginning to step back in, because they still are the fuel to underlying economic growth. But we need to remember underlying economic growth and financial or stock-led growth are very different things as the Fed reverses course.
And Andy, let me get your thoughts on earnings season. We have Alphabet, we have Amazon on deck this week, some pretty big names. We've already seen some disappointment from the financials, a little bit of a surprise from Apple. What are you expecting here?
I think this earnings season is going to be about the haves and the have-nots, and not so much about who has growth, because just about everybody is posting very solid growth regardless of the sector. It's who has cost discipline and who's able to maintain their profit margins. That's really what we've seen so far this earnings season. Early announcers, JPMorgan, Goldman Sachs, disappointed the market, not because they didn't grow enough, but because their cost items were really starting to creep up there, especially the cost of keeping their workers in their seats. Meanwhile, Apple last week really put a floor into the market single-handedly. Why so? Because they were able to maintain that cost discipline. They demonstrated that they were able to overcome these supply chain challenges to still be able to deliver a record revenue print.
You had some significant discounts where we were seeing companies like Netflix, Tesla, some of those longer plays being set up as a result of those discounts that were in play coming into these past two trading sessions that we've seen to round out January. So where do you imagine that there is going to be more of the investor sentiment of buying on the dip right now? Andy, that one to you.
Sure. I think anybody who's able to generate free cash flow and see a pathway to profitability in the near term is going to find a floor to their share price at a reasonable valuation. I think Netflix is a great example of this. They took it on the chin, 20% down on the day that they announced earnings, mostly in response, not so much to cost, but mostly in response to slowing growth. And yet they are a free cash flow machine. At this point, they have hundreds of millions of subscribers. It's really about creating that cost discipline to be able to be a profitable company. And that's why I think they're finding a bid now, whereas some of the less profitable tech firms can be down 50% and still not attract investors.
And Jeff, we've seen a tremendous amount of volatility this year. It's been risk off, risk on day to day, sometimes multiple times within a day. I'm just wondering what you expect on the volatility front. A lot of this coming from moves in the bond market. How do you see the volatility space shaping up this year?
I think one of the things we've seen, not just even recently, but across the last decade plus, is investors are watching the Fed. And the Fed ebbs and flows, right? They ebb between very easy and accommodative monetary policy. And when they begin to scale back monetary policy, that doesn't just come and go from a day-to-day perspective. That stays with markets for months at a time, if not even years at a time. And that will translate into the same thing from a volatility environment. So as we see individual days with heightened periods of volatility, we really think that we're in this a notably different regime where we should expect these large reversals both intraday and day to day as the Fed steadily marches rates higher. So from our perspective, this is an excellent trading environment for active investors. And this is an environment where you can truly express conviction in individual names and portfolio construction, and where you can allow yourself to shine throughout that market cycle. But we are absolutely in a period of heightened volatility, and we think it's here to stay for some time.
All right, we're
Jeff
going to have to leave it there, but
who is
really
the Thornburg Investment. Oh, sorry.
Go ahead, Brad.
Go ahead. Okay. Jeff Klingelhofer, who is the Thornburg Investment Management co-head of investments, and Andy Capron, who is the Regent Atlantic co-chief investment officer, joining us here today. Gents, thanks so much for joining us and weathering through some sound issues with us too. We appreciate the conversation and the insights. Jared, I'll toss things on over to you because we've got some interesting looks at the end of the month, and what a month it has been in January, Jared.
Yes, it has. We've been just talking about the volatility. I think that's something that just kind of slapped investors in the face very, very close to the beginning of the month. I want to go to the Wi-Fi Interactive. And this, by the way, is about an article that I'm writing up, going to be posted hopefully later this evening, if I can finish it up after the bell here. Nasdaq Composite, let's get the year-to-date view, and we can see it's down 8.98%. Now, this was a day ago. We were looking at the worst Nasdaq performance for January on record, but now it is number 2. You'd have to go back to 2008 to find another January that didn't do so well. In fact, that was the beginning of the global financial crisis, so kind of ominous there. Another thing I found, I'm just going to put the sector action for the month up as I'm talking here. Another thing I found was that 6 of the 7 worst Nasdaq Januaries happened since the year 2000. Now, the data only goes back 50 years, but that's still kind of an outsized source of volatility. And this is all par for the course. This gets back to electronic trading, the demise of the pit trader, And you can see that in the price action. Now, what I want to focus on here, this is how the month rounded out for the various S&P 500 sectors. Energy is a huge standout, up 18.7%. Financials can't even round to anything other than zero. After that, you get the defensive sectors of staples and utilities, each down about 1% and 3% respectively. But to the downside, consumer discretionary really got hit. That's down 9.5%, followed by real estate, healthcare, materials, and also tech, all of those down about 7% or more. And then you take a look at what's happened inside the Nasdaq 100, and a lot of red on the screen right there, notably Amazon down 10%. That's part of that consumer discretionary group that we were just looking at. Tesla down 11%. And that gets even worse for some of the software makers, chip makers. We can see AMD down 20%. That's not even the worst performance. Netflix down 29%. And the absolute worst, the biggest laggard, is Moderna. That stock is off 33% as a number of back stocks simply got pounded. Also want to take a look at the ARC Innovation components here. They had an absolutely terrible month. Now, first I'm going to show you what happened over the last 2 days. Nice to see them bouncing back. But when you take it into context of the year-to-date price action, really seeing a lot of these here. So look at Shopify. That's down 30%. Roku down 20%. Palantir down 25%. Now take a look at what's happened over the last 2 days. Who's number one? Shopify. And then we find Twilio. So a lot of the most beaten down names are getting bought today. What does that tell me? Probably a bit of short covering. So not sure the bottom is in just yet. It's a start, but we're going to have to see what happens in January when we finally get a look at what those flows are into the second month of the year. So it looks like we're going to go to break here. And we do have a possible intro for this, but it doesn't look like I have it on my screen here. So we're just going to go to break, be back in a couple minutes.
My pledge to you is that I will do my best to try to balance out these more controversial viewpoints with other people's perspectives so we can maybe find a better point of view. I don't want to just show the contrary opinion to what the narrative is. I want to show all kinds of opinions so that we can all figure out what's going on, and not just about COVID, about everything.
That was Spotify podcaster Joe Rogan responding to the backlash surrounding his stance on COVID-19 vaccinations after singer Neil Young pulled his catalog from the Spotify platform in protest. Now, Spotify shares, they did rebound today, even as more artists pledge to remove their music. So will a new COVID-19 information hub be enough to keep more musicians from leaving the streaming platform? Big question there. CFRA analyst John Freeman joins us now to discuss, alongside Yahoo Finance's own media and entertainment reporter, Alexandra Canal. Okay, so let's get into it here. John, first to you. Want to get your reaction to the share price move today, and what most notably stands out from this particular instance that Spotify is having to move through, having its own kind of Netflix Dave Chappelle moment, if you will.
Right. Yeah. So the key is that Spotify is not a platform per se. I think it's definitely arguable that it is a media company and therefore has, an editorial obligation. Whether or not that passes legal muster, I don't know, but I believe that kind of, users and people who subscribers and even the free users who listen to Spotify, they feel that, right? It's more like a radio station than it is, Facebook, where sort of anybody can put up their opinion, and there's more sort of leeway with regard to tagging that information and so forth. The disclaimer definitely helps, but I don't think that Joe Rogan's sort of, hey, all opinions are equal with regard to things like that, I don't think that passes muster. And I think there is a potential for backlash that Spotify really has to be careful of. But of course, at this level, I still have a buy on the stock because there are some very powerful secular trends that are driving the growth of the company worldwide. And yet at the same time, they have some powerful bundler, competitors like Amazon and Apple that they can't, it's not like they have a lot of leeway, the same kind of leeway that, for example, Facebook would have or Google would have, in search. You just don't, there's just not that many alternatives. I think there are more legitimate alternatives to Spotify. So that is definitely a concern and a risk.
And John, let's talk about some of that potential for growth. I mean, Spotify listeners, they've clearly connected with Joe Rogan's podcast. It's the most popular one on the platform, boasting 11 million users. So how much of this is about protecting Rogan and that asset? Because not only could this help lead to more successful podcasts down the line, but it's also a great way for Spotify to expand its advertising unit.
Right. So that's an interesting. So right now, more than 80% of their revenue comes from subscriptions, and they're really trying to drive the advertising side of that revenue. Particularly important in countries, outside of the U.S., where there's not as much disposable income, but there's certainly a lot of interest. India, for example, has tremendous subscriber growth and is really starting to become a pretty significant amount in terms of the number of total subscribers. So that is I think that's meaningful. I don't know, 11 million people listening to Joe Rogan. I think the key number is how many would leave Spotify, right, if Joe Rogan went somewhere else. I think that might be a meaningful question. Obviously that's sort of a hypothetical. They've got a relatively long-term contract, but so I think the backlash is still a concern, and I think they need to handle this, very carefully. And I think the disclaimer is probably a good start, but maybe not the end. I think they should probably, construct some protective moats around this kind of content that could be, that could, for one reason, it could attract government scrutiny, which is another sort of thing that Spotify, maybe not in this country, but in others, that's something that Spotify doesn't want to be, anywhere near, right?
Well, we know that there's already a lot of scrutiny on Amazon and also Apple in this country, maybe Microsoft as well. Let me just pose you the question this way. I'm wondering about churn within the industry. You talk about people following Joe Rogan to another platform. How many would leave if he stays? I'm just wondering because I have been a YouTube Music subscriber for years, grandfathered in from YouTube Red. I'm not changing. I'm not going to go anywhere. I've never even tried Spotify because I'm happy. I'm just wondering how that shakes out in the industry.
Right. So it's not just in terms of the number of subs that would leave, but it's also the number of subs that wouldn't join, you know, if when they get presented with the choice, because I think we've got a long we got a lot of growth, subscriber growth ahead of us in this, in the let's call it the audible content space, right? And so I think that's really what is potentially concerning. I mean, we're not talking about a disaster where it falls off a cliff, but we are talking about perhaps clipping that growth significantly, which would have an outsized impact on a growth stock like Spotify. So that's kind of where I'm I'm sort of focused on. Go ahead.
It also comes down to the demographic of user, right? Because if you have an artist that decides to take the alternative side of Joe Rogan, who is actually carrying a larger fan base, and in the core demographic that Spotify is going on, what type of impact would that have, or how would investors even look at that situation where it's a fan base that one artist carries? Because if we look at the artists that have said that they're going to go elsewhere, that's perhaps on the higher end of the age demographic or spectrum that Spotify sees among its user group.
Right. I think the artists who are leaving are not necessarily going to take subs with them, right? I don't think Neil Young is going to take 11 million subs. No way, right? Not even in the ballpark. However, it signifies something. And if somebody can get most of the content that they want, most of their music content that they want with Amazon or Apple, just as sort of a social good motivation kind of a thing, we see this kind of coming in and becoming more important. Activision, I think, was another sort of example. I think they dodged a bullet with the acquisition by Microsoft, but there were a lot of there's a lot of interest in not playing looking for alternatives to Activision because of the lawsuit, the state of California suing Activision for promoting a culture of pervasive sexual harassment and so forth. So these social issues do matter, not necessarily for any specific artist, but I'm thinking more sort of generally speaking, as a backlash, right?
And John, real quickly here, just to wrap this up, what kind of precedent do you think Spotify is setting moving forward, and especially when it tries to get other exclusive podcast deals on the platform?
Right. Well, I think they're basically saying that your speech is going to be protected. We might have to disclaim it. But there's a couple of other things that have been bothering me about Spotify. Despite all the, like I said, I have a buy on the stock and a lot of secular growth trends, but I did downgrade it from strong buy to buy because there's a lot of other things that are going on. They're bundling their customer service, advertisements popping up in the middle of meditation applications, listening sort of content that you don't want, the middle of it to be interrupted. That just seems, there's a lot of things like that that kind of struck me as a, poor execution, poor operational execution. And I'd like to see, I'd like to see some improvement on that as well. And kind of the way they've handled this has been a little, ragged. So those are the kinds of things. It's more indicative, right, than specific to this issue right now, if that makes sense.
John Freeman, CFRA analyst, and our own Alexandra Knoll joining us here today to talk all things Spotify, and we'll see how they continue to chart their own course and navigate out of this issue that they found themselves in. Thank you both for the conversation here. Coming up on the other side of this short break, the Bengals surprised the Chiefs, and the Rams are heading into the Super Bowl with home field advantage. We've got your recap of the conference championships, plus a look ahead to the big game. Coming up next.
Welcome back. Got some breaking news here. NXP earnings on deck, and Yahoo Finance's Ines Ferre is here with all the details. Ines.
And Jared, NXP reporting earnings per share for its fourth quarter of $2.24 versus an estimate of $2.98. Meanwhile, its revenue for the fourth quarter came in at $3.04 billion. The revenue the street was expecting was $3 billion, so that was a beat. Automotive revenue came in at $1.55 billion. That beat the estimates. Also, industrial and Internet of Things came in at $661 million. That also beat estimates. The company announced a dividend raise and also a new share buyback program. Today, the stock was up 8%, and right now it's up 2% in after hours. Jared.
All right, thank you for that, Ines Ferre. We also want to bring in another Yahoo Finance reporter, Josh Schaefer, and that's because we're breaking out the chips. We're cracking open a cold one, and it is time to talk the Super Bowl. Bengals bested the Chiefs over the weekend. They head to the Gridiron Showdown against the Rams in 2 weeks. And I guess we're talking ratings, too. We got those are finally bouncing back after a dismal year. So why don't we start there, Josh?
Yeah, Jared, we just got the first estimated ratings for the NFC Championship game, which was between the Rams and the 49ers, and that looks like it came in at about 35 million. So to put that number in perspective for you, that's a big number for the NFL, a number they're probably going to be happy with. And to put that in perspective, going back to last week with the divisional round games, 43 million people watched the Chiefs versus the Bills in kind of that epic showdown between Josh Allen and Patrick Mahomes. And that was kind of a game that you'd expect 43 million people to watch and set some records for the NFL. That was their most watched divisional round game in 5 years. And so we've seen these kind of big numbers being hit for the NFL throughout the playoffs now. Going back 2 weeks prior for the 49ers-Packers game, that was the most watched Saturday night program in television since the 1994 Olympics. So after years of the NFL kind of missing the mark with some of their playoffs, last year's Super Bowl, I might mention, was the least watched Super Bowl in about 15 years. So the NFL is starting to finally hit those marks again. We're excited to see what we got the other game, the Bengals-Chiefs AFC Championship game for viewership, and what will come for the Super Bowl. It certainly seems like it's building in the right direction. It's already building in the right direction. People seem to be happy with the Super Bowl matchup as far as ticket sales go. I was taking a look earlier at kind of the average ticket price just to get in the stadium for coming up in 2 Sundays from now. It's going to be around $5,500 just to get in. And that's before fees. So I average that between a couple of the different exchanges that are out there. You add in fees, it's probably closer to $7,000, $7,500 per ticket once you start adding in fees and different things like that. I compared that to 1989, the last time the Cincinnati Bengals were in the Super Bowl. That was $100 to get into that game. And I know you guys know, even if you adjusted that for inflation, it's barely over $200. So we're talking a big difference in price from 1989 to now, kind of proof to show you how big the NFL has become.
Yeah, Jared, when we think about the number of viewers that were watching yesterday and how much that also correlates with more states bringing gambling and wagers for sportsbooks online, how much do you think that contributed?
Yeah, Brad, I think that definitely is something that we're seeing that matters, right? It's a way to engage an average sports fan or an average viewer. It gives all of us something to root for and something to watch. You can gamble on pretty much any part of these games now, and you can sit with your friends at a bar, even if you don't like football, that's not your sport. It can engage you, and that's why the league is starting to sort of lean into this a little bit. You see all the partnerships with DraftKings and FanDuel and Caesars, and the numbers so far, specifically looking at some of the New York State numbers, have really shown us that the handles are growing and they're eye-popping. We think New York State this Friday, we'll have the numbers for you here on Yahoo Finance on Friday, but we think they're probably going to post the largest mobile sports betting handle we've ever seen in a month. And it will be only in about 3.5 weeks of legal gambling in New York State. So the gambling space is certainly taking off, and it'll be exciting to watch through the rest of the playoffs.
All right, so we'll be waiting Friday for those numbers. We're sure that you will be back to present them to us. Coming up, Overtime and MetaQuest see a future with live sports in virtual reality. The details behind the experience up next. Welcome back. Atlanta-based Football League, Overtime Elite, and MetaQuest, they're teaming up to create exclusive VR content. And we want to welcome back into the stream Josh Schaefer from Yahoo Finance, along with Mark Cohn, Overtime and Overtime Elite Chief Content Officer. Mark, thank you so much for joining us here. Can you just give us an overview exactly what you're doing? Because I was reading some of the details, and this came at me from left field, but it seems like a really promising idea that you have here.
Yes, so we are a basketball league that pays high school age players to play in Atlanta, Georgia. We have 16 to 19-year-olds, some of the best players in the country, aspiring to become, NBA and professional basketball stars down the road. And so what we've partnered with MetaQuest to do is to create some VR dunk contests that kind of bring the audience from around the world closer to the action. And so because we built this arena in Atlanta, Georgia, that is state of the art, it's one of the greatest digital video arenas in the entire world. Our lighting system is only in 3 different places in the world. It's the Barclays Center, the Staples Center, and OT Arena. And we were able to create a virtual reality experience with MetaQuest that brought viewers from around the world to be able to watch our unbelievable athletes put on one of the great dunk shows that you'll ever see.
Yeah, Mark, can you walk us through, I guess, the logistics of putting this on, VR headsets and kind of what the added challenges are there? I don't know if you needed a certain amount of different cameras that had to be added in, but what were kind of the logistical hurdles and what needs to come together to make this happen?
So for our regular games, we have 10 broadcast quality HD cameras. We had to add 5 virtual reality 180 cameras to our camera package for this dunk show. And part of the intricacies of virtual reality is being able to put the cameras in the right positions of like, where would the audience want to watch this thing? And so we put one right underneath the basket so that you are sitting right on the baseline, right underneath the hoop. We put one right around the 3-point line. As you can see in the B-roll, you can see fans lining the court. And so we have one of those cameras right there. So you would be shoulder to shoulder with those people on the court. And then we put another one along the baseline to kind of give that side view perspective for the audience that was a little bit elevated. And when you think about 180, it's almost like in virtual reality, every camera is kind of like you have 180 degrees line of sight. So every camera that you set up, you kind of think about like, what does the viewer see who throws on the headset? And for all of you who would want to go see it, if you throw on one of your headsets right now, we're in Horizon venues for everybody to kind of check it out. It is a surreal experience. So I threw one on this morning to kind of see how things looked, and was able to just bump into my friend who was, in the balcony watching as well. And we were able to have a full conversation while watching the dunk show. And I think when you think about the future of sports and being able to bring people closer together, this metaverse that everybody's kind of talking about, really the key part of it is community. Right? You're able to kind of go there and, for instance, I'm a gigantic Miami Dolphins fan. I can imagine throwing on a headset someday, watching games live from the 50-yard line with all of my Dolphin friends. And the ability to connect to your community, talk to people while you're really right in the action, that's what this technology allows you to do. And it's ready right now.
Certainly. And so when you think about the different monetization touch points that come with an experience like this, what would that look like, and how readily accessible are those touch points for the different viewers and the people who would be engaging with this different type of immersive experience?
So I think it's probably what you guys talk about every day, all day long right now, right? It's like the rush, for NFTs and like, what are these non-fungible tokens, and how do you give people different access to things that they have in real life, like this, this hoodie? How does this become a digital item that all of our fans can watch? And so whether that is sneakers, whether that is digital hoodies, whether that is like different access points, right? So whether that's our athletes at OTE who have their avatars being built, and us being able to host different rooms, build an overtime basketball court inside of the metaverse, it's the ability to kind of create a deeper connection with people who can't see you in real life all the time. You can kind of bring the next best experience into the metaverse. I think that obviously everybody's on their phone all the time, nonstop, right? And so it's really not much different than that, except it's even more interactive, and people will soon, I think, Bill Gates said that in 3 years, every meeting will be in the metaverse. I can see how that can happen after experimenting with this technology. I think that the blend between your real life and your digital life are going to be one and the same pretty shortly.
And Mark, when you mentioned the fact that you have to kind of have those cameras almost perfectly placed, right, to get in the right spot for the viewing, a dunk show is pretty, where the guys are going to be, and where the ball is kind of going to go, and it can be planned out to some extent. Yeah. Is this possible to do this with live games? Do you think live sports is headed that way? Could we ever watch live sports in the metaverse, or is it too unpredictable?
No, it will happen as the technology gets better. There are a couple of different technology points that will need to improve. But if you were able to put a camera at, and we will do this shortly, if you were to put a camera at center court, if you were to put cameras behind the baskets, because of their fixed position, and you have to make sure based on like, hey, how you cut cameras can get a little intricate based on how people are viewing. You don't want to, all of a sudden, have a camera that's going this way and then and then cut quickly to a camera that is in the opposite direction. But the technology is almost there. And I think that you can watch a basketball game today in virtual reality. The NBA does it, and it's a pretty good experience.
And Mark, the tech looks amazing. I got to ask you about your business and perhaps your path to the IPO, because I'm looking at some of your notes here. Your last funding round valued at about $250 million. That was last April. A lot of things have changed. You looking to go live? You looking to list this year, next year? What does that path look like?
I'm not the guy who makes business decisions. I'm a content guy. I'm the guy that gets to dream up of building this arena and being able to think about how we go into the metaverse. But there's smarter people than me that know about IPOs.
Fair enough, and we'd love to have you back when you get some of that new tech up and running. That is Mark Cohn, Overtime and Overtime Elite Chief Content Officer, along with Yahoo Finance's Jeff Schaefer. Coming up after the break, we'll be right back. Just give us 2.5 minutes.
Welcome back to Yahoo Finance Live, everyone. We're continuing to keep a close eye on shares of NXPI here. After the bell, they've been moving higher and now in fractional declines here. This is after the company has reported its most recent earnings revenue that came in for the fourth quarter at least. They saw $3.04 billion. That was up 21.2% year over year. They also announced their full year record revenue of $11.06 billion. To break down these results a little bit more with us, we've got Will Stein, who's the manager and director over at Truist. Will, let's just dive right into it. We're taking a look at the actuals versus the estimates. The shares are fractionally lower here in after hours. What do you believe investors are latching onto with this report?
Yeah, so if you'll notice, the shares traded up initially, which is the correct read based on the fundamentals that the company reported for the quarter and guided. However, when you read through the details of the press release, you find that the company disclosed that its auditors identified a material weakness in its controls. The company does not believe this is going to result in any restatement of financials, but a material weakness tends to be, a fairly important thing for investors to focus on. I think that's what's dragging the shares this afternoon.
Yeah, that is an important thing to button down, though, those controls and procedures. But I want to talk to you about NXP and the semiconductor space overall. We talk a lot about the chip shortage, but also interest rates factor into a lot of what we're talking about. I'm just wondering, what's your assessment of the semiconductor industry for the current year? We've seen a lot of the stocks get battered so far, bouncing back over the last couple of days, but start to the year.
Yeah, so we provided an outlook piece towards the end of last year, and that was to recognize that we are clearly in the back part of a cycle, right? So the semi industry saw peak growth in second quarter of 21. So we've already been in a fading year-over-year growth situation already for a couple quarters. We expect that to persist through 2022 as well. However, slowing growth doesn't mean slow growth, and it doesn't mean a collapse of the cycle. We believe that as growth moderates as we go through the year, and we see that back half of the cycle and revenue decline, not revenue decline, but year-over-year growth declines, we think there's still going to be upside pressure to numbers because demand is still in excess of supply. So we think that as companies can eke out a little bit of incremental capacity and they get better pricing, we'll still see upsides as we progress through the year. So we're bullish on the group, and we continue to have that view.
As we continue to evaluate the broader chip sector and the year or years of investment that we may be looking at going forward from this point, with new factories for fabrication being brought online, for NXP, where do the largest prospects still stand in their segment approach that they have?
Sure. So the company has 4 segments that it discloses. The ones that are most supportive of significant growth over the next few years are in the automotive end market, which is the biggest end market. It's the one that investors tend to pay the most attention to for this company, and the industrial and IoT, as they call it. This is the long-awaited Internet of Things that is really delivering very good growth for several semi companies. But NXP is particularly well positioned because of its combined products of microcontrollers and connectivity assets.
And what about its suppliers? I'm looking at Taiwan Semi as one of its biggest suppliers and its customers. How does it fit into the landscape here? Who is dependent on them for these chips that they're making?
That's a great question. On the automotive side, they would typically transact with what are called the tier 1 automotive companies, but their end customers and the way I think the company tends to think about it is that the customers are really the OEMs, so the Fords and GMs and VWs and the like, right? So on the automotive side, that's those are the biggest customers, right? It's the global OEMs really, and in the industrial IoT end market or that segment of the business, it's really a very different story. It's really very fragmented across a very large number of customers. It tends to be very distribution centric and very dependent on production in China. So it's a very different business from the automotive one.
Second largest growth in the industrial and IoT segment here. Considering where we saw that growth come in year over year, 29% growth in that particular segment, where can they continue to see some of the opportunity in the year ahead, I suppose, to continue kind of that neck and neck battle with the other segment that we talked about in the automotive space? And, especially considering that it is, even despite the growth that they've seen, 1/3, roughly, rough numbers here, of the size of that automotive segment.
Yeah, I think there's an important, what I'll call a misunderstanding among many investors and the public about shortages in semiconductors. So let me explain for just a minute. The automotive end market tends to get quite a bit of attention when it comes to these shortages. And I think a big part of the reason is the number of Americans that are affected in terms of jobs when these factories have shutdowns. However, the shortfalls in the much broader, much more diversified industrial end market, I believe, are even more severe than the shortages in automotive. It doesn't get the same sort of press. It doesn't get the same sort of attention. It's not like you can name, your 5 to 10 OEMs in industrial that are going to be shutting down factories as a result of shortages. It's a much greater number of much smaller factories and smaller demand drivers, but they're a very important supplier to a wide number of industrial customers. And the shortages there are even worse, is my best understanding.
Will Stein, Truist Securities Managing Director, joining us here to break down NXP earnings that have just dropped this afternoon, and we'll see what more the company has to say when they address analysts on their earnings call. Will, we appreciate the time. Thanks so much for breaking this down with us. And everyone, coming up on the other side of this short break, the New York Times and the puzzle czars that they're buying a new puzzle game, Wordle. We'll discuss exactly why and the significance of the timing after the break. known for puzzles in print and have gone digital with some of those same puzzles. New York Times, not to be outdone by any newcomers. They are buying Wordle. They are acquiring this company. And of course, Wordle has seen astronomical rise over the recent weeks in the early days of 2022, as we've seen it go viral with people posting their Wordles and how well they're doing. They tried to get the Wordle in 6 tries, and it's got to be a 5-letter word, basically. And so I don't know if you're a Wordler, Jared, but I think for New York Times and what this spells out, if you will, is that this buying spree that they've had to kick off 2022, of course, to begin the year in January, they bought The Athletic. And so really kicking off 2022 with some of these key acquisitions to either position their puzzles in one sense or just position the publications that they've got in another sense.
Well, that's right. And this seems like a perfect fit, right? The New York Times, famous for its New York Times crossword puzzle. To answer the big question here, I am not a Wordler just yet. I came back to Twitter after a weekend and I couldn't figure out what was going on. Took me a day or so and I decided it's a little bit too trendy. So I'll see if it takes off. But they went from 90 to something like 300,000 users in a few months, just blew up overnight. And I think it's fitting too, because this is something that keeps people coming back. It's a little bit of a hook. You can only do one puzzle per day. And from the background that I read on it, that's when it kind of launched, that and a few other things. It's really interesting when these little, I guess, I don't want to call it a fad because maybe it's going to be here to say, but when one of these things hits and takes Twitter by storm, and suddenly everybody's doing it, everybody's talking about it. And you mentioned, yeah, this is a buying spree by the New York Times. They're up to 8.4 million subscribers. And also, Brad, as you noted during the break, the New York Times broke their own story and immediately put it behind a paywall, Brad.
It's super fitting monetization opportunity for sure, on top of the acquisition and what they're seeing in the potential in Wordle perhaps in the future too. And we'll see how that experience maybe changes in the broader gaming landscape. Things are heating up. We've seen the Activision Blizzard acquisition that Microsoft went forward with. Of course, to begin the year, we had another major acquisition that took place, and I believe the 2021 in the form of what we saw prompted in all of this space in the arcade. It came down to what the future of gaming looks like as well. So amazing to see some of these acquisitions, but that's going to do it for us today, Jared.
You bet. And we'll see everybody back here tomorrow at 9 a.m. Be here at 9 a.m. That's when we start tomorrow. Have a great evening.